Axis Bank, LTI Mindtree later today. Israel and Hamas reaching a ceasefire agreement to pause the war in Gaza after 15 months of fighting. The deal will come into effect from Sunday, with the first batch of 33 hostages set to be released by Hamas in exchange for Palestinians held in Israel jails. Israeli Prime Minister Benjamin Netanyahu says that the final details of the deal are still being worked on. Hello, good morning. You've tuned into CNBC-TV18 and I'm Vinny Motiwala. You're watching Power Breakfast with me. A quick look at what the Asian markets are doing. We don't have a bad handover coming in. So when you're looking at the Asian markets, we're seeing green across the screen. Taiwan index, 2% up. Hang Seng holding on to gains of more than 1.5%. Any of the indices, when you look at Nikkei, when you look at ASX 200, Shanghai, Kospi, all of them are managing to hold on to good gains. And do not forget, in South Korea also, the rate change, the central bank has kept the rate unchanged. So that is also leading to some bit of a positive move coming in for Kospi. Other than that, Nifty implied open. Let's look at that because that's indicating a gap up start for the Indian markets, 136 points up, given the handover from Asia as well as the US markets is quite positive. So yes, not a bad start is what we're expecting today coming in for the Indian markets. Now talking about the US market and the handover from there, Wall Street actually ended with solid gains after cooler than expected inflation print that came in, and strong earnings from several big banks sent the indices soaring in trade. When you look at the Dow Jones, that rallied almost 700 points. S&P 500 advanced by 107 points, and tech-heavy Nasdaq rallied up by almost 467 points. Boosting the sentiments of Wall Street were strong earnings that came in from a banking heavyweights. So JP Morgan Chase, Citigroup, Goldman Sachs as well as Wells Fargo reported a good number, which raised investor sentiments after their fourth quarter earnings beat the street expectation. Let's go to CNBC's Rick Santilli, who's breaking down the inflation data for us.
Consumer Price Index for December comes out up 0.4 on the headline, exactly as expected. To find a higher number than 0.4, you're going all the way back to August of 2023 when it was up 0.5%. Strip out the all-important food and energy, up 0.2, 1/10 cooler than we expected, 1/10 cooler than the rearview mirror, up 0.2. How does that comp? We equal July of 24. Find a lower number, you go back to June of 24. Year-over-year numbers, here we go. On the headline, year-over-year, up 2.9. As expected, and I always question how much more important as expected is to the fact that it's 0.2 higher than our last look, which was 2.7. To find a number higher than 2.9, you're going to June of last year. And finally, on the year-over-year core, it's 3.2%. 1/10 lighter than the rearview mirror, 1/10 lighter than expectations. But, 3.2 is a little bit of progress. It equals where we were in August. Now, that equals August. To find a lower number, you're really going in the way back machine. You have to find a 3% number, and that's all the way back in April of 21. Now, many don't look at the indices. I look at the indices. This really says it all. Okay, if you look at the CPI index, started in 1913, it now is 315.605. 315.605. That's the second highest number ever. The highest, the record, was October of 24. If you look at this, pretty much every month we make new all-time highs. So it's nice that we pulled back just a smidge. And if we look at the year-over-year, core, going all the way back to 1957, 323.38. That is a new all-time high. What does that tell me? We could look at these numbers based on expectations like we do, but the reality is, even yesterday, if you looked at some of these smaller month-over-month numbers, it just means that the inflation rate is growing more slowly. It isn't going in reverse, and that's what these indices tell us, that virtually anybody out there watching that isn't an economist, they feel the pressure of rising prices. And it's a pressure that very much never seems to ease off. We don't normally see a lot of negative numbers. And speaking of negative numbers, there's one I haven't pointed out yet. Empire was also out. January number, kind of real time, minus 12.6. Minus 12.6 would be the weakest, going back to minus 15 and change in May of last year. So we still see that manufacturing is a bit curtailed.
Okay, and after the cooler than expected inflation, yields saw a sharp fall. Priya Mishra of JP Morgan Assets Management comments on the latest inflation print is good for bonds and equity markets. Listen in.
I think this is a good number. It's a sigh of relief for the bond market as well as the equity market, risk assets in general, because it takes that Fed hike. I think, we priced out a lot of the Fed cuts in the last few months. And now there was talk, well, if inflation's moving up and the big question still remains, what are we going to get from the administration? I would argue there's a market constraint, there's a political constraint. I don't think you're going to get that much, but I also think that that's behind in the market's mind. Are we going to get significant fiscal easing, which is why the long end of the Treasury market has been selling off? I think that's still an open question. We'll get this big, beautiful bill with significant deficit finance tax cuts. I don't think that's happening. That's still going to be in the market's mind. But I think the reaction where, okay, inflation is slowly but surely getting close to that 2%. It's just taking longer.
Okay, that's all the global market action that we have this morning. But how is all this going to be impacting our Indian markets? We have a team of research joining in with us to take you all through the trade setup, as well as which are the important stocks to watch out for. Hormaz as well as Vamakshi, good morning and thank you so much for joining in with us. Hormaz, let me go across to you to get us a setup for trade. What are we watching out for? Implied open surely indicating a good start as of now.
Good morning, Winnie. And the big question that everybody on the street wants to know is that the kind of moves that we saw on Wall Street overnight, will we be able to replicate that in today's trading session? And the answer as of now is a resounding yes, because the GIFT Nifty is indicating a 150-point gap up for our own markets as we speak. We had a slight inkling of that in yesterday's session as well. We did end off the highs of the day, but we didn't end in the red. There was every attempt made to buy every possible dip that occurred in the markets as well. We did break a 9-day streak of making lower highs on the daily chart, but we did not sustain above that 23,250, 23,300 zone, and that will be the first zone for the Nifty to cross in order to move higher towards that 23,500 mark. And if the contributors list will give you an idea of why there was pressure from the highs of the day, it was the banking names that put pressure, with Axis Bank, HDFC Bank, Bajaj Finance, all of them pulled the Nifty down, but it was Reliance that kept the Nifty upbeat and ensured that it ended in the green in today's session. All of them off the highs. The mid-cap index, the broader markets too sold off from the highs of the day in line with the Nifty, but they too managed to end in the green in yesterday's trading session. Now, the first hurdle today, of course, in the sustaining above that November low of 23,263 will be the first challenge for the Nifty. Of course, today is the weekly expiry as well, so that volatility will be at play for the index. You need to keep that in mind as well. And three major earnings, of course, with Reliance, Infosys and Axis Bank, that might just keep the bulls a little cautious and ensure that they don't go overboard. For now, the GIFT Nifty is indicating a gap up for our own markets, and there are plenty of other earnings in store as well.
Absolutely. Thank you so much for that, Hormaz. But let's go across to Vamakshi, who's here to tell us which are the important stocks that you should watch out for in today's trading session. Good morning, Vamakshi.
Well, good morning, Vinny. Let me first start off with L&T Tech. The company reported inline operating performance. The dollar revenue saw an uptick of 1.6% sequentially, coming in at $311.9 million. They've also updated their revenue guidance to near 10% as compared to 8 to 10% earlier. Margins have, come higher than the CNBC-TV18 poll at 16%. The net profit, however, has come in at 322 crores, lower than what we were expecting, and that is mainly on account of lower other income. HDFC Life total APE saw an uptick of almost 12%. This came in higher than estimates. VNB margin came in higher than the poll at almost 26.1%. CEAT's revenue saw an uptick of 11.4%. The margins, however, have contracted to 10.3%, and the net profit resultantly is down nearly 47%. In addition to that, the company said that they will be investing 400 crores in capacity expansion for their Nagpur unit. Punjab and Sindh Bank is the next counter that we're watching out for. NII saw an uptick of almost 27%. The net profit has more than doubled to 2 crores. The asset quality has improved with the gross NPA at 3.83% and the NNPA at 1.25%. RVNL also on our radar, and that is because the company-led consortium has bagged an order worth 3,622 crores from BSNL. This is for development of middle mile network of BharatNet on DBOM. GAIL has entered into a settlement agreement with SEFE Marketing Trading Singapore, and the SEFE Marketing will be paying the company $285 million in settlement. So therefore, keep an eye out on all of these counters.
Okay, Mamakshi, thank you so much for that. Keep an eye out on all the stocks in today's trading session. But on that note, we're going to slip into a very short break. Don't go anywhere. After the break, we'll talk about Reliance Industries that will be posting its third quarter numbers later today. So don't go anywhere. We'll get you the key expectations.
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price.
Welcome back to Power Breakfast on CNBC-TV18. Let's move on and talk about Reliance that is set to report its third quarter earnings today. Rima is here with the key expectations. Rima?
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price hikes. And even the retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, geo and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Geo 2, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember, would be the July hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter, the overall subscriber base declined by more than 10 million on a sequential basis, perhaps as the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will watch. But remember, the stock has been a bit of an underperformer. So last year, Reliance Industries share price declined for the first time in 9 years, and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptake. Even the telecom business is likely to see telecom, stable. Tariffs retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
Thank you so much for that, Reema. But on that note, we're going to slip into a very short break. Up next, we'll get you the latest update coming in from West Asia as Israel and Hamas reach a ceasefire deal.
The retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, geo and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Geo 2, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember, would be the July hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter, the overall subscriber base declined by more than 10 million on a sequential basis, perhaps as the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will watch. But remember, the stock has been a bit of an underperformer. So last year, Reliance Industries share price declined for the first time in 9 years, and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptake. Even the telecom business is likely to see telecom, stable. Tariffs retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
For the third quarter for Reliance's retail business.
Welcome back to Power Breakfast on CNBC-TV18. Let's move on and get you the latest update coming in from West Asia. Now, after 15 months of fighting and 10,000s of people being killed, Israel and Hamas have finally agreed to a ceasefire and hostage deal. The agreement is set to take place on Sunday. NBC's Alice Barr has the latest on this.
Jubilation among the ruins in Gaza and on the streets of Israel as hostage families and Gazan civilians who've spent 15 months in the line of fire learn a long-sought ceasefire and hostage release is coming. Negotiators in Qatar confirming the three-phase agreement and crediting a joint push from the incoming Trump administration joining the Biden team's months of work.
At long last, I can announce a ceasefire and a hostage deal has been reached between Israel and Hamas.
The remaining hostages include Americans like 19-year-old Itai Chen, who the Israeli military says was killed in the October 7th Hamas attack and brought to Gaza.
There's been too much pain for these 15 months.
The family desperate for the closure of bringing Itai's body home, though that won't happen in the deal's first phase that has 33 women, children, elderly and injured hostages set to be released in exchange for Palestinian prisoners, dramatically increased aid into Gaza, and the withdrawal of Israeli troops from population centers to a border buffer zone. Soldiers and other male hostages would be released in later phases.
We are grateful, and it's a time to be joyful for those that will be reunited, but there's still work to be done.
The agreement is very similar to a proposal President Biden announced last spring. President-elect Trump crediting his upcoming inauguration as a catalyst to finally move forward. As the U.S., allies, and all those suffering hold on to hope, the agreement will bring a final end to a devastating war. In Washington, Alice Barr, NBC News.
And while announcing the ceasefire deal, U.S. President Joe Biden also reiterated that both his administrations as well as incoming Trump administration had been speaking as one team while working on other agreements and negotiations. Let's also listen into that.
I'd also note this deal was developed and negotiated under my administration, but its terms will be implemented, for the most part, by the next administration. In these past few days, we've been speaking as one team. This has been a time of real turmoil in the Middle East. But as I prepare to leave office, our friends are strong, our enemies are weak, and there's genuine opportunities for a new future.
Now bringing you the updates from Los Angeles firefighters continue to confront extremely strong and dry winds that have fueled two giant wildfires in the region. A new fire broke out yesterday in the east of Los Angeles, and around 6.5 million people remain under critical fire threat. The death toll has now crossed 25. Around 8,500 firefighters from the western United States, Canada and Mexico have kept the spread of fires in check for the last 3 days. The disaster has cast a shadow over Hollywood's annual award season, with several red carpet events being postponed or cancelled. And with that, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Don't go anywhere. Next up, we have Bazaar Morning Call.
Consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, quarter 4, quarter 1 and quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins. And we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year on year growth in the EBITDA and 8 to 9% growth quarter on quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll, which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Ustar and Swadesh, and finally their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
The weight of India in the EM index has actually been going up. And with the domestic bid very strong, valuations are relatively elevated. I wouldn't say they're extreme, but they're relatively elevated. We expect foreigners to be very engaged in the Indian market this year. Over time, it's on its way to being the largest market in EM. And that means global investors are going to pay a lot more attention to India than they have in the past.
China and Malaysia and Vietnam, through which Chinese transshipment goes through, will be targeted. We had 60% tariff on China, so China and tariff is 20% at present. We expected it to go to 60%. Then our sense is that on January 20th or that week of 20th, you're probably going to get many, many more countries under the tariff umbrella than just China and Malaysia and Vietnam. We have already taken out all rate cuts for the first half of the year. We just have 2 more rate cuts, one in June, the other in September, and that's it. I think a 3% depreciation is enough to take away that rate cut, but our depreciation higher than that, yeah, possibly the February rate cut gets pushed up, but we do have a rate cut in February. In fact, we have 100 basis points of rate cut in 2025 price for the RBI.
What's important, I think, is that GDP growth is over 6%. We're forecasting 6.3% and then 6.5% this year and next, the year ending March and then the following year. That inflation remains moderate, a little over 4%. The interest rates, we get 2 rate cuts in our view, and we think it's a 2 to 3 quarter phenomenon. If we're wrong, if it's a 2 to 3 year phenomenon and earnings growth falls away substantially, then our call on the market will be wrong.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, inching towards the 20th of January, Trump inauguration. 2 days to go for the week. This is a Thursday morning. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. It is looking much better with the overnight cues suggesting a bit of a risk on. I'm Prashant, with me my colleagues Surbhi and Nigel. Guys, good morning.
Hi, morning folks. Well, yes, plenty of green across global screens, some good news coming in. And the best news really is in the Middle East. Finally, it seems we have a ceasefire in place.
Yeah.
After so many months, and so many lives lost. But it seems that it's phased out. It's in 3 different stages. First stage, aid flows into Gaza, hostages are released. So good news.
Well, that's right. Good news for humanity. And in fact, the other big point is, has Trump peaked out? Has the Trump factor peaked out getting into that 20th? Well, we'll know in a couple of days from now. But it appears, at least as of now, post all the exuberance that Trump is coming, dollar index shooting up, yields moving up, I think some kind of sanity's come back. So pretty good times.
Absolutely. And I think markets are swinging like, what do you call it? A drunk sailor. I don't know. It's too early for that, But I think you got big moves coming through one way or the other. They're big, down and up and down. But as we've been saying, leading up to the 20th of January, it is going to be volatile. But I mean, this was not the last night's move was nothing to do with what Trump or expectations around Trump. It was pure hard data. So you essentially had the NFP, the jobs data last Friday, which triggered this big fear that rate cuts, etc., are off the table and markets plunged. Well, markets are reignited after cooler than expected US CPI print, which came last night. So the number actually, the core CPI, rose 0.225% month on month in December. This is this is the unrounded figure. Now, the reaction in equities and rates and dollar, etc., was pronounced. S&P was up 1.8, NASDAQ 2.5 higher. Russell was up about almost 2% as well. I mean, that entire tech complex, Tesla was up 8%, but, so many others, Amazon, etc. I mean, the entire large cap tech names in the US, outsized influence, of course, across all indices. VIX fell about 14% to about 16.12. So that's the fear gauge volatility, the CBOE VIX, which fell about 14% or so. Now, the 10-year yield, actually, it's not just the 10-year. You look at the 2-year, 5-year, 10-year, 30-year, everywhere there was a sharp decline there. So the 10-year fell about 14 basis points to 4.65. Remember, yesterday, when we were talking about this, actually, in the previous session, the US 10-year had reached 4.8. So from 4 and left off at about 4.77. From 4.8, it's now down to about 4.65. That's really big moves. I mean, if this number had actually come in hotter, 5 was possible, but we've gone the other way. Dollar index has slipped to about 109 odd levels or so, and this is essentially where things are. Consequently, Fed cut pricing firmed up to about 39 basis points now compared to 29 basis points before CPI. The interesting thing is markets are not really sure when to distribute these rate cuts. When will these cuts actually happen? Will it be in May? Will it be in June? Will it be in July? But confidence that there will be rate cuts has probably gone up a little bit. So at least 125 basis point cut will be seen by July. Let's put it that way. That's the confidence that markets have gotten. More conviction rather than confidence after the numbers. Now, oil prices is the other bit, which went up about 3% or so. 82.47 as far as the Brent oil price is concerned. And we'll talk more about this because oil's been a little bouncy. US retail sales data will be important and interesting. That's, of course, later, and we'll track it as it comes out. Now, just to tie in the levels, I mean, the downside levels are pretty clear as we've put out. You basically just got to look at the Monday lows for the Nifty and for the Nifty Bank as well. But we are bouncing a little bit, and we've got help from global markets, so you should look up and see what can happen. Now, resistance for the Nifty comes in at the 40 hourly. I mean, we put the 20 and the 40. 20 is conquered now, and 40 is in sight. So 23,347 is the first resistance. And then the daily averages come into play, which is so far looking at the hourly, but daily, perhaps 23,672 is the 20-day moving average. For the Nifty Bank, similarly, which, by the way, was the first of the two indices to cross the 20, the 40 comes in, the 40 hourly comes in at 49,023. I mean, I think that should get done if the GIFT Nifty open holds. And of course, after that, multiple resistances between 49,310 to 49,850. So those are levels. And I said on the downside, levels are clear. GIFT Nifty should come up on your screen indicating how we're likely to start. It's about 130 odd points higher. I just want to say one thing. While it's looking good and it's looking solid in terms of the handover from Wall Street, and, I've made this point last 2 days now that, once Trump is in the saddle in the White House, he's going to be bound by office, and he probably will not do all the things he said he will. Some form of it, maybe, but at a lower level. Although people like Jahangir Aziz, who was with us yesterday, disagrees. He says we should take Trump literally. Although he said, well, I hope I'm wrong. But the point is, between now and just 2 days now, and actually 3, because Monday late night, of course, is going to be the swearing in, or in the evening or whatever. So Tuesday morning, you'll get the full reaction and executive orders, etc. But it's going to be volatile, and there will be, people will have doubts again. There'll be more statements which will be made. So it's going to be a volatile environment, at least for the next 3 days. So if that's your time frame, then chasing is not a good idea, and you're better off just sort of waiting on the sidelines. Individual stocks, of course, as we will continue to discuss, is a different story, and there is a lot happening there as well. Surabhi.
Absolutely, big headlines coming in, and it's very, very clear. It seems that even President Biden, as he goes out, he wants to leave a mark. He wants to be remembered. And I think maybe the fact that this ceasefire deal finally has come through, perhaps there was some added pressure to do it before. In fact, the first phase starts rolling in on the 19th itself, his last day in office, which is when aid, rolls back into Gaza after 14 to 15 very, very difficult months. Anyway, to talk about markets over here, yesterday's Wall Street party was based on 2 key pivots. One was the softer than expected inflation report that came in, and the second was blowout bank earnings. On inflation, we've kind of mentioned that point. The CPI number was 2.9%. The market latched on to the fact that core CPI actually fell a little bit more than anticipated. It was 3.2%, and it was a little lower than expectations. So that really worked very well. And then we had the reaction play out in yields, in equities, in the dollar, so on and so forth. The dollar index, by the way, is now at just about 109, just a notch above 109. Imagine, just a couple of days back, it was roaring above 110. So big cool off over there. On the bank earnings, we've got massive reactions. I mean, look at how stocks have moved. Wells Fargo, Citi, and Goldman Sachs rallied 6 to 7% on pretty solid, earnings prints coming through for all of them. JP Morgan was up 2%. JP Morgan's profit has soared 50% in the December quarter, and all of their engines have been firing, whether it's bond trading, equities, whether it's investment banking is up, I think, 45% or so. It's been a fantastic December for the large US banks. In fact, more of them would report today. Morgan Stanley and Bank of America are the ones that report numbers today, so we'll watch out for that. In addition, Scott Bessent is supposed to speak before the Senate Committee on Finance, and the markets, as usual, will hold on to every single word to understand any cues on tariffs, what they're thinking. Remember, he said there is the IRS internally, and there should be the external revenue service as well. So you collect more money in the form of tariffs. So let's see what we get from the man who is supposed to take over as Treasury Secretary in the new administration. Moving on to Asia, markets are really latching on to all this positivity from Wall Street. So there's a broad sea of red, gains anywhere between 1% to 1.5%. Quick data points. In South Korea, there's a bit of a surprise. The central bank was supposed to cut rates by 25 basis points, considering how growth has been, faltering. But they didn't do that today. So no rate cuts in South Korea this morning. In Japan, inflation continues to be a concerning point. Producer prices are up 3.8% in December. And remember, this is the other watch point for global markets, whether the Bank of Japan will go back on its hiking path. It's been on pause, trying to understand what's happening with the Fed in the US election. So that's a cue for the BOJ when it meets later. We've discussed, of course, the ceasefire. That has had its impact on the oil markets as well. Oil had a massive upbid yesterday because of the drawdown in U.S. crude stocks. U.S. crude inventories are at the lowest level since 2022. But then the ceasefire news came in and very quickly crude cooled off. It touched 82, that's Brent, and then cooled from that level. So that's good news for us, at least from the oil markets, considering that there's a bit of a, unwind of that long trade. For the Nifty, the challenge is, can the market go beyond sell the rally? Yesterday was all about sell the rally, at least at an index level. Let's see if that changes today, now that we have far more supportive global cues. What's not supportive, obviously, is the FPI flow situation. Again, we had a sell figure yesterday, about 4,500 crores worth of cash market equity sales from FPIs yesterday. Domestic buying didn't exactly sort of negate the entire amount of it, but for what it's worth, we managed some green on the screen. It's going to be a lot about individual stocks. Remember, earnings season is in full gear. You'll hear more about, L&T Technology Services. Decent numbers and very fantastic performance on margins, sounding good in terms of deal pipeline as well. HDFC Life's numbers are very good. Remember, they've dealt with so many regulatory changes in terms of the surrender value and so many other sort of changes that have happened. But they've managed a very smart increase in VNB margin. We'll talk about this. CAT's numbers are not that great. A big fall in margins, nothing great on the top line to report as well. So watch out for these stocks. Today's biggies. Reliance Industries, Infosys, there's Axis Bank, and there's LTI Mindtree. So plenty to keep us busy. And let's see if the markets get a bit of a leg up, because on Reliance, I think there's a lot of hope building that something better is coming in the next few quarters. So let's see if we get some hint of that in these big earnings today.
Well, that's right. And overnight we had the CBOE volatility index that cooled off 13%. And that's normally music to the ears of bulls. Well, let's take a look at the top 3 indicators as we normally do. Well, 2 out of the 3 actually moved in our favor. That's the 10-year yields. Well, they cooled off, and the dollar index as well cooled off. Brent crude prices, as you all mentioned, that's perked up a little bit because of the sharper than expected draw in the United States, as well as the sanctions on Russia that could limit supply. So that's why, in fact, that's not moved in favor. But the other 2 out of 3 have moved in favor. Now, you're moving to what the FIs did in yesterday's trading session. Very, very measly shorts got covered out. The longs got added as well, but they continue to remain net short on the index. And if you look at the positioning as of now, the clients, well, they are net long on the index. The FIs, they are net short on the index. But on the stock futures, both of them, they are on the same page. So both of them, they continue to remain net long on stock futures, while on index futures, as I mentioned, both of them on extreme ends. The point is that big short covering bounce is still due, because we haven't yet seen it, going by the number of contracts they have on the short side. So you like the market to trend up a little bit and then, in fact, get the short squeezed out of the system. It's a big day of earnings, actually. You'll have 18% of the Nifty that will be reporting its numbers later today. Most of them will be post-market as, but that's going to be a big queue. And stocks like Reliance Industries have already underperformed. So is the risk on the upside? Could we get a positive surprise out there? Infosys as well, up close to 0.5% in trade yesterday. This big boy can drive the IT index, while Axis Bank went soft into its number. So there is bad news. How much of it is in the price? We'll have to keep an eye on all these 3 names. But the options data suggests that the bulls, well, they are a little bit skeptical, but the bears, well, they are getting very confident. 23,200 call, 23,250 call. Both of them were very, very active in yesterday's trading session. In fact, between both of them, a crore shares were added. That's telling you that the crucial resistance mark come out here. 23,350, the bulls will like to get to this particular level, and support level, the recent reference of around 23,000 odd. Very, very crucial factor. Remember, today is the weekly expiry. So the bulls need to take the bails out. Well, today could be that day. It's as good a day as any to see a big short covering bounce play out. The Nifty Bank, well, we'll be mentioning this, that it was making lower highs. Yesterday, it made a wee bit of a higher high. So this is the level you'll want the Nifty Bank to cross in today's trade. The indices that I'll be looking at, since the dollar index has cooled off a little bit, tech as well as the metal index, we'll keep an eye on both those 2. And a few stocks have moved into the F&O band. We've seen sometimes these stocks move quite violently. So we'll keep an eye out on all these names. Kalyan Jewellers as well, massive open interest build up. Keep an eye out on all these 3 names for trade today.
Okay, all right, got that. Thanks very much, Nigel, for all of the cues. Of course, we are going to keep an eye on all of those individual stocks and the market levels as well. But for the time being, let's actually address the big, global headline that goes even beyond markets. After 15 months of fighting and tens of thousands of people being killed, U.S. President Joe Biden finally announced that there is indeed a ceasefire and hostage deal between Hamas and Israel. He also reiterated that both his administration as well as the incoming Trump administration had been speaking as one team while working on the agreement and the negotiations. Take a look.
Long last, I can announce a ceasefire and a hostage deal has been reached between Israel and Hamas. I'd also note this deal was developed and negotiated under my administration, but its terms will be implemented, for the most part, by the next administration. In these past few days, we've been speaking as one team. This has been time of real turmoil in the Middle East. But as I prepare to leave office, our friends are strong, our enemies are weak, and there's a genuine opportunities for a new future.
Well, that is, President Joe Biden making the announcement. But I think the question on everyone's mind is how much of this is, of course, Trump, that he takes over in 3 days. And how much is it Biden? Because, Biden, it's been Biden as president for the last 4 years. And it's only now, 3 days before Trump takes over, that there is a ceasefire announcement. William Lee is chief economist and executive director at the Milken Institute. He's joining us now. William, great to have you with us here. I don't know if you agree with that. I think so, and I think maybe, two conflicts, right? One done and one more to go. That's Russia, Ukraine. And that's the big thing for many, that at least with Trump, he'll sort of get some of these conflicts under control. Do you think that's the way to look at this?
That's a great perspective. And in fact, I'm glad you mentioned that there's a lot of things that are happening right now that are in anticipation of President Trump taking office. We see that the global leaders have been reacting much differently than they have throughout the Biden administration. When President Trump comes around and really operates according to his manual, which is the art of the deal, everyone knows they better start getting their act together and prepare for his negotiating ploys. And what we learned in that book, The Art of the Deal, was that his negotiating ploys that start out with strong, outrageous statements and then eventually come through a more reasonable resolution. But those outrageous statements, like, if you don't behave now, you're going to really learn to behave once you get into office. Those kind of threats, people know that President Trump is crazy enough to actually carry them out. So they are really acting in a way that they didn't for the last 3.5 years.
And by the way, William, he said that I'm going to, of course, maybe a little bit of bluster, but I'm going to solve the Russia-Ukraine conflict even before I take office. So it's very clearly laid out as a big priority, right, to end that conflict as well. Do you think we're going to see activity, action? I mean, I was reading that, in President Putin in Russia, there's some kind of summit which is being arranged. He's agreed to it. You think that'll be the next one on the list?
It might be, but I think Russia right now and the whole Ukraine fiasco is tied up in some global politics that involve the financing of that war through China and many other of the new axis of nations that have lined together against the United States. So I think to unravel that situation might be just as difficult as the Middle East. I think what we found is that in the Middle East, the negotiations have been in place for quite some time now. We had the Abraham Accords that were an initial blueprint of what President Trump wanted to do. And I think people realized that the Middle East is such a high priority for President Trump that people started to get their act together sooner. In the Ukraine-Russia war, I think there the plan is less clear, and because the actors are so much more intricately tied together in ways that are really not quite visible right now, I think that's going to take a while to unravel. But surely the funding that the Ukraine has been receiving, the carte blanche kind of funding that they have been accustomed to, is certainly something that President Trump said he's going to change.
Okay. William, hi, great to have you on the show. Now, on the markets, I think what everyone's trying to understand is whether this Trump incoming tantrum that we've seen with the US yields as well as the dollar index, this massive fear about tariffs, etc., and absolutely unchecked spending, which is what's driving up yields, of course. But a lot of that fear psychosis, whether that's over and done, or whether you wouldn't really take it off the table entirely. I mean, what I'm asking is that what do you see ahead in terms of both yields and the dollar, given the expectations from policy?
I've talked to a lot of global investors, certain in the days after the election, and the main question on every international investor's mind is: are we going to have a repeat of the 1930s? Will the tariff situation be put in place that'll replicate the 1930s Smoot-Hawley tariffs, where it really crunched world trade to the point where the global economy went into depression? And I have to say, absolutely not. The situation now is completely different. The man who is wielding that tariff policy tool has very different intentions. I tell everyone, remember why President Trump was elected. It's the Make America Great agenda, right? Maximize the income of Americans, maximize the number of jobs for Americans, and to try to secure our supply chains in a way that doesn't expose us to a lot of global politics and weaknesses and vulnerabilities that we saw after COVID. Those are the principles behind the tariff. And so, as I said before, the art of the deal tells you that his initial round is that he's going to be and he's going to make it very credible to say that I love tariffs. I think tariffs are things that that allow the United States to do two things. One is industrial policy to try to subsidize the industries that we think are important, and also tax the importers who want to have access into the U.S. market. Now, it could well be that some of that tax will fall on American consumers, but that depends on the product. If the foreign exporter wants to have a market share, they will absorb a good chunk of the cost of that tariff. So using a tariff is really a way for President Trump to accomplish what President Biden has done through direct subsidies like the CHIPS Act, and to try to coalesce a new form of trading. We're going to see, I believe, globalization shift from where you have concentrations of production, like in China, into regional trade patterns, where we'll have distributed production in very many different places, India being one of them.
All right, William, final question before we let you go. You're clearly indicating that you believe Trump will walk the talk. So you will have to wait by for that. Give and take everything. You know, if he's going to be focusing a lot on the US economy, what happens to an economy like India? From a market perspective, how do you approach India? We have earnings, stable government out here. But, you know, there has been some kind of nervousness with regard to Indian markets. Trump will be good for India?
I think Trump will be good for the whole world, including India. What we're going to find is that the arrangements for the treaties will be no longer this large multilateral treaty that everyone has to fit into, but a lot of bilateral deals. Bilateral deals done by nations and also bilateral by sector, possibly even bilateral by company. Indian companies and Indian sectors will have a chance to negotiate the terms of trade and free trade agreements with the United States. I think that flexibility and speed of action, because bilateral deals are much easier than multilateral deals, we'll find that is the form of new trade foreign policy that will benefit the rest of the world, and especially India, as India starts to gear up its tech sector and gear up to become a massive world producer.
All right, William, it's a great conversation, and I hope the first of many with you on CNBC TV18. Thank you very much for joining us, and appreciate your time here on CNBC. Well, we'll take a quick commercial break here, but just a quick tease out of what's lined up here. 8:30, Deepan Mehta will exit equities. We'll talk stocks, and there's a fair bit to discuss. 9 o'clock, you'll hear from the management of the recently listed Transrail Lighting. Third quarter earnings, Manish Gunwani of Bandhan AMC will be our market watch of the day. That's 9:15. 9:30, you'll hear from the management of Minda Corporation. They've done an acquisition. Following that, you'll have Amit Chadha of L&T Technology Services. A quick chat in the third quarter numbers. 9:50, you'll hear from the analyst at HDFC Securities. Cement is in focus. We'll get you the preview for the third quarter. 10:15, Lata takes over. And as the economy, we're going to talk about the cool-off expected in Indian and US inflation, the future course of the dollar, rates, rupee. Neeraj Gambhir of Axis and Mitul Koteja of Barclays help her do that. Stay tuned.
All right, time to slip into a short break. We've got a lot of stock-specific action to track for you in our special Top 10 segment. Here's the list. HDFC Life, L&T Tech Services, Minda Corp, Transrail Lighting, Azad Engineering. All of them will be reacting to positive news flow. Out of the list, RVNL, GAIL, Hitachi Energy. On the negative side, you have Oracle as well as CEAT that will be reacting to their results. Slip into that break, come back. We'll get into further detail on all of these names.
Well, we've been telling you that the news across global markets is really positive. There's nothing to complain about because markets are cheering the fact that the the consumer inflation print has not gone in the opposite direction. It's been good and markets are up and about. So let's talk about individual stocks because there's plenty of stock-specific action as well. We have our team standing by with the CNBC-TV18 list of stocks to watch. Let's start looking at some of the major earnings that came in. Yash, HDFC Life actually looking pretty good, right? Considering the regulatory concerns that we kept hearing of in the quarter.
Well, certainly, Surabhi, a lot of negative sentiment was around the company and the numbers, but the numbers are surprisingly good, except for new business premium. There was a beat on all parameters. For new business premium also, it was a decent growth on a year-on-year basis at 11%, which came in at about 7,899 crore rupees. Total AP was a beat as against our poll. It was up 12% at 3,569 crore. Retail AP, again a beat against our poll. It was up 12% at 3,122 crore rupees. Value of new business also was a beat, up 9% at about 930 crore rupees. And the most surprising part was on the margin front, where the compression was expected to be a lot larger than what came through. The margin compressed just by about 74 basis points, came in at 26.06% versus 26.8%.
Okay, all right. Got that, Yash. That's HDFC Life. Let's watch for it, see if it gets a positive pop or not. Let's come to the IT names then. Rima, morning. L&T Tech and Oracle Finance. How does it look?
Well, so for L&T Technology, it's an in-line performance at the operating level. The company's reported a revenue growth of about 3% in constant currency terms. Margins have expanded by 80 basis points to 15.9%, and this is despite absorbing a wage hike impact. Margins X of the M&A, one-time M&A charges, is actually 16.2%. Now, the FY25 guidance was earlier 8 to 10%. Now, the company made an acquisition, IntelliSwift, and the company said this acquisition will now contribute 2%. So now the guidance stands at 10%, but including the acquisition. So the organic growth guidance is actually 8%, at the lower end of the company's guided band of 8 to 10%. So some analysts are disappointed, but I would suspect that, this is something that the street was expecting. That was difficult for the company to achieve the middle or the upper end, and 8% is perhaps what's already in the price. The stock is down 9% in the last 1 year, and also in the current quarter, the company reported the highest ever large deal wins. Now, Oracle Financial Services has had a slow quarter. Revenue growth of 2.5% quarter on quarter. On a year-on-year basis, revenue growth is down 6%. If you remember, it was exactly 1 year back when Oracle Financial Services had that bumper quarter. Revenue growth was close to about 25%, and the company, and since then, the stock was a big outperformer. In the last 1 year, it's rallied more than 100%. Margins too have contracted in the current quarter, and EBITDA margins are down to 41.6%. Back to you.
Okay, all right. Thanks for that, Rima. In fact, we'll have the management of L&T Tech Services that will be joining in at 9:40 a.m. later today. Let's talk about Transrail Lighting, the newly listed company. Vivek joins us to help us out with a quick analysis on their numbers. Vivek?
Well, good morning. That's right. Important to keep in mind, it's Q2 results, so it's the end of the September quarter that the company has declared results for because it's a recent listing. It's been a steady Q2 for the company. Revenues higher by close to 11.5% on a year-on-year basis. EBITDA up quite almost 16.5%. Margins very strong, especially for an EPC company, 12.9% versus 12.5% on a year-on-year basis, and profitability higher by 20% on a year-on-year basis. The order book strong, 10,358 crore versus Q1 end order book at close to 10,200 crore. Order intake, till September 30th, 2024 has been close to 2,248 crore. And interestingly, the company has done a preferential issue of 10.3 lakh shares at 484 rupees a share. Along with that, they've also approved a capex plan of close to 326 crore, for which the company will be taking on additional debt. Management will join us shortly, so it'll be interesting to see how Q3 was, order book, order inflow, as well as the reason for taking up further debt immediately after an IPO as well.
All right, no, absolutely. 9 o'clock, you'll hear from the management, Mr. Randeep Narag at Transrail Lighting on that second quarter performance and, more importantly, outlook for the second half. Well, CEAT and Minda Corp are the other two. From the auto space we want to talk about. Hormuz is here with details. Hormuz, morning.
Morning, Prashant. And talk about CEAT first. There's nothing to write home about quarter for the company. It's an 11% revenue growth, but the EBITDA was down almost 20%. Margins too saw some bit of contraction of almost 400 basis points from last year. The profit nearly halved from the same quarter on a year-on-year basis. So the management also said that it was because of this high raw material costs that the margins were impacted. They expect them to remain flattish in the fourth quarter, but the demand, according to the management, remains stable, is what they're saying, with a robust order pipeline. Now, they've also announced a 400 crore rupee capex to expand capacity at its Nagpur unit, which will expand capacity by around 30%. They'll fund this by debt and internal accruals, but the numbers are looking weak and expect the stock to open in the red. For Minda Corp, the announcement of the acquisition that they made yesterday, that gave a boost to the stock in yesterday's trading session. They held an analyst call as well, where they've mentioned that the combined entity will grow by 10 to 12% in overall size, and they're adding powertrain electronics as a new vertical of growth for the company, and they intend to capture this growing market which is in this ICE and the EV market. What they also said is that flash electronics, which they've acquired, has grown from 800 crore to 1500 crores, and they're expecting that number to go higher as well. So the premiumization of products also will increase their overall kit value between 40 to 45,000 rupees per kit. So expect the stock to boost from yesterday's gains as well. Expect that to open in the green.
Okay, Hormaz, we'll watch out for Minda Corp, and we'll, of course, be chatting with the management of the company as well. We'll get some more details on this acquisition, the rationale and the expected numbers. Akash Minda is going to be joining us at 9:30 a.m. Let's move on now. We've got Vamakshi joining in with a bunch of other stocks that are in news today. Vamakshi, morning.
Well, good morning, Surbhi. Let me first start off with Azad Engineering. The company has bagged contracts worth almost $112 million, which is approximately 960 crores from GE Vernova International LLC. The contract is for supply of highly engineered complex rotating and stationary airfoils for advanced gas turbine engines, and this contract is to be executed over the next 6 years, so going with the green for this counter. RVNL is another counter that will be in focus. An RVNL-led consortium has bagged orders worth 3,622 crores from BSNL. This is for development of middle mile network of BharatNet on DBOM, that is design, build, operate and maintain model. So therefore bodes well for the company, and going with the green for this counter. GAIL is also expected to open higher today, and that is because they've entered into a settlement agreement with SEFE Marketing and Trading. The company is going to pay GAIL $85 million, or somewhere around 2,463 crores approximately. In fact, the company will also withdraw arbitration proceedings before the London Court of International Arbitration, so bodes well for GAIL as well. And lastly, keep an eye out on Hitachi Energy. The stock is expected to open higher, given that a board meeting is scheduled on Jan 18 to consider fundraising via various routes.
Okay, thanks for that, Vamakshi. Let's do a quick recap of all the stocks we just covered. The ones with positive news flow: HDFC Life, L&T Tech Services, Minda Corp, Transrail Lighting, Azad Engineering, RVNL, GAIL as well as Hitachi. While stocks with negative news flow include Oracle as well as CEAT. Slip into that short break, come back, we'll get into further analysis on all of these names. Deepan Mehta of Elixir Equities is waiting for us. Welcome back. Hope you're having a good morning. As promised, let's get in Deepan Mehta of Elixir Equities to help us out with some fundamental stock analysis. Hi Deepan, good morning. Good to see you win. HDFC Life, that's the first one that's going to be reacting to its numbers. Nifty stock, a big underperformer, but it seems the numbers had a positive surprise. Your take on the stock at around the 600 rupee mark?
Yeah, good morning, Nigel, and thank you for having me on your show. I think decent set of numbers and valuations also have come off. I think it's coming at around 2.4 times embedded value. I remember the stock was trading at 4-5 times earlier. And a steady set of numbers, I would say. All the parameters are decent. I read somewhere 18% at a 16% return on the embedded value. So from all parameters, I think the company's performance has been good. And in markets like this, when you're looking for safe counters, safe sectors to invest in, I think life insurance certainly fits that criteria. So I would expect investors to get overweight HDFC Life. And I think it's a good number and stock may react positively, but one can't really say in the short term.
Okay, that's HDFC Life. Let's see how that plays out. Deepan, I want to also talk about some of the other numbers that came through yesterday. L&T Tech, that's what Rima was saying, that there could be some argument on the top line growth because that 10% I think is including an acquisition. But they've done fairly well on the margins. How do you look at it today? There's LTI Mindtree, there's also, of course, Infosys. So give us your idea on some of these smaller companies and then maybe a quick take on Infi itself, if you're interested in this one.
No, Surbhi, I think software, you have to be extremely selective. And I was really surprised. And when you meet the LTTS management on your show, you can please ask them that how can they classify a 3.1% sequential growth as strong? I mean, by no measure is it a strong quarter. It's a flattish quarter at best. And, has the bar for the industry and the sector been reduced where, even if you get a high single digit type of a growth rate on top line, you consider it to be a good quarter? I don't think so. As an investor, we want our companies, investee companies to grow at least at 15-17% top line. Otherwise, how are they going to give decent returns? And that's what's happening in the software sector, that they're stuck in that low single-digit type of growth rate, a few acquisitions here and there to get them to double-digit growth rate. That's just not acceptable, at least not at these valuations, and not considering that the kind of potential which is there to still export from India. So I'm very disappointed with LTTS, disappointed with all the numbers which have come through from the software industry, be it HCL Tech, be it TCS. No great expectation from Infi as well. But it's a sector which is a safe sector. And, in markets like this, where you may see further slowdown in earnings on domestic focused companies, this is one sector which may have, at least stability in earnings or slight improvement. So that's how I look at the software industry. Looking forward to good numbers from a few select companies only.
So take your point, since you're saying, your concern and that passionate call out on the top line is well taken, Deepan, because we've come to a new normal where 5-6% is supposed to be great growth. But given what you said, we have to look at it in the market context, and these are cash-rich companies, and there's also the rupee tailwind. Given the other factors, would you buy anything, any names in IT?
See, I'm waiting for results from 4 other companies. I thought Oracle was a bit disappointing, but Persistent, I think KPIT, Newgen Technologies, I think, and these are the 3 companies which I think may be interesting, may outperform and may report very good numbers. You could add Coforge to that list as well. I think these are the 4 outperforming companies, and I want to see their results before I make a more optimistic call on them. These companies have consistently grown above that kind of a double-digit growth rate. They're in that 15 to 17, 18% type of growth rate, purely because of their domain expertise or extraordinary marketing. But let's see whether we are seeing a slowdown over there, and maybe thereafter take a call on these companies. But by and large, the software industry results so far have been disappointing. You could have a few surprises from a few other mid-cap software companies, but let's just wait and watch.
Deepan, I'm not sure you'll have very much to say about this. Good morning. But you must have seen, right, news about Hindenburg, how the short seller group is winding down. And there's a letter from the founder, etc. Of course, here in India, Hindenburg is well known because of the reports around the Adani group. Any thoughts on this, around this?
Prashant, what can I say? I think maybe
that's why I said I don't know if you'll have very much to say.
Maybe it's a failed business model which is causing them to wind up like this. But well, I think to an extent it will remove overhang on Adani Group stocks. But they have their other challenges as well. in markets like this. So, I mean, I don't think it's going to make much of a difference. Maybe sentimentally, it may improve I would say for the Adani Group stocks, maybe it's a sentimental improvement. But look, end of the day, fundamentals do matter. And let's see what numbers these companies have to report.
No, got that. The other one is Kalyan Jewelers, Deepan. It's fallen sharply, right? I mean, high was about over 700, close to 800. Now about, I think, 550 or so yesterday. Any thoughts on this one? Of course, at the highs, I remember pointing out that it used to trade at the high point. I remember at about 120 times 1 year forward earnings. So valuations were just completely whacked out. But now, of course, it's fallen. Any thoughts here?
Prashant, I think there are a lot of controversy surrounding Kalyan Jewellers, and I'm sure they will settle down. And management has clarified, and we can expect more transparency from them as well. But look, amongst all the companies in the jewelry space, if you look at the pre-quarter release, I think Kalyan Jewellers had amongst the best pre-quarter release. After many years, we have seen Kalyan Jewellers top line and other financial parameters better than Titan as well. And I think they have a good runway for growth, considering that a lot of consumers are shifting from unorganized to organized sector. I'm positive on the company per se. Hopefully, no more controversies arise. And valuations also are reasonable compared to the peer group if you compare with Titan as well. So I think that further correction and the numbers are good and the PE compresses from these levels, it may make a good entry point. Actually, there are very few sectors which are still showing decent growth. And the jewelry sector is certainly one of them. So one should have a focus on it.
Okay, very quickly, Deepan, I wanted to ask you about Paytm. Towards the end of trade, one stock that moved on very strong volumes and saw a bit of a bounce back after pulling back 20% was Paytm. MK has come up with the note and they've upgraded the stock. Your view on it at around 860 rupees?
I think it's pretty well priced, and you could see some pre-quarter result buying taking place in Paytm and some of the other platform companies as well. I think that it's a company which is still trying to, find its right footing and right strategy to get back into black in a solid way. At some point, they will reach over there. But in the meantime, I think investors are forecasting a very bright future and valuing it very much into the next, few years or so. It's not an immediate kind of expectation that numbers will come through. It's more into the future.
There's a perfect bull and bear on Paytm because I was looking at the UBS note. UBS came out with a note earlier. They said that this NPCI data is telling us they're not gaining market share at all. So UBS was quite neutral. But now MK is saying that this opens up a big runway. Maybe they can get more customers and therefore they have this target. MK's target on Paytm, just for the record, is 1,050. UBS is at 1,000. That's Paytm. We'll in fact have more on this stock as we go along. Deepan, stay on. We want to talk to you about the auto space as well. But first, let's listen into some management commentary that we've gotten. Hero Moto is targeting double-digit revenue growth in the current financial year as rural demand recovers. The CEO of the company, Niranjan Gupta, says that they are focusing on the premium segment to address the fall in market share. Take a look.
We've been guiding that that double-digit revenue growth is what the industry looks like. And we would stay with that. We would refrain from any volume guidance. And moving forward for the next fiscal as well, we do see industry growing double-digit in revenue. Rural coming back. And I think many companies have talked about this as well. We were expecting this in any case because we do know that post-COVID, rural had slowed down for obvious reasons. Now with the government capex investments, with right monsoon, crop cycle, little lift up in the employment and the informal sector like tourism, travel, things are coming back on rural. Urban may seem to be slowing down, but then urban had a great period post-COVID. If you look at, first of all, the market shares have already started recovering back, as I just talked about. Our losses had been more due to segmental mix because the mix went more in favor of premium where we were not present. So the entry actually shrunk post-COVID, and which is where we are the lead players, and the growth was happening in premium. So it's more a segmental mix impact that we've had, and which is what we are correcting by being stronger in premium. FY26, we should be looking at crossing maybe 500 cities and 1,000 outlets. That's what our aim would be, to make it available across the board by the end of fiscal year 26. And that's getting helped by our upgrade of our stores, because we're upgrading Hero stores to Hero 2.0, which is where we have said that we'll put our EV. Majority of our capex or investments will continue to be behind premium and EV moving forward as the growth engines. Glad to announce that in the first 9 months of this fiscal, our exports have grown by 40%, much higher than industry. Some of the actions that we have taken have started giving dividends to us, whether it is the customized product in the countries, whether it is opening up Mexico, the efforts in Colombia that we put in, the Bangladesh coming back, or a distributor change in Nepal. Plus, we have announced that we will enter Brazil, and we have commenced operation in Philippines, which is just going to be a gateway to Southeast Asia. So absolutely big focus on lifting up global business.
All right, Dipan, I don't know how much you like two-wheelers and whether or not you enjoyed riding a bike, but what's your view on two-wheelers? You heard what Hero MotoCorp management had to say. What's your pick from there?
Nigel, you asked me this question many times, and we have a common connect over here, that you like riding bullet bikes, and I like buying Eicher stock. I think after many years, we have seen very good numbers coming through from Eicher, and seems to be firing on all cylinders. Very pleased with export growth as well. And stock again has created a new high. So I remain quite optimistic on Eicher. Disclosure, we and our clients are invested in it. And I think that this is one company which will outperform the two-wheeler space. But auto also is getting into a slow kind of a zone over there. So one needs to be a bit careful. And, one kind of discounting which is taking place, and overall urban and rural slowdown, I think that needs to be monitored. Also, I think they're working with a very high base as well. So you may have a few softer quarters, could be a cyclical downswing, but I don't think the outperformance in the auto sector will last at least for the next 2-3 quarters or so.
I just have one request. As a shareholder, you definitely think differently. For me, Dipan, I want them to come up with a bigger bike. I'll be one of the first buyers. I ride the 650. I've ridden the 350, the 500. I hope something bigger than 650 comes. I'm definitely going to buy that one.
They will listen to you, Nigel.
I hope so.
Okay, all right. But by the way, before we take the break, Dipan, very quickly, since we're on the subject of autos, Maruti, I've definitely been noticing that stock. While the market is worrying about Trump and tariff and oil prices and yields and all that, look at Maruti this year, 2025. The best performing stock on the Nifty, already up 11-12%. I don't know what the market's smelling or beginning to price in, whether there's excitement on the upcoming launches, something else. But your thoughts?
I think very impressive numbers for December. The sales and volume numbers are very good, and that's rekindled the interest in Maruti. Key thing which we watched over here, whether it is sustainable. So, if it's a trend that, are they going to a higher growth phase? Is the kind of small car which was a laggard for them, has something changed over there? Structurally, has it started to pick up again? I think these are questions will get answered in 2 or 3 months or so. And then you could perhaps review the stock. But you're right, I think it's turning out to be a big outperformer. And I think we should expect good numbers from December quarter from Maruti.
All right, Dipan, now take a quick break on that note. We'll come back on the other side. We'll, of course, have our technical experts join in the conversation, Mitesh as well as Sudarshan, with a couple of trading ideas. Back in just a moment.
Welcome back. You're tuned in to Bazaar Morning Call. As promised, our technical experts join us on the show. Good morning, Mitesh and Sudarshan. Well, Mitesh, you go first. Today's session has the makings of a good one, at least to start off with. Do you think it's going to be a really strong trading session today? And if yes, what are the levels you're looking at? Mitesh, we'd like to hear you, so please unmute yourself.
Apologies for that. The start will be quite positive given the fact that the GIFT Nifty is clearly showing a 120-30 point kind of gap up. Also is the fact that with this gap up, we'll open right around this 23, 330, 350 zone. So maybe, if you haven't been carrying long positions and we also haven't been carrying long positions, then I think the way to approach is see if the level of 23, 350 is being taken out. Else you'll get some mild dip in the first 30, 40 minutes and that will be a time to enter. I believe that the way the indicators are moving up, just shaping up, you might have made a temporary low, not a proper low, but a temporary bottom, and therefore next few days could be slightly biased on the upside, unless until we repeatedly fail around 23, 350 marks. So trading with a long bias to begin the day with, but I would want actually the Nifty to see to show a lot of strength once we approach this level of 23, 350 and then capture it. Then I think it will be much more easier to trade on the long side.
Okay, Sudarshan, let's come to your index calls. Good morning, gentlemen, both of you. Sudarshan, trades on the index first.
Yeah, good morning. See, for the last 2 days, I've been saying we should be buyer on dips for intraday trading. So the sense was that the markets are finding a support level. The resistance are immaterial because the key point is the market should not fall. Then the market builds a base, moves sideways, goes up as it could do now. So with 23,100 as our support and our make or break level, we should go long. There's no need to go long right at the morning in a gap up. The markets will cool. They will sort of subside from the morning euphoria. So go long at some point in the morning and stay long with a stop at 23,100.
Okay, all right. Got that. Sudarshan, tell us your picks as well.
Well, it's an all-buy list, starting with NTPC, where a buying opportunity exists with a stop under 315. Indus Towers, which has gone through a deep and sharp correction and may be ready for a rebound, a stop under 340, and it's a buy. Hindalco is a buy with a stop under 580. And finally, BSE, that stock exchange. The BSE itself is a buying opportunity, the share, with a stop under 56.65. I don't think you should look to go short today.
Okay. Mitesh, your picks?
So I have BSE on my buy list as well. Keep a stop at 5,700, look for a first target of 6,000. That apart, a buy on Aeroflex Industries. The stock has gone through many months of correction. Now is showing first signs of a reversal or a rebound. So buy with a stop bid of 421, look for targets of 450. TCS remains a buy. That's one of the strongest tech stocks in the short term. So buy here with a stop at 4207 or yesterday's low. And 4350 could be your target area. And the final buy call is AU Bank, which I would recommend buying with a stop at 577 for a first target of 605.
Okay, all right. Gentlemen, thanks for the calls. We'll come back to you a little closer to market opening. Right now, a quick break. We'll be back. We'll have the pre-opening race. And then, of course, it's earnings season. We come back with the management of Transrail Lighting to figure out how the second quarter is and what the outlook is for the rest of the year. Welcome back. So in the next couple of minutes, we'll have the pre-open rates trickle in. We'll have the rupee as well. Remember, the rupee had a nice pullback and a recovery yesterday. And after market hours, we got more announcements from the Reserve Bank of India. It seems that the RBI will resume the variable rate repo auctions, the VRRR auctions as well, starting this Thursday. So why is this happening and how is the market going to interpret this? Let's ask the expert. We have Lata with us in the studios. Lata, tell us more.
Well, this is a repo. A repo is how the central bank gives money to the market. What they have announced is they will start a daily repo. You call it variable rate because the money is auctioned and people can take it at the rate at which it's auctioned. Why that is important is this had been stopped. It was part of the inflation targeting framework. It was stopped by Urjit Patel, but it was formalized by Shaktikanta Das that we will give money only with a 14-day. You do a repo daily, but banks have to take it for 14 days. So they have to estimate how much will be their liquidity deficit for 14 days. And it is a daily thing, but it is a 14-day cycle. Now what our Reserve Bank, it's gone back to the status quo ante and said, we will give every day. The reason for stopping it was RBI didn't want to be the treasury manager of the banks. You can do whatever you like, spend anything, and I'll come and give you every day whatever money you want. They didn't want that. They wanted banks to plan their, liquidity pluses and minuses. But for whatever reason, now it's not working. The banks never got used to the 14-day idea. So RBI started giving 5-day, variable rate repo, 7-day. But market was wanting that one, daily repo. It's just a steroid that you like because you're not able to estimate liquidity. And now Reserve Bank has agreed to do what it had resisted for at least 5-6 years to help the banks evolve and make their own decisions, make their own judgments. This is a very big relief. It's extremely positive for the market because if you don't know that whether your deficit is there or not, you will want deposits. So you will keep rates high. You will not lower deposit rates. In such a situation, a rate cut doesn't work. But when you have this standby that Reserve Bank is there to supply, if the rate is cut on February, it will be passed on. So the market is reading it as one of the steps towards also possibly a rate cut. Then there are others. FX swaps has also been announced. Not announced. It's done. This is how the Reserve Bank intervenes. They have to supply dollars. When you sell dollars, you're withdrawing liquidity. They immediately do a buy-sell. They did it on 2 occasions in the past 7 days, indicating that they're immediately giving back the liquidity. So all these actions are indicating that the Reserve Bank is very proactive in the supply of liquidity. And for what it is worth, it is coinciding with the governor and the deputy governor changing. So it looks like a new regime is in place. You must expect even banks to be very cheerful. Bank stocks to be cheerful today. The currency separately is going to do well for a couple of reasons. Yesterday, the Reserve Bank came with a bang and supported the rupee. 2 days, they allowed it to drift all the way to 86.60s, even beyond 86.60. And then yesterday, they came with a bang and it was, 86.36 by end of day. Today, people think that it can even be 86.25 given the, the way in which the dollar index has fallen rather sharply. So today, a lot of cheer in the fixed income market.
Okay, all right, got that. Lata, thank you very much. So let's see if bank stocks cheer the fact that there'll be some more liquidity now available and the hopes for a rate cut are only increasing. Let's go back to Deepa. And then, Deepa, actually, let me ask you this. We were asking a couple of experts even yesterday. Now, even if it's a near-term trade, and this is not, I'm not saying a portfolio investment, but if you want to play the rupee depreciation theme, assuming that maybe it will work at least for the next couple of weeks or maybe the next couple of quarters, what would you look at? You've already documented your views on IT. What about pharma or anything else which is more export-oriented?
Pharma, definitely. I think very positive trends coming from the pharma industry. The rupee depreciation certainly benefits them. And I think a little bit competitive intensity has reduced over there. There's the Biosecure Act as well. And new opportunities emerging in all these weight reduction or anti-obesity drugs into the medium-term future, like 26, 27 onwards or so. And I think companies are doing well in India market as well and other global markets as well. So very positive on pharma. Big opportunity in CDMO as well is appearing. So I think if you want to play the rupee depreciation, that's the best sector. It's a sector which is safe and one should be overweight on definitely.
Okay, all right, Dipan got that. Thank you very much for your inputs today. Appreciate you joining and have a great day. And we'll connect again soon. All right, it's just about 9 a.m. So the first of the rates will start trickling in. Let's wait for this to settle. Right now, the bulls are very excited. They're saying 200 points on the pop. But let's see how this exactly plays out. The Sensex is up about 1%. So is the Nifty for the time being. There's a broad sea of green. HDFC Life is popping 6% at the start. But like I said, let's wait for some of these rates to settle and we'll come back and revisit the pre-open. Going forward with some of the earnings reactions that we are getting in. Transrail Lighting is on the radar. The company reported strong revenue growth for the second quarter. Remember, the company just recently listed. These numbers are not third quarter, but second quarter numbers. We have Mr. Randeep Narang, MD and CEO of Transrail Lighting, joining in to take some questions. Mr. Narang, thanks for being with us. I'll just look at the broad numbers and we'll get them up on the screen for our viewers as well. You have managed to see about an 11.5% revenue growth. Margins are steady with an upward bias. Margins are now almost touching 13% and your profit is up almost 19 to 20% as well. But before we talk about the numbers, something that's baffling is that you've just done an IPO in which there was, I think, 400 crores came to the company. But yet you're doing a capex plan of 326 crores for which you will be taking on more debt. Why is that?
So, ma'am, that's firstly, thank you for having me over. So we are part of the IPO was to look at around 90 to 100 crores of capex, which was part of the plan. And with the current order book, we need a lot of tools and plans for us to look at execution of these. And this capex is a 3-year principal approval. It's not going to be spent immediately. And this is phase 1, what we had planned in the IPO. And phase 2 will happen subsequently after a year, year and a half. So there is no hurry for us to implement, but as a principle, a board approval is required to start work. And that's what has been done yesterday.
So can you just tell us that now this 326 crores, I think this is entirely debt. You had raised about 400 crores in the IPO. So give us a balance sheet update. What is the debt equity now? How much will you look at increasing your gearing? Just give us a sense on the capex and how you're funding
part
it.
Of it is this 326 is not a new capex. Part of it is already approved as part of the IPO. So that is already around 90 to 100 crores is already there, which is part of our pre-planning, which is already work in progress for our brownfield expansion of our current plants. Subsequently, we plan going forward to look at a new plan based on our current order book. And this will happen not in this financial year, it will happen in 26-27. So principally, we are not in a hurry to use capex right now. It's more of a principal approval from the board, which we're going to take forward in the subsequent 2 years.
What is the debt equity right now and how much can it go up?
Ma'am, the debt equity ratio currently is not going to go up dramatically. It's going to be at the current levels, because we are in no hurry to increase our debt and it's going to be in a phased manner.
So the number, please, if you could give the number.
Number, I'll have to check with my CFO and give that to you right now.
Okay.
All right. Yeah, so I mean, as he gives it to you, we'll get an update out there. But good to see you in, sir. Give us a few more details then. Could you tell us what is your updated order book? These numbers are as of Q2, but an updated order book as of now, point number 1. And what kind of order inflow are you looking at for FY25?
Okay. So the H1, we have got orders worth 2,200 odd crores with a L1 of 3,400. So this L1 of 3,400, we hope to fructify in the next 3 months. Other than that, we are further bidding for jobs in domestic and international. And this percentage of order intake should go up as we have planned. So we have 2,200 in the bag. Overall, our current order book today, what we are executing is 10,300 and with the 3,400 crores of L1.
Right. But 10,300 is as of Q2, right? Now we're already past Q3, we're in Q4. So could you give us an updated number? How much higher will it be?
So we are, as I said, we are bidding. We bid jobs worth around 30,000 crores
and
so far. Waiting
what
results.
is your 30,000 crores is what you bid for?
Yeah, in the last 4 months. And we are waiting results both for domestic, international, all our verticals.
And what is normally your strike rate?
A strike rate normally is 8 to 10%.
So around 3,000 crores odd is what of inflow we could further expect, right?
That could be an inference, yes.
And for the year, what kind of an inflow will we look at? 2,000 crores in the first half of the year, 2,200, I think so you said, and another 3,000 crores. So ballpark around 5,000 to 6,000 crores should be expected for FY25, or will it be higher?
So that's the trend. We've been clocking around 6,000 crores 2 years ago and 5,000 last year. So that's the trend we will maintain and better.
Sir, just talking about now margins and the contribution of your international business. I remember when we spoke to you just around the listing time, you had mentioned that the international business is the higher margin business for you. But I believe in the second quarter, execution has been really slow in the international business. Why is that? Do you expect to pick up? And if things remain like this, then is your margin at risk? Your margin right now is about 12.9% as of the second quarter. Just give us a full year trajectory as well for the margins.
So, ma'am, if you remember, last year we clocked 11.77% EBITDA. And we had given a guidance that we will be bettering this around 12%. So we are ahead of the curve a little bit. Now, predominantly Q2 in India and internationally, because of the rains, there is a slowdown, which we see every year. But definitely H2, we will catch up from the point of view of execution. And we will continue in the same trajectory as we have promised in our RHP.
Okay, so sir, can you leave us with a guidance? Full year revenue growth FY25, what kind of growth do you see? And full year margins, exit margins FY25, where do you see yourself?
The full year profile, as I mentioned, was that we will grow around 30% year on year. So that is what the guidance still is maintained. Last year was 4,100 odd crores. And this year we'll be continuing with the same guidance. And on a margin profile, as I mentioned, we are looking at 11.77 going to 12 odd %. And if we can better it, we'll try our best. And to answer your previous question on our debt equity, we are at 0.53%, which we are looking at maintaining that for this financial year.
Okay, all right. We'll leave it on that note. Thank you very much for joining in and giving us some perspective on the business. That's Transrail Lighting at the end of their second quarter, not the third, second quarter. Company has recently listed. Stocks doing well in the pre-open. It's up 6%. Let's look at the rest of the market, which is also doing really well, actually. About 0.7% higher on the Nifty. Mid-cap index is up about 1%, and the Bank Nifty is also in sync with the Nifty, with a gain of about 0.7%. And HDFC Life is the biggest winner on the index right now, 6% higher. And some of the Adani Group stocks are looking smart. Adani Enterprises and Ports up between 4 to 5%. Okay, let's quickly go back to our technical experts for some more calls. Sudarshan, so, final ideas, what would you go with today?
Well, I would go with BSE. Why BSE? With stop under 56.65.
And Mitesh?
I think Aarti Industries come on the list after a long time, could do well.
Okay, all right. Thanks a lot for that, Mitesh, as well as Sudarshan, for joining and giving us your 9:10 call. Let's hop across to Nimesh. He's here to tell us about a couple of telecom companies. All right, I think first we can hop across to Hormuz, who's here to fill us in with a couple of stocks he's tracking. Hormuz?
And Nigel, it's about the telecom companies where UBS has upgraded Indus Towers to a buy. They've raised their price target to 425. For Bharti, they remain neutral though. There they have raised their target to 1707. But for Vodafone Idea is the interesting one here. They've maintained their buy rating, but they've cut their target down to 13 rupees from 19 rupees earlier. And what they're saying for Vodafone Idea is that they're expecting mobile revenue to grow 2.8% on a sequential basis. And looking ahead, the key driver now is any potential relief that they get on the statutory dues, which is AGR or Spectrum, and which they believe is still likely. And if that happens, that will be a big boost for Vodafone Idea. And now that the fact that the stock is trading both at 11 times EV to EBITDA for both similar to Airtel and Jio, they believe that the risk reward is attractive for Vodafone Idea. Now for Indus Towers, they say that it remains well positioned to surprise on dividends, and this along with continued payments from Vodafone Idea should be able to increase their dividend payouts going forward as well. So positive commentary coming in on both Indus Towers and Vodafone Idea. For Bharti, they remain neutral.
Okay, all right, got it, Hormuz. Thanks very much for that update. Let's go and revisit that call that Elara has taken on Paytm. Remember, we were saying they are fairly bullish on the stock right now because of the way they are seeing the NPCI data. We have Abhishek with the details. Abhishek?
Well, MK has upgraded Paytm to buy from add. They have increased the target price to 1,050 from 750 that they had earlier. They say that the recent NPCI approval, which came in October 24, releases a major regulatory overhang on Paytm. So this should help, rebuild the MTU base over the next 12 to 18 months. The cross-sell of retail financial products like loans, that is especially home loans, insurance and wealth products will actually help in improving revenue per user. Now, Paytm may be on early path to profitability by FY26. After that, the profitability will accelerate for Paytm. They say that Paytm's cash to market cap, now this is an interesting ratio, is at 21% for Paytm, while that of Zomato is at 5%, which provides a strong margin of safety for investors. So additionally, further easing of a regulatory stance via potential approval for payment aggregator license could be a positive catalyst for Paytm. Back to you.
Okay, all right. Thanks a lot, Abhishek, for joining in and giving us all of those details. By the way, it's Surbhi, it's a bazooka opening that we're seeing for the markets. The Adani Group stocks, well, they are opening up well in the green. You have Adani Green, Adani Power, both of them up close to around 6 to around 7% or thereabouts. So big move is what we're seeing out there. NTPC Green as well has pulled back in the last few days. So quite a few of these stocks are doing well. The crucial factor is, can we hold above these levels? Remember, the markets have seen a sharp correction. But from this number of around 23,350, the bulls would like to sustain this opening. One positive is the Nifty Bank is likely to make a higher high. And that's something that was missing in the previous few trading sessions. But in the last two sessions, we have managed to get that higher high. And from the Nifty itself, HDFC Life, plenty of headwinds we have seen, but now in fact those numbers look quite good, and I think it's one of the top gainers in a pre-open, up close to around 6% or thereabouts. So it'll be a pretty good looking screen, but I'll tell you what, at 3:30 p.m. the bulls would like to see a similar or a better looking screen.
I'm looking at some of these internet new age companies because the news flow is just so much around them. One is Bernstein has come out with a note across the sector, and they like lots of stocks, including Zomato, including Swiggy. There's also CLSA, by the way, which has put a 400 rupee price target on Zomato. 400 stocks at 250 right now. Bernstein's target on Swiggy is above 600 rupees. Swiggy also, remember, has incorporated a new subsidiary, a sports subsidiary. We need to figure out what exactly they're thinking over there. Plus, they're launching a whole bunch of additional apps. So a lot of the new age stocks are in focus as well. Many of them could be starting. On the positive side, watch out for RVNL because of some order wins. That stock's very excited, about 5% higher. Transrail, of course, we just spoke to the management, is up and about. But on the flip side, two result reactions where the bears are going after these stocks, two of them. One, Oracle Financial Services, 5% down there, and the other is CEAT. CEAT's really disappointing with the top line and the margins, etc. So these are stocks which are, in all likelihood, they're going to start really soft.
Okay, well, we got the market open coming up in just a couple of seconds, and we'll have the first rates on your screens. So as expected, it's a bumper start, 130 odd points higher on the Nifty. So we're at about 23,345. The Nifty Bank is starting at about 49,150. That's about 0.8% higher. The Sensex is up 0.6. Mid-cap index doing a little better with about a 1/3% gain, and the small cap index will come up as well on your screens. So 1% on the Nifty IT index, and it's seeing a bit of a jump. So outperforming at least the benchmark indices at this point, the Nifty IT. Look at the heat map, which is emerging up on your screen, 0.5%. On the Nifty, you've got just about 4-5 names in the red and everything else, which is starting up in the green at this point in time. Okay, a little more red now, so about 14 odd names in the red, but everything else is starting in the green. So that's it. I mean, HDFC Life is, of course, the big results reaction, 7% higher at this point in time, but it's all about individual names, individual stocks. Look at the sector watch, right? PSU Bank, top gainer 2%, but of course it's lost about 0.25% of value from the all-time highs. Metals are up 1.5%, dollars lower. And of course, I mean, others as well in varying degrees. IT is up about 1.3%. Surbhi.
Okay, let's get down to stocks then. And obviously, HDFC Life is the one that's hitting it out of the park. Stock has been up between 5 and 6% as we open. Make that 7.5% now on HDFC Life. Look at that. The thing is that the market wasn't ready. There was no positioning to look at such a performance because the narrative was so negative. This whole clampdown on the banker channel, the surrender of policies being the other regulatory overhang, but they have come out with great performance. The margins are looking stupendous and the market's saluting that. Let's move on. Adani Enterprises, Adani Ports having a good start this morning. HDFC Life is pulling up, SBI Life as well. That stock's up about 4%. The other gainers include SBI, the bank itself. Tech Mahindra is up to 2.5%. IndusInd Bank is also higher. There is, actually the banks are doing very well. HDFC Bank as well, 0.8% up there. The bank Nifty is gaining twice as much as the Nifty. So it's a solid morning for some of the large cap banking names. Let's round it up with ICICI Bank, also up about 0.5%. So this is the good piece. On the downside, there is some profit taking in the so-called safety zones in the market. So your consumer names are down and out. HUL, ITC, Nestle, Tata Consumer, all of them losing, but not too much, 0.5% to about 1% lower. Otherwise, the banks are turbocharged this morning, looking very good. 500 points up on the bank.
All right. Well, the HDFC Life, clearly the stock of the morning up close to around 8.5%. Paytm is not doing too badly. That as well is up close to around 5%. Yesterday, it had a 4% rally. It's building on to those gains and on massive volume. So that one comes up for you on the screen. You had MobiKwik. Well, yesterday, in fact, had a large trade that took place. A large fund did sell most of what they had. And that one, in fact, has popped up in trade in today's trading session. So good move is what we're seeing on that one as well. Ambuja Cements, well, that's bounced back with the entire group of Adani Group companies. So Ambuja as well as ACC, both of them moved high. We'll get an analyst later on today. Will be interesting to hear his thoughts in terms of what is his view on both these two stocks. So we'll stay tuned for that. On the downside, a few stocks that are moving lower. CESC, that's lower. Kalyan Jewellers, massive volumes is what we have seen just in the first few minutes. The stock is as flat as can be. It's in the F&O band. So we'll have to see whether or not there is any kind of buying that takes place on this one. But keep an eye out on that name. The other one is Manappuram. That's as well as in the F&O band. And that's opened up, I think, with a gain of close to around 2.5%. So Manappuram continues its upward trajectory after making a low of around 150 rupees. And ABFRL, that's the other one that's in the F&O band. So I think we should get that one as well. What are the initial rates on ABFRL? Up close to around 1%. Good start. Need to build on from here.
All right. Well, I think it is indeed a good start, and we'll see how it goes from here. What do we have apart from everything that we've laid out? So just volume-led gains coming through. Paytm is up another 6%. Paytm is back above 900. Yesterday was a 5% mover. It's another 5-6% today. So million plus shares on Paytm coming through. SBI Life is the other one. So HDFC Life, of course, but SBI Life is also coming up. I think SBI Life reports numbers tomorrow. So that's a 60 rupee pop, 1,530. Again, this one has come off from, highs of close to 2,000 bucks. So there is some activity here. Policy Bazaar is coming up. I mean, these are all essentially a little bit of rebounds after, what we've seen in terms of cracks recently. Max Financial, I'm not sure you guys mentioned, 7% on Max Financial. It's insurers and life insurance companies. Actually, we should have a stock stack with the life insurers at the bottom of the screen. The HDFC Life Impact. So MFSL, SBI Life, HDFC Life, and I'm sure there are others which are doing well as well. HCC, PG Electroplast, there is a lot. I mean, HFCL, Railtel, Hoodco. I could go on. Ambuja Cements is up about 4% or so. And of course, the Adani Group names are all up between, 4 and 5, 6, 7, 8% at this point in time. We were talking about that with, of course, Deepan earlier in the morning. So a bit of a lift. I mean, just there's no news flow. It's just a sentiment, kind of a boost with regards to that. Of course, Hindenburg winding down news flow. Oracle Finance is down 0.5%. It's the largest volume traded name by far. Trent is coming up with about a 1% cut. And it's got large volumes. ITC is 0.5% lower, and CESC is down about 1.5%. I think C8, etc. we already mentioned.
That's right. A couple of more stocks. Aeroflex Industries, that's up close to 12.5%. They came out with the set of numbers. Yeah. So boom on that one. And the other one is L&T Tech Services as well. Big move is what we're seeing. Massive volumes on that name as well. So a few of these names are doing well. And at least, the breadth of the market, it's been a long while since we saw this. 9 stocks advancing for 1 stock that's declining. We have seen the reverse. So the bulls will be breathing a sigh of relief.
Yeah, no, I mean, more than, fresh buying and what your fresh purchases will do. I mean, markets correct, existing portfolios look a little worn off, and rebounds always, of course, welcome in that sense. Manish Gunwani is with us, Head of Equity at Bandhan AMC is with us. Manish, good to have you with us here. Thank you for your time. Good to get you on this morning. So, how are you looking at things? Are you in the camp that, with the environment has turned a little more adversarial, both local and global as well? Global, maybe yes, rate of change is slightly negative. Varying degrees, if it depends on who you ask. In local, of course, there is the slowdown, which is not new. It's at least 2-3 quarters old now. What's the sense?
Yeah, I think it's going to be, I believe, not a very high return market, to be honest, the next few quarters. The thing is, rather than forecasting anything, the biggest thing is last 3-5 years have been solid in terms of returns. Obviously, valuations are high. And two is, as you pointed out, we're entering a phase where the world's largest economy is going to see a fairly radical regime change. We don't know what exactly will happen in terms of dollar strength, yuan weakness, trade tariffs, etc. So there is a lot of uncertainty, and the valuations are probably, on an aggregate, not reflective of that uncertainty. But having said that, I think there is value at polar opposites of the market. I think a lot of tier 2, tier 3 financials are almost at distress valuation. And I believe that in India, secured lending will still be okay because in general, we are a reasonably high inflation economy. So the asset values keep inflating. And a lot of the tier 2 private banks, PSU banks are at book or below. So I think there is a risk reward opportunity there. I think there is a risk reward in metals at this point of time. And on the other side, when you look at the quality companies, I think the internet platforms and anyone who has the potential to use stuff like AI well, those companies, I think, still are very interesting.
Manish, hi, morning, and great to have you with us on the show today. So the market's kind of, been dealing with a lot of news flow and a lot of moving parts. I want to focus, however, specifically on this morning's trade, just because it's so pronounced. And that's life insurance. I think the market went into the earnings season with not too many great expectations because there have been so many regulatory headwinds for the sector. Sometimes there's a tax change. Then there was a change in the surrender value norms. And then there was some chatter about when the finance minister made that statement that, there should be no mis-selling and banks have no business to be selling policies that people don't need. Despite all of that, look at the performance of some of the sector leaders like an HDFC Life. And right now, as we're speaking, stocks are running anywhere between 3-4% to 8-9% higher. What's your stance on insurance, both life and non-life?
No, you're correct. I mean, bulls are very tired on insurance because last 3-4 years, we've kept getting hit by some regulation or the other. So in terms of the theme, I think there is attractiveness in the sense that we all know that financialization is going up, that people long-term over the next 2 decades will move from physical assets to financial savings, and obviously insurance is one form of financial savings. It is a fairly urban affluent product, and to that extent, that is the segment which has done well, which we've seen in savings or consumption. So to that extent, top-down has been very good. Unfortunately, there is a question whether a lot of these products are they good for the customer. I might be a bit biased because I do feel that mutual funds are more efficient as a savings vehicle than insurance. But having said that, there is obviously need for long-term savings, which insurance is an avenue for. So we have a bit both the general insurers, life insurers, and the tech platforms around it. But yes, it's been it has needed a lot of patience.
No, absolutely. It does need a lot of patience, and maybe it will require more patience as well as we go forward. I'm just looking at if anything else has moved into the sort of gainers list out here. Swan Energy is coming up with a 5% gain. It's got very large volumes right now. I think Azad Engineering, we highlighted 6% gains. Zentech is up about 6%. So, saw a bit of a fall from 2,600 rupee levels back to about 2,300. I don't know if you can look at something like a Kalyan Jewelers, right? So, was a big loser yesterday. And will be interesting to see what it's doing. This morning, it's kind of dithering, nothing. 555 is unchanged in a market like today. So 125, so 23,340 is where we are at. By the way, ICICI Pru is the one name we did not mention. ICICI Pru is up about 4% as well, 4.5%. So MFSL, SBI Life, HDFC and ICICI Pru about 4% higher from the life insurance space. Many more names starting to find their feet with gains. What else, Manish, at this point in time is, thematically speaking, over the next 6-12 months, apart from sort of sectors like financials, etc., anything else looking interesting?
No, overall, we feel healthcare is a good space. It's not obviously high beta, but basically, I think globally, there is a need to reduce healthcare costs because governments are very leveraged. There is aging population, and India has obviously got great strength in terms of generic drugs or medical tourism or whatever. So I think it's a good theme to play for the long term. As I said, some of the domestic companies which can, the large companies which can use AI, that is a nascent theme. We should, I think, keep an eye out for that because globally, that is differentiating companies within large sectors. So I think these are a couple of secular themes we are interested in.
By the way, as an aside, Manish, somebody was talking about how maybe to insure yourself against medical bills, healthcare costs, maybe, buying medical insurance is one way, but maybe buying a bunch of hospital stocks is another way, right? And actually, if you think about it, it's not the wildest of ideas. Of course, not arguing against medical insurance, which everyone must have, but no, point taken. And you mean hospitals, right, Manish? When you say healthcare, right? Hospitals.
I think the entire value chain from contract research, generic drugs, hospitals, the entire value chain, yes.
Okay. All right. So, Manish, just to kind of, sum this up, overall on the market, just a call for this year, sideways, range bound, 4 to 5%. Just leave us with something.
Yeah. I would go with that. I think India's macro is stable enough, but growth is an issue. Valuations are not super cheap. But yeah, I think long term, I think small cap space is where we will make money, and a lot of it will depend on how we pick stocks.
Okay. All right, Manish, thanks a lot for joining in. Wishing you a good year ahead, and we look forward to chatting up with you as the year progresses. Let's focus on the big mover of yesterday, Minda Corp. They have acquired 49% stake in Flash Electronics for around 1,372 crore rupees. To talk more about this development, we're joined by Mr. Akash Minda, Executive Director at Minda Corporation. Hi, Akash. Good morning. It's been a long while since we spoke. Well, give us a few details. Basically, first, what about the funding? 1,370 crores odd you have to come up with. Split it up for us. What is the funding? And if you could help us out, how are your current books looking, your debt on your books, if any?
So hi, good morning, and wishing you all a very happy new year. And it's been a while, but I think we are back with something which is historic for Minda Corporation. As you know that we have formed a strategic partnership with Flash Electronics to create the fastest EV growing platform in the country. As going forward, I would first like to share about the Flash Electronics. It is an organization which is based out of Pune and has focused on EV and ICE engine and powertrain electronics. While Minda Corporation also focuses on the powertrain side of the EV products, but we have body electronics such as instrument clusters, keyless solutions, wiring harness, and other product lines. Going forward, we'll be, as a part of the strategic partnership, we'll be acquiring 49% stake for 1,372 crores. And going forward, this will be value creative for Minda Corporation shareholders, as we will be creating a lot of synergies from the way of cross-selling to the captive requirement of Flash Electronics, as well as adding new customers and exports, which is the growth for us. Secondly, the share of profit that will be coming in Minda Corporation will be additional from the financial year 26. As well as for the funding side, growing in the short term, the net debt to equity will be about 0.6 times, which is well within the comfortable interim limits of Minda Corporation financial prudence. And the net debt to pro forma net EBITDA is about 1.8 times.
Okay, so can you break up that number for us? What is the debt on books? As of last year, your interest cost was close to 60 crores. So what is the existing debt on books, if any? And if you could tell us, with this acquisition, you have to come up with around 1,300 crores. How much of it will be debt? So what does it take the total debt to?
So in the short term, all I can say is that we will be looking at about 0.6 times our debt to equity. And going forward, we are having a lot of opportunities and options in order to fine-tune our long-term perspective of the financial positions.
Will you raise any equity? Will you raise any equity? Is that an option you have?
So there are various options that we will continue to evaluate, and we will come back to the market as we decide.
Okay. Akash, morning. Prashant here. Why 49 and not 51?
So good morning, Prashant. See, we believe at Minda Corporation, it is the era of partnerships and collaborations going forward. And also, we believe that creating value together is the best interest for all stakeholders.
Is there an
as part of our value creation?
Is there an option to go up to acquire majority? I mean, is there an agreement? I mean, some first right of refusal or something? I mean, where will this be, or will this stay at 49?
So as of now, it is 49. We will continue to explore how we can collaborate and work together.
Okay. And if one were to look at this association, what can we expect in terms of revenues from this partnership? Talk to us a little bit about that. What are we looking at?
So as the synergies for the captive consumption of Flash, we are looking at from, let's say, about 18 to 24 months from now on, about 100 crores plus, and going to about 600 to 700 crores by 2029 and 2030, just by the captive requirements in the areas of die casting products, wiring harness, and other electronics that are synergistic to Minda Corporation. Plus, this will become more competitive for Flash as well as Minda to acquire more customers and more product lines. And third, very important lever is on the adding of the new customers as well as the exports market that will open up for Minda, where we can be adding new products to our new customers coming from Flash Electronics.
Right. Just the numbers once again, Akash. You said just by 18 to just repeat the numbers, please, for us.
Yeah. So in 18 to 24 months, we're looking at about 100 to 200 crores as per our business plan. And by 2030, just by organic captive consumption, we look to expand this to about 500 to 600 crores.
This is you selling to Flash, is it?
That's right.
But so, you're buying 49% in a company to be able to sell to them. Is that broadly, am I understanding it correctly?
No, the idea, the more important idea is to create the largest EV platform in the country. So while we are into the body electronics and Flash is in the powertrain and engine electronics, we're going to be offering the complete system solutions offering, which is offered by none other in the country to all the e-wheeler manufacturers in India, whether it is two-wheelers, commercial vehicles, three-wheelers, as well as passenger vehicles. That is the idea on how we can combine and cross-sell our products as a system solution offering to the end customers, which are the OEMs for us.
Okay. Akash, now Flash obviously is a very profitable entity, and I'm looking at some projections which say that the FY26 levels could be in excess of 100 crores. Can you tell us your share in the profits? It's going to be in the same ratio, I'm guessing 49%. And also when you talk about it being EPS accretive from the word go, what should we expect? What should we expect on the margins of this combined entity as well?
So Flash Electronics is expected to deliver a PAT about 110 crore plus in FY26. And Minda Corporation having 49%. So we'll have about 50 to 55 crores of PAT consolidated in the Minda Corporation books of accounts. So that's one. Number two is on us for our while we are increasing our debt. So the interest will be increasing, but this will be compensated by the cross-selling opportunities as well as the new customers and export orders that we'll be adding at terms of Minda Corporation. So we will be getting scale as well as in terms of the other books of accounts, in terms of customers, other synergies, and cross-selling opportunities.
Okay, so let me just reiterate that just because of the consolidation, in the immediate term, you get 50 to 55 crores. That's the 49% share that you have. Now, I want to come to the bigger picture. This combined large entity, of which as of now you own 49%, what will the revenue be? As of today, what's the revenue? What is the potential in terms of revenue growth, CAGR? And what will be the blended margins? Because a lot of the brokerage notes are pointing out towards the cross-sell opportunities. Like you're saying that, Flash and Minda are in complementary businesses. So as you scale up and you cross-sell, what is going to be the revenue pie, say 2 years down the line, the CAGR? And also what will be the margin on which this entity will operate?
So currently, speaking about Minda Corporation at first, we're looking at about 5,500 crores revenue by end of this financial year. Out of this, EV products are about 5% of the revenue, which is in line with the EV penetration of two-wheelers in the industry. Speaking about Flash, last year they did about 1,340 crores. And by end of this financial year, they're speaking about 1,550 crores plus of revenue, which is about 1,590. And their 13% of EV revenue has grown to about 20% plus in the overall 1,590 crores. So for Flash Electronics, it's just simply doubling the revenue from about 150 crores to more than 350 crores, expected to be closer by end of this year. So combined revenue, if you just think by end of financial year 25 itself, will be about 10% of the overall Minda Corporation's revenue. And while the EV penetration is expected to increase by 2030, and the fastest growing space is the two-wheeler electric vehicle mobility space. That is where both the organizations expect to combine and get the maximum value and value creation out of this.
Akash, sorry, a lot of numbers there. I'm just trying to get to one number. You said Flash itself, the revenue projected for FY25 is about 1,550, right?
1,590 to be precise.
1,590. Now, once the combination takes place and you get the synergies on board, FY26, what will be the revenue of this merged combined entity in which you own 49% and the margin of this entity?
So it will not be a combined merged entity. It will be an associate company for Minda Corporation having 49% stake. Okay. That's one. So in our long-term plan in terms of Minda Corporation, again, we plan to outbeat the market and grow 1.5 times. And Flash Electronics with their 1,590 crores by end of financial year 25 is again expected to grow by the tune of about 15 to 20% next year, which is FY26. So while their current revenues are about 20% of EV, they expect to grow up to again 25% or so by FY26.
All right, we'll leave it there. Amit, and thank you very much for joining us with that. We wish you all the best of luck and hope to speak with you again as this starts to happen and things move between Flash and Minda with regards to supplies, captive consumption, and being able to build that EV platform that you're talking about. L&T Technology Services is also in focus. It's reported an inline operating performance in the third quarter. Company's updated its FY25 revenue guidance to near 10% compared to 8 to 10 earlier. Let's talk about this more. Amit Chadha is Managing Director and CEO at the company. He's with us. He's also the NASSCOM Executive Council member. Amit, good to have you with us here. Thank you very much. Your FY25 revenue guidance of 10% now includes an acquisition. Can you share what the organic growth guidance is for this year?
So the organic will be at that 8% level, and with Intelli will come to that 10% level. So that's how you should see it.
Right. Fair enough. So organic growth of 8% for 25 would imply a Q4 revenue growth of 7% on a sequential basis. What makes you confident of achieving this?
So thank you for asking it. So number one, I should say that we don't give quarter guidance. So I haven't, I'm sure I've done the math, but I'll stick to my annual numbers, and whatever that comes out to the quarter, that will happen. Now, why am I confident? Number one is that if I look at our pipeline, I've talked about it in the past as well, our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past, right? If you look at it, there's been 8 wins. So there's been a 50 million win, there's been 235 million wins, there's been 25 million wins, and there've been 10 million wins. And these all go into revenue realization in the current quarter. Some of it came through last quarter, but the rest of it comes this quarter onwards. If I may just take a minute and talk about a couple of other things. See, we've been investing all throughout in AI, Gen AI. We stand at more than 175 patents now in that area alone. The company has yet again filed 50 patents in the current quarter as well, overall total. So the technology push that we've been giving is starting to pay off for us, and we are seeing deal conversions. In fact, the medical deal that we won, the industrial deal that we won, and the media deal that we won, all three of them, we've actually sold. Part of the service offering has been to sell the packaging of our reusable assets and AI, Gen AI as well, right? So that will help us as we plow through next quarter and beyond as we grow.
Hi, Amit. Your FY25 organic growth of around 8% is at the lower end of that 8 to 10% guidance. Would you say that there is some downward assessment to your organic guidance? And also, you had a margin guidance of around 16% for FY25. Maintain it?
Sure. So if you look at it, we gave a band 8 to 10, right? When we give the band, we can come in anywhere in that band, right? So you can't assume that you'll always be at the upper end. And this has a number of factors. This has decision making. This has deal velocity. This has the overall demand environment, etc. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year. And I do see the green shoots coming out, and therefore FY26 being a better year than FY25. Having said that, there is a little bit of, revenue to be sold in the year baked into these guidance numbers that we always give. And that's where we are. Now, in terms of margins, we had committed that H2 will be better than H1. So if you look at it, our 15 odd levels that were there in Q1 and Q2, in Q3, we've come in operationally at 16.x. And then if we take the M&A charge, small charge, it comes down to 15.9. But I'd stick to the 16.x or 16.2 that we've got. And I do see quarter 4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. So we are back operationally, as you can see, because our investment phase is kind of the jump investment quarter 1, quarter 2 is over. It will be regular investments, and you will continue to see margins improve. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
17 to 18% EBIT in the medium term. The market is liking what you're saying, sir. So once again, just to reiterate, the near term, what you're saying is that in Q4, margins will sustain at the Q3 levels of around 16%.
In that neighborhood, yes, you are absolutely right. And from there on, you will see the organic growth and the organic margin should continue to improve and climb from there. Because we have invested, like I said, in reusable assets. We are automating a lot more. There's a pyramid correction that we have implemented. In addition to that, we will be taking in about 2,000 freshers in FY26. So all of this will come into play. And we are working on improving the offshoring ratio as well. So you will see all that positives coming in as we move forward.
Okay, so you're very confident on margins. Got that point. Speaking of offshoring, I mean, that's the next big chatter, right? What happens to immigration policy in the US? What is your current offshoring ratio, and what scope of improvement do you see?
So we are in that currently our range, and I don't have it off the top of my head. I think we are at about 41% on-site, so about 58% odd offshore right now. And we should be able to, again, in the medium term, this 58 odd percent can go up to about 65, 68% for sure.
Okay, all right. Amit, you mentioned that FY26, will be better than FY25. What are you hinting at? Should we assume a double-digit growth?
That will be the aspiration, but I don't want to give out a guidance right now. Please allow us to come back in April to you. Things will shake out and be a lot more clearer. But you will have, Intelli's 3 quarters coming in because we've integrated that on 3rd January. So a quarter of that will come into Q4 of ours, and then the remaining will come into 3 quarters for next year. So that's how you should see this. In fact, I do want to make a couple of points here. One, we will be able to, with IntelliSwift, be able to take 3 of our hyperscaler accounts and move them to 20 million plus immediately. Second, we were not working in the service-led ER&D space, and that opens up for us. So fintech, retail, healthcare are 3 areas that we'll additionally start to serve. And I do believe that will help us grow faster and further as we move along.
Right. Amit, did the 3rd quarter benefit from bunching up of deal wins? And is this deal win run rate sustainable?
This was the highest growth that we have had. This is the highest deal wins that we have had in the current, in this quarter. And I do believe that going forward into Q4 and beyond, we will try to keep this pace as we move forward. Our pipeline is a lot better than what it was last year. And we do believe that the differentiated solutions that we have and our accounts are starting to grow. So next year, you will see our first 50 million account and then beyond. So you will see that expansion coming, and all this should help us.
Okay, just to wrap things up, some more color. Mobility was under pressure. Why is that? What's the outlook on other verticals? Just leave us with the big picture.
So mobility for us is auto, trucks off highway, as well as aero and rail. In the current quarter, I had said when we gave our results out last quarter that mobility will be soft, and that was an account of furloughs, as well as a couple of automotive, automotive spends are under stress. So keeping all that in mind, we had made that commentary. I would like to confirm that next quarter onwards, mobility will start to grow again. And this will be on the back of the deals we have won on this quarter, as well as some of the solutions we created on LTTS iDrive, which is our software-defined vehicle solution, and based on the fact that aero and rail should grow. So with all those 3, you will see mobility starting to expand next quarter onwards again. So just take this 1 quarter as a one-off. Now, if I switch subjects and go to sustainability, which is our highest profitable segment, that grew at 4% quarter on quarter, 8.1% year on year on a sequential, constant currency basis. I do see demand in sustainability to continue to be there. In fact, we won deals in the current quarter, and we've got a good, healthy pipeline to close in Q4 in sustainability as well. There's a couple of very chunky deals, and that will help us. In fact, maybe our first 50 million account will come from sustainability itself. And you will see that continuing to expand as we move forward. We are seeing demands in rejigging of supply chain and industrial automation, as well as AI in automation in the shop floor. Finally, the tech segment, which actually grew about 11%, was fueled by medtech, as well as hyperscaler revenue, CMT, that came into us. And on the back of the deals that we won this quarter, we do expect next quarter to be the growth to continue in this area. So I'm fairly comfortable at this stage to say that all 3 segments will grow next quarter, as well as continue to grow into next year.
Okay, all right. We will leave it on that note. Thank you very much for joining in, Mr. Chadha, and good luck to you for the rest of the year as well. Need to take a very quick break, come back on the other side, and then we put the spotlight on the cement space. Earnings season is in full bloom. So what are the expectations from this major sector? Rajesh Ravi of HDFC Securities will join in. Of course, Nigel is going to run us through the key expectations. Quarter se quarter tak. Welcome back. Just a quick glance at the market before we march on, and it's still a 100-point gain, so it's all right. Bulls for now are retaining their control. The Bank Nifty is leading from the front, 1% higher, and mid-caps are doing even better. The mid-cap index is up 1.5%, massive advanced decline ratio, very green-looking, bright green-looking screen this morning. Okay, now that we've done that quick update, let's move on to the promised conversation on cement. It's time for our special segment, Quarter Se Quarter Tak. We have Nigel on the wall to first tell us, so what all has happened with the sector in the third quarter and what the broad expectations are. Nigel.
Well, that's right. For the cement industry, Q3 is likely to see some signs of improvement for the cement companies, with volumes, prices, as well as profitability probably bottoming out. Now, industry volume growth is expected to be in mid-single digits, which is better than the flattish number that we saw in the first half of the fiscal. The reasons for improvement include a pickup in the run rate of government capex, recovery in construction demand post the monsoon, as well as the festive-related slowdown. Now, large cap names like UltraTech as well as Dalmia, they're expected to report high single-digit volume growth. ACC as well as Ambuja, they'll report mid-teens volume growth due to the acquisition of Sanghi Industries as well as Penna, and also due to the master supply agreement between the two. Shree Cement will relatively underperform. The volumes out there will see a bit of a degrowth. And among smaller names, surprise, surprise, Nuvoco is expected to outperform. They'll deliver mid-teens volume growth, but that comes on a very, very low base. Moving to pricing, cement prices finally witnessed a recovery in Q3 after 3 weak quarters. They've gradually moved up from those 4-year lows that were witnessed in the past quarter. Now, price hike attempts appear to be finally going through in most regions. That's barring South India, which is expected to see a dip in prices even in Q3. Now, the street estimates that close to around 1.5 to 2% improvement in realizations, though it will be much lower on a year-on-year basis. Prices could be lower by around 8 to around 10%. North India, that's the one that's likely to lead the improvement, while West is also likely to see some kind of improvement. Now, both pricing as well as volumes will improve. So that's what points to an improvement in the overall profitability on a sequential basis for most of the companies. And that will arrest that decline that we were seeing in the profitability in the past few quarters. There is also an anticipation that profitability will further improve from here on. That's from Q3 and then Q4 onwards. Industry estimates suggest that the average EBITDA per ton could improve by roughly around 170 rupees sequentially, though it will be lower by roughly around 300 rupees per ton on a year-on-year basis. Now, coupled with the improvement in pricing, the aggregate cost per ton should come down by around 2 to around 3%. That's because petcoke, international coal prices, both of them are expected to remain soft, which will result in fuel cost savings. Jefferies, they have come out of the note. They're mentioning some relative out and underperformers. The potential outperformers, well, they include UltraTech that could report relatively lower EBITDA on a year-on-year basis, but on a sequential basis, there'll be some improvement. Dalmia, Shree, JK Cement as well as Ramco, they'll take a sharper knock as well on a year-on-year basis. On a sequential basis, things could look better. JK Cement could report the highest increase on a unit EBITDA per ton, while Ramco, that could be a relative underperformer because the EBITDA improvement sequential will be marginal, and on a year-on-year basis, it will be much lower. Let's wind it down with the valuation snapshot. The large names like UltraTech, Ambuja, as well as Shree, they enjoy higher multiples, while underperformers like Dalmia, Nuvoco, as well as ACC, they trade at sub-10 times EV upon EBITDA. The hope is Q3 shows some kind of green shoots, which will further improve in Q4, which is incidentally a seasonally strong quarter. Well, let's welcome Rajesh Ravi, who joins us on the show. Hi, Rajesh. Good morning. Good to see you in. What's your take? Q3 will be the bottoming out quarter and things improve from here on. Fill us in with a couple of numbers. Aggregate EBITDA per ton, how much does it improve in Q3? And for Q4, how much more better can it get?
Hi, good morning, Nigel, and thanks for having me on the show. Yes, you covered it nicely in terms of the expectations for Q3. So volume, which was sluggish in H1, is finally expected to recover around 5% in Q3 year-on-year. But mind you, this is suboptimal given that the expectations were that the volume should in H2 look up north, would be close to 8 to 10%. And that is where even the top managements were guiding that, demand should pick up. That Q3 hasn't materialized, and that is why even the pricing action has been suboptimal. Less around 1 to 2% in most markets. South market prices have again slipped in Q3. So last major pricing action we had seen was in September of 2023. After that, prices have been on a slippery slope only. all efforts have been, none of them materialized. Q3, finally, we have seen some improvement in realization, and there are hope that in Q4, with demand accelerating, most of the pent-up demand, getting executed in Q4, the pricing action should be better than what we have seen in Q3. So overall, there is hope with good amount of probability that Q3 margins have bottomed out, and sequentially, as you pointed out, the expectation is close to 170 to 180 rupees margin improvement. In Q3, we should see at least similar 150 to 200 odd rupees margin improvement at least in Q4, premising that 100 odd plus should come in through realization and 100 odd through coming through operating leverage and some of the cost savings. So at least 200 rupees margin improvement in Q4 should be there, and then the margin profile year on year may look better versus Q3 when we are sharply down year on year.
Got it. All right, Rajesh, give us a few more details then in terms of preference of stocks. ACC and Ambuja Cements,
Yeah.
there's a group level inquiry that comes about, and then the markets get a little bit jittery. How do you approach both these two names? Because valuation wise, relatively, and also in comparison to replacement cost for ACC, they have come down to attractive levels. You agree?
So, to look at ACC independently as a cheap stock, maybe, something which could be looked upon differently. Yes, it is very cheap. In our view, it is trading at $90, which is for a 30 million ton plus company. But, how and when, at what ratio the merger would happen in Ambuja, whenever that happens, that is what puts keep the valuation under check, because recently you saw how Sanghi acquisition, while the promoter stake initial was purchased at north of 100 rupees per share, the share swap ratio which came in recently is close to at 62 rupees. So ACC per se, the valuation is for sure not to be looked at independently. Ambuja, on a console basis, in our view, it is trading close to $160, which we believe is a comfortable zone when we look at Ultratech, which is trading north of $200. And we believe that Ultratech and Ambuja today, on a console level, both the companies will have similar margin profile, and volume growth in Ambuja in near term will outpace Ultratech because of the in acquisitions volume getting accumulated in the growth numbers. So from that perspective, Ambuja's valuation is comfortable versus Ultratech.
Okay, all right. Just hold on to that thought, Rajesh. We have some source-based information that's coming in there. IDBI Bank is seeing a bit of a spike up because the March FY25 target is intact for receiving financial bids for IDBI Bank, and that's why that stock has moved to the high point of the day. Big volume spike is what we're seeing on that one. Rajesh, I wanted to ask you a couple of other questions then. Stocks like Nuvoco, they came out with an IPO at the peak. Everything looked so good, and then everything went away. At around this 350 mark, people are talking about it getting acquired. Now, valuation-wise, it's in their favor. It'll be interesting to see how they can turn around this asset. But what's your take on stocks like Nuvoco? Dalmia is down more than 25% from the peak, particularly on both these two names.
Correct. So coming to Dalmia first, see, this is becoming a 50 million ton franchise by end of this year, and this company, the balance sheet is quite comfortable. The company has faced challenges in terms of volume growth. FY24 second half and FY25 also, they have struggled for volume growth in the first half. Q3 at least they are trying to recover on that. They have recently got a marketing head on board also. So the management is taking corrective steps, and I believe if your balance sheet is healthy and your focus is in terms of cost efficiencies, where Dalmia is already efficient enough, and they are also improving their green power mix, we believe it's just a matter of time when with the volume growth comfort coming in, the valuation should again prop up. It should easily get $130, $140 valuation. So Dalmia is for sure, whenever the pricing improvement happens across the industry, and in the interim, the volume growth efforts start playing out, I believe the stock is up for a re-rating. Coming to Nuvoco, yes, when it came for the IPO, the market was a different zone. All building material stocks, demand was super strong. East market was growing in high double digit, and thereafter we faced both demand challenges and the coal prices also went for a toss, impacting everyone. And Nupco had a high leveraged balance sheet. However, the management did the right thing in scaling down incremental capex. And now this Badraj acquisition, which they have done at $60 versus the current trading at $70, we believe this is not very front-ended in terms of capex expenditure. Most of this will happen between FY 26, 27, and partly may flow into FY 28 also. And they have put down, they have shelved their north expansion plans, brownfield, which they were planning. So net-net, this should not lead to any major stretch. Yes, the key would be they're ramping up the assets, which they believe. What the management has said that they have got it evaluated from multiple vendors, independent vendors, and they are confident that the plant can be up and running at a total cost of $60 per ton. If that happens, the strategic nature for them is that they could service the Gujarat market, and they could also look going into Maharashtra and some other potential south market as Sanghi was planning. And hence, their north capacity will be freed up, and they could be delivering growth across the, from east market, north and Gujarat markets, west markets.
Okay. All right. Very quickly, Rajesh, before we let you go, as of today, how much have prices improved in comparison to an average for Q3?
So prices in so far, see, this is the first few days. The prices have not improved much because this is, still the non-auspicious period. Only the projects which are undergoing continuously just is what is being, executed. So most of the pricing action are now expected to play out between January and February, and we believe if any major effort in terms of the pricing, that should be visible by month of February, and only then we could say that the pricing action is strong enough to sustain the earnings estimate which we are penning in for FY26.
Okay, so no big improvement in pricing. Thanks a lot, Rajesh, for joining in and helping us out with your quick analysis. So the optimism is that Q3 sees some kind of improvement, and Q4, which is normally the seasonally strong quarter, we see a further improvement from year on. And Ambuja's valuation, as he said, looks relatively more favorable in comparison to Ultratech. Mitesh Thakkar is back with us. Mitesh, we're up 100 points. Still holding on to some gains, though we've come off a little bit from the top. Trade on the Nifty and individual stocks?
Nigel, I think, once again, I would say we kind of failed to sustain about 23,350 despite the fact that we opened much higher than that, about 30 odd points higher than that. We still haven't got long, but on stock specific basis, yes, there are some reversal patterns which we are observing. So on the index weighted out, I would still want an hourly close about 23,350 to take longs, or you get a dip around 23,240 to 30 zones. That apart, on the stock side, Apollo Tyres, after a correction, has come into radar. Buy on a breakout above 465, so about today's high, 465, 466. Keep a stop around 456 and look for a target of 485, 490 to begin with, and then eventually we may even look at higher levels. Or the other call, which I would recommend is a sell on Sun Pharma. Disclaimer, we have some put options positions, and Sun Pharma, I'm waiting for the stock to break 1740. It's sitting around 1750, 52 levels. So below 1740, expect a move to about 1705, which is the 200 average area, and then sell with a stop at 1760.
All right. Mitesh, thank you very much for that. So that's the technical view, and more coming up as we go along. We have to take a break, but more stocks, specific stock-related stuff coming up on the other side. Stay tuned.
Welcome back. Let's look at some active stocks, and probably the most active stocks in the market this morning are life insurers. Look at what's happening to HDFC Life. The gains are in double digits now. And it's not just HDFC Life. It's taken the entire sector along with it. Yeah, almost 11% on HDFC Life, Max, SBI Life, thrown in ICICI Prudential as well, which is up 4-5%. Massive move on these stocks. And why? Because HDFC Life's Q3 numbers are well above market expectations. And anyway, the market wasn't positioned too much on life insurance stocks in any case because of all the negative updates that we've had, regulatory updates in the quarter. In fact, let's get in Yash now to understand what exactly happened with HDFC Life, Yash, that's fired up the street and the stock.
Well, absolutely, Surbhi. So, of course, HDFC Life understood is running higher, more than 10% in trade today on the back of its Q3 results. But what that has done is that it has given a ray of hope to all the life insurance stocks that the quarter indeed could be better than what the street has been estimating. Speaking about HDFC Life itself, except for new business premium, all other parameters, which include total AP, retail AP, value of new business, as well as margins, has come ahead of street estimates. To be precise in terms of numbers, new business premium, as I said, it's a slight miss to the poll, but still up 11% at about 7,900 crore rupees. Total AP, that is ahead of poll, up 12% at about 3569 crore rupees. Retail AP, that is ahead of poll at a growth of 12%, 3122 crore. Value of new business ahead of poll, up 9% at about 930 crore. Margins, particularly, the street was estimating a higher compression to come in terms of margin. That has been much lower at about 74 basis points downtick at 26.06%. In terms of brokerages, Jefferies and HSBC have a buy call with a target price of 750 rupees a share, and CLSA has an outperform call, but they've trimmed their target price to about 690 rupees per share.
Yash, thank you very much for that. So that is the sector of the day by far, life insurance. Paytm is the other one we want to focus on. It's higher, 5% yesterday, another 5% today, maybe a little more. Abhishek is here with, I think, MK's take on the stock. Abhishek, morning.
Morning, Prashant. So MK has upgraded Paytm to buy from at. They have increased the target price to about 1,050 from 750 that they had earlier. They say that the recent NPCI approval, which came in October 24, releases a major regulatory overhang for the company. Now, this should help it rebuild the lost MTU base that they had in the next 12 to 18 months. So cross-sell of retail products, especially like home loans, insurance, wealth products, will help improving the revenue per user. Now, Paytm may be on early path to profitability, so by FY26, and after that, profit will continue to increase as per them. So, Paytm's cash to market cap ratio, now this is a new ratio that I have seen, is at 21% versus 5% for Zomato, provides a strong margin of safety. So, additionally, further easing of regulatory stance via potential approval for payment aggregator license could be a positive catalyst for Paytm, is what they have written in their note. Back to you.
Okay, all right. So that's MK sounding quite optimistic on Paytm. Working well for the stock this morning. Thank you very much, Abhishek, for that. In more stocks that are surging and reacting to news flow, Aeroflex, which is up about 15%. Now, this one is reacting to its Q3 earnings print. Vamakshi is here with the details. Vamakshi, fill us in.
Well, it's a good set coming in from Aeroflex. Revenue saw an uptick of almost 36% on a year-on-year basis. Revenue now stands at 99 odd crores. And keep in mind that this is very strong as compared to the growth that we've seen in the past few quarters. The gross profit margin for the company has also seen a substantial improvement of 220 basis points year-on-year, now coming in at 39.9%. Resultantly, the EBITDA margin has also improved. Most of this growth has been largely driven by the gross margin. EBITDA margin is now at 21.7%. Which is again higher by almost 285 basis points. Net profit resultantly is seeing a very sharp surge of almost 70% year-on-year, coming in at 15 crores. Keep in mind that the margins at 21.7% is the highest that we've seen since Q4 of FY23, and the net profit too is at a multi-quarter high. When we look at the key internals, they saw very strong growth in assemblies, which is their value-added product. It was up nearly 101.4%. The contribution in the mix has also risen. export sales, which drive nearly 77% of the revenue for the company, saw an uptick of 10.5%, but it is the domestic business that actually drove the growth for the company this time around. The domestic sales were up 183.6% in the third quarter. The company also announced further expansion plans. They've already expanded to 16.5 million meters per annum by December, but they plan to take it further to 20 million meters per annum. For miniature metal bellows, they will be installing capacity of 2.4 lakh pieces per annum, and the combined capex for both of this will stand at 77 crores, and this will largely be funded through internal accrual. So good growth coming in for the company for the third quarter. The expansion plans also laid out bodes well for the company.
All right, Vamakshi, thank you very much for that. And before we take your leave on today's edition of Bazaar, this is some pretty shocking news coming in for the city of Mumbai. Bollywood actor Saif Ali Khan has been stabbed during an attempted burglary at his home, and he's currently being operated upon at Lilavati Hospital. We've got our colleague Santya joining in. She's just outside Lilavati, I believe. Santya, this is quite, difficult to wrap our heads around it. Tell us what you know.
Absolutely. This is an absolutely shocking and bizarre incident. And remember, this happened in Mumbai's Bandra area. First of all, Mumbai, the financial capital of the country. And then Bandra area, an area which is known for being the Bollywood personalities hub. And security is almost, top-notch here. So an incident like this taking place here is not acceptable, is obviously bizarre and shocking. Right now we are outside Lilavati Hospital, and this is the place where Saif Ali Khan was brought immediately after the attack, and he's being operated upon. The second round of surgery is being performed on him. So this is exactly what happened at around 2:30 this morning. Saif Ali Khan, his wife Kareena Kapoor, and both the sons, they were present at their Bandra residence, Pali Hill residence, and the family was asleep when this intruder barged in their house. According to Mumbai Police's prima facie investigation, the accused tried to attack Kareena Kapoor and the children. That's when Saif and this accused got into a scuffle, and Saif got hurt. While trying to protect his family, the accused stabbed him multiple times, according to Lilavati hospital staff. The actor was stabbed 6 times. Out of those 6 injuries, 2 are deep and 1 is pretty close to the spine. So the first round of surgery was performed immediately after he was brought to the hospital, and the second round is underway. According to Mumbai police, at present, and this is all based on the prima facie investigation, there was only 1 accused, and he is on run right now, on the run. What exactly was the motive? How exactly did he manage to enter the building and then the flat? All these questions are yet to be answered by Mumbai police. But after attack on Salman Khan, murder of Baba Siddiqui, all these things which took place in Bandra, once again, this incident taking place in Mumbai and Bandra, it's not a good look for Mumbai police.
All right, no, absolutely, and shocking incident there. Santya, thank you very much for that. We'll get you more details along the way. And of course, hoping for speedy recovery for the actor, Saif Ali Khan. Well, cooler than expected Indian and US inflation is in focus. Latha will take this up. The future course of dollar, rates and rupee with Neeraj Gambhir of Axis and Mitul Kotecha of Barclays coming up in just a bit.
So you've been playing international level badminton for almost 15 or more than 15 years now. Do you feel it also defines who you are as a player now, how you've matured as a player, your journey, your experience?
Yeah, definitely, yes. The person you are, the confidence levels that you show on court are very important. And I think as a person, when you're right there, when you stand and people, when they look up to you, they also need to understand that, yes, she has done a lot for the country. And that itself shows that how confident you are when it comes to the way you are, the way you show up, the way you prepare and the way you stand yourself in terms of, let's say, when it comes to style, when it comes to your personality, when it comes to your confidence levels. It is very important.
Right.
Yeah.
When you're speaking about your career, one thing when I was hearing you speak, how would you define a winning mindset, both on court and in life?
I think it's very important to believe yourself. I think that itself defines who you are, what you are, and what you stand for, whether if it's on or off court. I know people might say that, you've been very successful, what else you need in life? But I think to get till there itself was a tough task, but I have been very fortunate to have people around me have been very, very positive and very supportive. So I think for me, success definitely means everything, but I think initially nobody is born with a golden spoon. Everybody need to work hard and be smart enough to work hard. It's not just few months of hard work, but it takes years and years of hard work to come to a level. But I think coming to a level is one thing, but maintaining that level is a different thing altogether, and it takes even more time and hard work, and it takes a lot of your time to
India's currency and bond markets and the US markets are in a state of relief. The Reserve Bank yesterday signaled a significant policy change on liquidity. The central bank has decided to do daily repos, which is a practice that it had discontinued for the past 5 years. Basically, a repo is a way in which the central bank gives money to banks. Now, the assurance of daily liquidity to banks has raised chances of a rate cut in February. Now, separately, in the US, core CPI for the month of December has come in at 3.2. This is 10 basis below what the market was expecting. That has meant US yields have seen some relief, falling by about 12 basis points to 4.66 from nearly 4.8 earlier this week. Now, bets of 1 and even 2 rate cuts from the Fed this year have gone up significantly, well, not significantly, slightly, compared to what it was earlier in the week. To understand the future course of rupee, bond and dollar, I have with me Neeraj Gambhir of Axis Bank and Mitul Kotecha of Barclays Bank. Gentlemen, good morning and thank you very much indeed for sparing time for me. Neeraj, first to you, is the daily repo announcement a major source of relief, and does it increase chances of rate cuts?
I won't go on to say that it increases the chances of rate cuts as yet, because the inflation is still an issue in India. But as far as the liquidity management is concerned, I think it's a significant change, because earlier Reserve Bank would not give a daily repo liquidity. Now they have started doing it. The notional amount that they've announced is about 50,000 crores. And more importantly, in this facility, they have included standalone primary dealers. I think that's another constituent of the market which requires this kind of liquidity on an overnight basis. So it's a significant change in the liquidity management strategy of the central bank. And essentially what the Reserve Bank is trying to do is assure the market of continued provision of liquidity, notwithstanding its active intervention in the FX market and the changes in the government balances. And that's what is kind of quite reassuring to the market.
Okay. Well, now let me get to the US markets as well. Mitul, how would you read the PPI and the CPI numbers? Would you say now rate cut chances have improved? And basically, have we seen the worst of yields, at least in the near term?
I think the market is still going to be very choppy. Yes, there has been a marginal shift in expectations of easing, but I think if you listen to Fed officials, they still sound fairly cautious on inflation. And there's a lot of uncertainty, obviously, on Trump's policies and how inflationary, or whether there'll be inflationary, particularly tariffs, but also immigration policies. So I don't think the inflation release marks the all clear. And I think there will continue to be uncertainty. We continue to see just one rate cut from the Fed this year in June. So we don't think the Fed will be in any rush to ease. And then after that cut, they may hold off for perhaps even a year and only start to commence easing again in the second half of next year, when the growth picture starts to turn more negative for the US. But for now, growth is holding up well. The labor market data still remains pretty firm. So I think one slightly softer inflation print doesn't really move the needle from our perspective from the Fed.
Mm-hmm. So how would you look at the yield itself? 4.8 can be revisited, you think?
We've been talking about potentially even hitting 5% on the 10-year Treasury yield. And look, we weren't too far off that. Obviously, yields have dropped on the back of the CPI release. But it is likely that, given how much of a term premium has been built into the yield curve here and real rates moving higher, there's still, in our view, a risk, especially given the uncertainty around the inflation outlook and growth outlook and Trump's policies. We could still see yields potentially moving higher, even reaching that 5% level. But we don't necessarily see yields significantly higher. We also wait to see what's happening with the reconciliation in the US and whether there's going to be any spending cuts. And that's could have some implications for potentially lower yields further out. But for now, I think we're probably still going to be gyrating, and potential for 5% remains in place.
Okay. In which case, we haven't seen the worst of the dollar rally as well. Neeraj, what would your take be? A significant fall from the 110.1, but is that just a near-term relief?
I think it's a very temporary relief. I mean, to the point on US yields, I think the fact of the matter is that the latest estimates of US fiscal deficit are at around 7% of GDP. So that's still a very, very, bloated fisc as far as US is concerned. It basically means much higher, borrowing requirements by the US Treasury. Their funding cost is going to go up. And that's also going to put some pressure on the fisc. So I think all in all, whether it is the inflation or whether it is the growth or whether it's the fiscal, I think all fingers are pointing towards the fact that US yields will probably remain elevated. And I don't disagree with the assessment that it could potentially cross 5%. So if US yields continue to inch up higher, I think there will be pressure on dollar to appreciate, and that will lead to pressure on currencies like INR. So I don't see the in the near term, at least, the pressure on INR to abate significantly. And I think that basically means that Reserve Bank will probably have to continue to intervene in the market to kind of manage the volatility and manage the pace of depreciation that we are seeing at the moment.
Okay. Mitul, your thoughts, both on the dollar and the rupee. You think this peak to 110 is just a near-term peak and maybe even 115 is on the cards?
Yeah, I would tend to agree with Neeraj. I think ultimately this pullback in the dollar is probably temporary. The market perhaps had become a little bit overextended in terms of positioning and sentiment for the dollar. Obviously, the CPI has taken some of the steam out of the currency. But again, any pullback is probably temporary. We would still see a lot of the factors driving the dollar higher remaining in place. And that's, U.S. exceptionalism, as you highlighted, higher U.S. rates in terms of bond yields. And we're looking at that rate differential between the US and many, many countries, even with India, the 10-year US-India differential, the advantage India has narrowed to about 2%. And again, for the rupee perspective, similarly, any pullback in the rupee at this point, in our view, is still going to be a temporary pullback. I mean, again, it still remains relatively rich from a valuation perspective. We also see potential for more volatility, more flexibility in the currency under Governor Malhotra, and at the same time, outflows, FPI outflows have started to pick up again, and that's also adding a little bit more pressure on the currency. So again, if there's any real perspective of catching up with some of its peers, that still implies some further depreciation of the rupee in the weeks and the months ahead.
Okay, Neeraj, how would you read the rupee? We had the trade deficit number, which looked much more benign after the correction for gold. Even the earlier numbers have been brought down a bit. And plus, the RBI allowed on Monday and Tuesday the rupee to kind of find its feet. A fairly decent depreciation. Now the overvaluation which the November REER gave us, it was 8% overvaluation as per the 40-country REER. Now that looks, it must have been corrected, isn't it? So is there much more of a rupee fall?
I think it's not just about the overvaluation in terms of the real effective exchange rate, right? It's more about what's happening in the short term to the flows. You rightly pointed out that the trade deficit is not the concern. Current account deficit for this year is likely to be less than 1% of GDP. So that's actually very, very benign current account deficit situation for us. I think the issue is really with the capital flows. Till such time we are in the regime of stronger dollar, stronger US yields, basically, the US growth continues to be fairly strong, and which basically means that it is becoming the main area of investment for everyone. So I think the flows are moving towards US, and that is putting pressure on the capital flows, and that's kind of putting pressure on all the currencies and not just India. I would like to point out that the rupee's depreciation since November has been pretty much in line with what most of the major currencies have done. So it's not an exceptional depreciation that we are seeing at this point in time. But I think it's simply a question of when do we see the dollar strength to abate? When do we see the US yields to kind of settle down? When the rest of the world will start looking at emerging markets once again.
So can you all, both of you, leave me with some levels? First, Neeraj, what should we expect in terms of the rupee, say by March? I know there are big Trump-related announcements and events in between, but still, what would your rupee range be for March? First, Neeraj?
I think I would say that anything more than 87 to 87.5 at this point in time looks a bit difficult. I think we will see exporters coming to the market once we reach those kind of levels and forwards come off a little bit. But, it could be a very, very volatile period from here until the March end.
Okay. Mitul, your thoughts on both rupee range and dollar index?
Okay, I think, firstly on the rupee, I have to go with our official forecast, which at the end year we're 87. Now, obviously, we've come very close to that even before January is out. So you have to highlight here that potentially we may have gone a little bit too far too quickly. But as I mentioned, it doesn't mean that we're not going to see any further depreciation. I think that still looks like it's going to continue. Similarly with the dollar, I mean, if I really look at our global forecast with this dollar move has been, the right direction from our perspective, but it's gone very, very quickly. So even from a DXY perspective, again, we don't have forecast levels, but around here at 109, there is potentially, and I had a number of conversations with clients last week, and a lot of investors are looking for DXY to get up to about 113, 115 even in the next several months ahead. Again, as I say, it's not our official forecast, but certainly clients and investors are looking for DXY to continue to move into a higher range.
Yeah, that's the chatter I heard. And perhaps this question is difficult because there are binary events lined up. These are not normal events, so we don't know if there is an external revenue service that President Trump is talking about. It can seriously disturb both goods and services flow and therefore currency flow. Thank you very much, Mitul and Neeraj. This is an unfinished conversation. We will have more data next week, same time, and we hope to invite you again to get your views. Thank you very much for joining us. It's just that with the dollar rupee, we should not extrapolate just because there is a huge movement in the month of January. A similar pro rata movement for the rest of the year is not to be expected because the rupee always moves in jerks and jumps, and maybe a large part of this year's depreciation, or at least some part of this year's depreciation, is over. We'll have to wait and see. Wrap up on Bazaar on that note. Chartbusters coming up.
So I think for me, success, I think badminton has been my passion. So I would do anything to be successful or to be at the top class level.
Right.
Yeah.
So just the way you handle a victory, how do you come over defeat and failure?
Definitely, I mean, every athlete or every person goes through it. I mean, wins and losses, and I think ups and downs are part and parcel of life. It's important to let go. I know it does take time, and it is easy to say, but I think it's not just end of the world. When you lose a match, you get to learn a lot more, and you need to come back stronger. That's what I've believed in, because I've had toughest matches where I was nearly there and then I just missed it out. But I think I've learned a lot from that, and for me it was very important to believe in myself and have that hope that I can do it again.
Right. So what's the Sindhu way of coming out of the defeat, getting your mind back on track? What's the mantra you follow?
Well, I mean,
you could tell us after any match that you remember which was very close to your heart and was difficult to get over.
Yeah, recently, I think, not recently, but Tokyo, I would say, where my Olympics, the second Olympics, I lost in the semi-finals. And of course, it was very, very hard. but I had mixed feelings, mixed emotions where, I was feeling bad, where if I have to think I lost an opportunity, I lost a chance to go to the finals. And on the other side, I was thinking, do I have another opportunity to play the bronze medal match? So I was like confused, I was upset, I didn't know what to do. I just had that, I would say, less than 24 hours to decide and come back stronger. So I think that was the perfect example that I could remember and tell you now, because it was really hard at that point of time, because
HDFC Life rallies 10% on the back of a strong third quarter performance. VNB margin beats estimates. Brokerages HSBC, Jefferies, CLSA also issue bullish calls on the stock.
L&T Services also rallies 8% after an inline Q3, which sees its highest ever quarterly deal bookings. The management tells CNBC-TV18 that the pipeline is better on a sequential and on a year-on-year basis.
CEAT comes under pressure following a weak third quarter. Margin declines 380 basis points due to higher raw material costs. EBITDA also declines about 18% from a year ago.
Paytm jumps more than 6% after brokerage firm MK upgrades the stock to buy rating and raises its target price to 1,050 rupees from around 750 rupees earlier. They are citing reasonables as well. Valuations are reasonable.
Adani Group stocks rally as Hindenburg Research's founder Nathan Anderson announces the disbanding of the firm, whose reports sparked heavy short selling by investors and investigation by authorities.
Hello and welcome to Chartbusters. I'm Nigel. With me is Mangalam, and as we speak, the markets are doing quite well, holding with the positive start that we saw. Nifty up 100 points. The good news is the Nifty Bank, that's done a relative outperformance in the last couple of trading sessions, and today as well. That's up close to around 500 points. Hey, Mangla.
Hi, Nigel. An imminent bounce, right? One would say, because the last two trading sessions, the Nifty has managed to make higher highs after 9 sessions of making lower highs itself. And today is also the weekly options expiry. Does it sustain above that 23,350 mark and perhaps pave the way for some short covering or not? The answer to that lies in the second half, where there has been a lot more volatility, as we've seen in the last few trading sessions as well. The mid-cap index tells you that there may be support at the lower levels as well, with 2,000 stocks advancing for about 338, which are on the lower end of today's trading session. But we're not the experts here. The expert is Sachidanand Utekar of Trade Bulls, who joins in for a quick technical check on the market. Sachi, do you think we've made a near-term support, or so to say a bottom for the market from here on, where we move higher, or after this big decline, this is just a bounce that needs to be sold into?
Good morning, good morning, Rachel. I think it's too early to call it as bottom, but definitely, we have started trending about 23,350 kind of a zone, and we need a confirmatory close about this particular level for the markets to really show a short covering move. So as of now, I think it's too early, but if you look at today's data itself, I think the most critical point would be a swing close above that 23,350 mark on the higher side. Else, we may see Nifty again, gyrating within the range of 23,200 on the lower side and 350 on the higher side. When we look at Nifty Bank, I think it is one shade better. It was one of the most beaten down index, and here I think the short covering move could be interesting. I think the immediate support is placed somewhere close to around 49,000, and on the higher side, the level has shifted back to 50,000. So probably we may see an extended move here. But when we look at Nifty FMCG, I think that particular index has given a fresh breakdown. It was managing itself about that 55,800 mark for the last couple of weeks. But the way that particular level has been breached, the next probable support is placed somewhere close to around 52,800. So I think Nifty FMCG has given a fresh breakdown, which could pull the Nifty lower.
All right, and individual stocks, what would you back right now?
Mangalam, at the beginning of this particular week, we did highlight the short setup in Titan, somewhere close to around 3,400. We are retaining that view. We are expecting that there could be fresh weakness, which could push the stock towards 3,160.
And even at this juncture, we are recommending fresh short positions, keeping a fresh stop loss at around 33.40 on a closing basis. The other stock on our radar is Britannia, which is also on the short side. What we have seen here is that there's a classic bearish flag formation. There has been a fresh breakdown in today's session. 4900 was a critical mark on the higher side. That particular resistance is still holding. So we may see further selling in this particular counter, which could eventually push it towards 4500. The immediate target is placed at 4680. So we are recommending fresh shorts here with a stop loss at 4860.
Okay, all right. Thanks a lot for that, Sachi. Well, let's move to our special segment where we get you a few ideas of profit from Money Control Pro. Varsha of moneycontrol.com joins us to talk about a stock that she's tracking closely. Varsha?
Today we are going to talk about Welspun Living Limited, a leading player in home textile segment which caters across 60 plus countries. The company focuses on three key segments: home textiles, advanced textiles and flooring solutions. Welspun targets mass market consumers with its Welspun brand and premium offerings through Spaces. This approach aims to strengthen its B2C presence by expanding its multi-brand outlets from 20,000 to 50,000 and increasing its exclusive brand outlets from 32 to 400 by FY27. Welspun leads the US market share in bedding and terry towels, making its largest home textile exporter. In Q2, the company has announced a Phase 2 capex plan aimed to expand its bedding production and tower loom. This new capacity is expected to become operational by Q3 FY27. The company is well positioned to leverage shifts in global trades, particularly due to the effects of Trump trade restrictions on China and ongoing challenges in Bangladesh, which may enhance export opportunities. From a valuation standpoint, the stock is currently trading at 15 times its FY26 earnings, which looks attractive.
All right, with that, we'll take a short break. On the other side, Ashwini Kumar, the Managing Director and CEO of UCO Bank, joins in to discuss their third quarter business updates and much more. Stay tuned.
You lost the semi-finals and you lost the opportunity to go to the finals and get a gold or a silver. Rather, you have another opportunity to prove yourself, right? So, yeah, I mean, my coach and my parents just told me that there's a lot of difference between the fourth and the bronze. So, at that point of time, my mindset was like completely like, I was like, no matter what. I couldn't even sleep that night because I had a match next day in the morning. And obviously, I just gave my 200% and I got that bronze back. So,
right, just come back harder. Just come back
yeah,
even harder.
I think the belief is very, very important. Just believe in yourself.
BB, we'd also like to ask you about this debate over 70-hour, 90-hour workday. It's a rage on social media. People have different views about productivity, not being forced into 90 hours. Rajiv Bajaj has said that if you want to work 90 hours, it should really start from the top. And if it's successful, then implement it. And it's not really about the number of hours you work, but about the efficiency and productivity you show. What would be your view?
I would not say this is right and this is wrong. My only thing would be, you know, how many hours ever it is. I would say it needs to be useful and there need to be a good change in whatever you do. I think that is the only thing I can say because talking about hours, I think people ask me how many hours do I play? You know, is it important that you play so many hours or is it important that you play only for a few hours? So even that debate keeps going on at times. But whatever it is, it needs to be in a very smart way and it needs to be very useful for everyone. And everyone needs to be happy at the end of the day. That is it.
My final question, what do you think India as a country can do more in terms of encouraging sports and making sure we do better at Olympics year after year? Athletes like you work very hard. It's a tough journey. You go through injuries, defeats, failures, bounce back again. It's a constant journey. But what can we do to have a greater sporting culture all the way from top to the bottom or from bottom up?
I think it's very important that you have a very good system.
Welcome back. You're watching us here on Chartbusters. The stock on our radar is UCO Bank. Why is that? Because the company, one, reported their third quarter updates, but secondly, we understand from sources, our correspondents have found out that the government may look to cut excess stake in public sector companies and also has okayed a 2,000 crore rupee QIP for 5 PSU banks, including UCO Bank. Additionally, very recently, CARE Ratings also upgraded its ratings on the long-term bonds of the bank. So to discuss this and more, we do have with us Ashwini Kumar, who's the Managing Director and CEO of UCO Bank. Thanks a lot, Mr. Kumar, for joining in. Let's first talk about this itself. Have you gotten an approval from the government to go ahead and raise these 2,000 crores? If yes, then could you give us a sense of the timing of the same, whether this happens over one tranche, multiple tranches? Have you had a word with any sort of institutions, etc.? What's the update on this?
Good morning and thank you very much for having me on the show. Yes, we have got the approval from Government of India to go ahead with the QIP plan of raising 2,000 crore. Our plan is to go in the one tranche after this quarterly audited results. Then we'll go to the market and we'll have a road show and discussion. Preliminarily, we have started discussion with some of the investors and hopefully after the quarter end, we'll come out with the QIP.
All right, so a 2,000 crore QIP after the end of the quarter, for which you've already begun early roadshows and started to speak, to some of the institutional investors, etc. If you could give us some color on, what the nature of those investors could be. Are they domestic? Are they foreign? And also at the same time, what does this do to your overall books when it comes to your capital ratios? And you were targeting CD ratio of about 75% as well. So if you could give us a sense on whether you've managed to mobilize those deposits.
See, currently we are talking to the domestic institutional investors and we are yet to go for overseas roadshows. And with this, we'll have around 3% reduction in the government stake. Currently, government stake is 95% in our bank. And with this, 3% stake will come down 92%. And second thing which you spoke about was the CD ratio. A year before, our CD ratio was around 64%, 65%. Now we had given a guidance of 75% of CD ratio, which as per the provisional numbers for December quarter, we are very close to 75% of CD ratio. And the deposit growth during December quarter was 9.37% and advances growth was 16%. Our guidance for deposit growth was 8 to 10% and advances growth was 12 to 14%. So third quarter provisional updates are that both the numbers are above the guidance which we have given.
Okay, all right. Hi, Mr. Kumar. Good morning. Good to see you. When you met DFS yesterday, right? What was the discussion about?
A discussion was more on government schemes, financial inclusion, how to improve our financial inclusion, the outreach. That they were the more discussions were on that front.
Okay, all right. And any expectation of PSU banks?
See, PSU banks are always there to achieve the government financial inclusion targets. So we'll continue to work in that direction.
But any kind of roadmap has been laid, anything with regard, you're looking to raise money, the stake will come down to 92%. Anything you want to tell us with regard to privatization of the bank that you're heading?
No such news, no such discussion, nothing.
Okay, all right. Let's get back to the operational performance then. You've got a ratings upgrade, I think, from CARE that came in on your Tier 2 bonds. Could you tell us how does it help in terms of cost of borrowing? I mean, how much does it come down? What was it? What does it come down to?
We are yet to go for raising the long-term bonds, but definitely with the upgrade in the rating, the cost of borrowing, cost of raising up bonds will definitely come down. At an opportune time, we'll go to the market for raising the bonds. Still, we have not yet planned finally when to go.
All right. Just a couple of more details if you could give us on your third quarter provisional update itself. You said that you're on advances and deposits, both of them, you've actually beaten your guidance of 12 to 14% advances that you had given at the start of this year itself. If you could give us some more sense on how the quarter has panned out when it comes to your cost to income ratio. I remember you were targeting that to come down to between 55 and 60%. Also NIMs, how have they been? Will they be between this 2.9 to 3% band as well, which you're targeted? And a word maybe on the asset quality as well. What should one expect?
See, the final numbers are under audit.
Yes.
Once the audit is over, then we'll give you the number. But let me give you the color that September we achieved 3.10 of NIM. Our guidance was 2.90 to 3, and we achieved 3.10. So I believe that we should be within the range whatever guidance we have given for December quarter. And cost to income ratio also, whatever guidance we have given, we are working in that direction to achieve that less than 60%, and we're moving towards 55%. Last quarter, if my memory serves me right, it was around 56%. So we should be in that range only in this quarter.
All right, Mr. Kumar, could you tell us how many accounts do you have in under NCLT, and what could the recovery number look like?
See, we have given a guidance of a recovery for the full year around 3,000 crore, and the numbers are in line currently. And once the final number are out, I think this is very critical information I'll be able to share with you once the numbers are out.
All right, you said that you will give us some color. Obviously, the final numbers are not yet out. The gross NPAs would be around 2.75, and net NPA you expected it to reduce from 0.09%. And also, you know, slippages would be about 1% in terms of slippage ratio. You would broadly be around these guided numbers itself that you said,
yes,
right?
Yes, team is working, and we are very closely, each day we are following. Our guidance was that slippage should be in the range of 1 to 1.25%. It will be in the same, we are working in the same direction. Our gross NPA has been coming down. Last quarter, we closed at 3.18. And with the recoveries and upgrade in this quarter and slippages which are controlled, so I believe that we should be achieving that number which we have given guidance at the start of the year.
All right, take that point. Thank you so much for joining in and being so candid with us when it came to, you know, your fundraising plans with your quarterly performance, etc. as well. The street would keep an eye out on that, more so because after the end of that quarterly result, you will have a bunch of investors looking to invest in your company via the QIP for 2,000 crore rupees itself. The street likes what you've said. The stock up around 3.5% after this conversation. With that, what we'll do is slip into a short break. And as we do that, here's some good news for you viewers. India's business news leader is now just a click away on Nigel's right. As you can see, it's the app, the CNBC-TV18 app. You can get instant access to breaking news, in-depth financial articles, also all the updates coming from the world of business at no other than just your fingertips. What you got to do is just download the CNBC-TV18 app from, depending on the OS you use, from either the Apple Store or the Google Play Store. Or what you can also do is there is that QR code on your screen. Just go ahead, scan that, and the app comes onto your hands. Everything at your fingertips.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
Important, and I think everything needs to start from the grassroots level. Not that when you come to a certain level, people then say that, okay, you know, we need support or we need the infrastructure or everything, but it needs to start from the grassroots levels. And I think I'm happy to say that we've been getting a very good support from the government, and there've been good support from the sports authorities. At the same time, I think there needs to be a lot more leagues happening so that, you know, there are a lot of youngsters who are doing really well, but, you know, not able to prove themselves. I think leagues, now if you see there've been Coco, and then there've been tennis and pickleball, a lot of leagues are coming up, and I hope there will be a lot more in every sport, because these kinds of leagues, you know, a lot of people get a recognition in terms of, you know, they get to see a lot of athletes who take them as an inspiration, and prove themselves and have that confidence that yes, even we can do it, because a lot of people are doing really well, are working hard, but they're not getting that opportunity or not able to have that platform where they can prove themselves. So leaks that like these will definitely help them to come up and think that yes, we also have something to actually look up to.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 Budget Headquarters as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Testing. Welcome back. The stock that's been in focus for the last couple of trading sessions, it comes up yet again. Kalyan Jewellers, that's the one we should pull up. Actually, let's pull up that stock on your screen. From the highs of the day, the stock has seen a sharp downtick. It's moved into the F&O band. It's been getting pummeled on a day-to-day basis. I think the last 7 trading sessions, the stock is down close to around 40% or thereabouts. So big downtick. The question will be, post the results that come out on the 30th of January, will the promoter entity come in and support the stock? Is there something more that they can do? And the second factor is, what about their pledge? They have 62% stake in the company, but 20% is pledge. So that's going to be important. So that's one stock that we're looking at. On the flip side, IRFC has moved to the high point of the day. BHEL as well has bounced back in trade, and a couple of these PSU names, they were getting pummeled earlier, so they in fact have pulled back. Even Coal India Mangalam has moved to the high point of the day.
We'll keep an eye out on that, and Kalyan in particular, the management held a conference call. They also, joined us on our channel, and the kind of questions that analysts are posing are more around corporate governance issues or questions around inventory overvaluation or others as well. Obviously, the analyst community, there has been no note on any glaring issue out here. Whatever has been hearsay. And on what there is, we've asked the management questions and they've clarified. The question is that despite this clarification, there has been a lot of selling pressure on the stock. We need to understand what exactly is playing out here. So we'll most definitely keep an eye out. Remember, after a good third quarter update, the company did see a bit of an up move, and from there itself, there was sell-off. Valuation was discomforting. But still, this kind of move tells you that perhaps there could be a little more selling pressure than what fundamentals indicate.
And it's a double-edged sword, right, for those funds that got in there, because it helped their NAV. And now, in fact, it'll be a bit of a drag as well.
Interesting part, just to end that point, the last time the F&O stocks were updated, Kalyan Jewellers was a part of that. So that gives it further, room for people to go ahead and make short positions while it is in F&O.
Well, time to wrap up on the show. On Chartbusters, stay with us. Trading Hour comes up next.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
साथियों आज
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer. It's almost 23,300 on the Nifty as the benchmark indices gain close to about 0.3%. The bulls have seized control of the mid-cap index. The mid-cap index outperforms with a gain of 1.3%. And the mid-cap index has been rising for the last 3 trading sessions. And in that, they've pretty much erased Monday's manic loss of 2,000 points. On Monday, we fell nearly 2,000 points, and that has been covered up in the last 3 trading sessions. Lots of factors aiding the bullish momentum, the Wall Street rally, the easing of the dollar index to levels of 109, the ceasefire in Gaza Strip, and then all eyes will be on Reliance, Infi, and Axis. So it's a big earnings day for us.
Absolutely right. Good morning, Reema. Like you mentioned, rally aided by the global cues. The Nifty Bank Index is one that's comfortably outpacing the benchmark Nifty Index today, and that's something that's actually giving quite a lot of leg up as far as the entire BFSI space is concerned. You spoke about the mid-cap, small-cap index. Let's look at some of the individual names today that are doing quite well. Look at the life insurance pack. A good set of numbers coming from HDFC Life. The VNB margin was a beat to estimates. The entire pack, so HDFC Life, SBI, Maxfin, ICICI Prudential, all of them doing quite well in the session. Another interesting stock, one that we've been discussing, over this particular week itself, is Kalyan Jewellers. Remember, today the stock entered into the F&O ban, but this fall over there has still extended. Today the stock is down another 5%. So concerns linger as far as Kalyan Jewellers is concerned. And the only set of stocks that are seeing a bit of profit booking today is the entire FMCG pack. In fact, quite a bit of a sell-off. Some of the names are down to 2.5%. Names like Colgate Palmolive, HUL, Tata Consumer, these are some of the stocks that are seeing some profit booking in today's trading session.
Even Devyani International, so some of the QSRs too are correcting after yesterday's move. But let's talk about life insurance, and in particular HDFC Life, because those earnings have fired up the entire sector. Yash is here with the earnings fine print for HDFC Life. Yash?
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates in terms of specific numbers. For new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3,569 crore rupees. Retail APE again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Thank you very much for that. Now let's get to L&T Technology Services, because that's another big mover, 8% higher. Let me tell you 5 reasons what's excited the street. 1, the FY25 organic revenue growth. So, here's the picture. In terms of the guidance, the earlier guidance was 8 to 10%. Now the company is saying organic growth will be 8%, including the acquisition, we'll get to 10%. So some people on the street believe that, well, the organic revenue growth guidance has been tempered a bit, because earlier it was 8 to 10%. Now it's going to be at the lower end of 8%. But here, what I would like to say is that analysts, most of the people on the street expected the company to do that. In fact, there was a Kotak estimate which said 7 to 8%, because after the H1 performance, it just looked difficult for the company to achieve the top half of the guidance, the top end of the guidance. So that, therefore, is not a negative. Secondly, the stock has underperformed. Taking into account today's up move, it's still down 13% from its all-time high levels, and therefore the valuations now, according to CA Motilal Oswal, are fairly attractive. The stock is trading at about 28 times forward multiple. Q4 numbers, in the Q3 numbers, the company reported the largest ever deal wins. In the first half of the year, the deal wins were subdued, and even going ahead, the company spoke about a broad-based growth, which means all the verticals, whether it's tech, sustainability, mobility, all of them will show good growth in Q4 and FY26. They even spoke about FY26 being better than FY25. And the fifth reason is this is a company which has less exposure to automotive. So CA KPIT Tech has 100% exposure to automotive. Tata Elxsi has about a 50%. This company's exposure is 30 to 33%, and automotive, particularly in Europe, is slowing down. So therefore, in a way, it's less at risk from the slowdown there. And even their mobility segment, I've written it as automotive, but it's actually mobility. But that also has railway, aerospace, off-highway trucks, which is doing quite well. The management commentary also, as we said, was positive. The company spoke about the pipeline being better quarter on quarter and on a year-on-year basis. The demand environment is today is better than what it was a year ago. FY26 to be better than FY25. Q4 margin should be at similar levels to Q3. Comfortable to say all the 3 segments will grow, and they're maintaining their medium-term aspiration of hitting $2 billion of revenues and margins of 17 to 18%. In fact, we did chat with Amit Chadda, Managing Director and CEO of the company. He's also the NASSCOM Executive Council member. Listen to what he had to say.
Our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year, or 16.2 that we've got. And I do see Q4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee bids. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
Well, a very interesting conversation that you had with L&T Tech, and the stock, like Rima mentioned, doing very, very well. Well, let's now dive into the growth code. We have Abhishek standing by. Abhishek will take us through the Paytm note that MK has written today. Abhishek, what are the key highlights of that particular development?
Well, MK has upgraded Paytm to buy from at. They have increased the target price to about 1,050 per share from 750 that they had earlier. They say that the recent NPCI approval in October 24 has released a major regulatory overhang on the company. So this should help the MTU base get built up again over the next 12 to 18 months. The cross-sell retail financial products like home loans, insurance and wealth products, that will help in improving the revenue per customer or per user for them. So Paytm may be on early path to profitability by FY26, post which profits will keep on increasing as per their estimate. They also say that Paytm's cash to market cap ratio is at 21% when compared to 5% for Zomato. Now this provides strong margin of safety for investors. So additionally, a further easing of regulatory stance via potential approval for payment aggregator license, that could be another positive catalyst as per MK for Paytm. Back to you.
Thank you very much for that. That's a big move on Paytm, 6% higher. Now let's dive into the growth code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, Nigel interviewed Praful Kulkarni, founder of Alpha Leo Capital, to understand why traders must learn to avoid the noise in the market.
Any practical tips for the traders? How can they stick to their strategy and avoid overreacting to news?
News, I think it's a very important question, because most of the people overestimate their ability to judge the exact outcome of the markets to the news. Two things here. One, we need to understand that we don't have the capability to exactly judge what would be the possible outcome or how would exactly market react to the news. And the second thing is, we need to understand that we are at the bottommost layer of the information chain. By the time you get the news, understand that the game is already over, you are late to the party. And at the same time, since you don't have the capability to take such big bets and sit through the ups and downs, and you don't have the capability to exactly judge how the market's going to react, I would say retail traders are better off not looking at the news, and they would just have to stick to their strategy by completely eliminating the noise.
समुद्री विरासत नेवी के गौरवशाली इतिहास और आत्मनिर्भर भारत अभियान के लिए भी बहुत बड़ा दिन है। छत्रपति शिवाजी महाराज ने भारत में नौसेना को नया सामर्थ्य दिया था, नया विजन दिया था। आज उनकी इस पावन धरती पर 21वीं सदी की नेवी को सशक्त करने की तरफ हम एक बहुत बड़ा कदम उठा रहे हैं। आज भारत पूरे विश्व और खासकर ग्लोबल साउथ में एक भरोसेमंद और जिम्मेदार साथी के रूप में पहचाना जा रहा है। भारत विस्तारवाद नहीं,
Welcome back to Trading Hour. Well, Axis Bank is in focus ahead of its Q3 earnings today. Abhishek joins us with more details.
Well, it's expected to be a weak quarter for Axis Bank. Our poll suggests the NII growth on a YOY basis may be one of the lowest that you are seeing in last 13 quarters. Now, deposit and advances growth will be seen closely. Now, Citi estimates deposit growth of 11% YOY and 3% quarter-on-quarter, which is higher than the industry average, while they estimate, advances growth of 10% YOY and 2% quarter-on-quarter, which is lower than the industry average that we had as per RBI data at the end of December 24. So net interest margin may decline both YOY and quarter-on-quarter. Kotak Securities estimates 11 basis point decline in net interest margin YOY and about 4 basis point on a sequential basis. Slippage is expected to rise quarter-on-quarter. Again, Kotak Securities estimates a slippage of 5,000 crore versus 4,400 crore in the previous quarter. So asset quality expected to deteriorate. Citi estimates gross NPA ratio to increase by 20 basis point quarter-on-quarter and net NPA ratio to increase by 10 basis point on a sequential basis. Provisions can remain elevated, thereby impacting the earnings momentum. Again, Kotak Securities estimates 198% gain with respect to provisions rising on a year-on-year basis and 5% increase on a sequential basis. Near-term, loan growth outlook and deposit growth outlook will be seen closely. Deposit is becoming a challenge for the sector. Our poll suggests NII growth of 9% YOY and about 1.5% sequentially. We are working with a profit growth of 3.5% YOY and a decline of more than 9% quarter-on-quarter. Back to you.
Thank you very much for that. It's a big earnings day. All eyes will also be on Infosys. Those numbers typically come out by 4:15, 4:30. Now, we're expecting a revenue growth which is about flat in dollar terms, but in constant currency terms, it should be a growth closer to 1%. Margins likely to expand 20 basis points to 21.3% and a marginal 4% jump in the company's profitability. But these are the numbers. All eyes will be on the guidance. Now, the current guidance stands at 3.75 to 4.5%. The big question is, does the company revise the upper end of the guidance? The upper end stands at 4.5%. Can they push it up to 5.5%? Margin guidance is likely to be maintained at 20 to 22%. What will the street watch? Well, recovery in discretionary demand, because so far all the IT companies, whether it's TCS, we even heard L&T Technology, they're all talking about discretionary demand being better, the situation being better than it was 3 months ago. Also for Infosys, wage hike, timing and the implications, the FY26 outlook and commentary on important verticals like BFSI, retail, high-tech will be tracked very closely.
Thank you so much, Rima. Another busy day as far as IT earnings are concerned.
We've got LTI Mindtree also, not to forget.
Well, let's now slip into a short break. When we return, we'll discuss market technicals with Vishal Malkan and also discuss his top trading bets.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
विकासवाद की भावना से काम करता है। भारत ने हमेशा ओपन, सिक्योर, इंक्लूसिव और प्रॉस्परस इंडो पैसिफिक रीजन का समर्थन किया है।
Welcome back. All eyes will also be on Reliance Industries as it reports its numbers. Well, first, let's get you through the key expectations. The revenue growth is likely to be flat on a quarter-on-quarter basis. But the key that the street is going to be watching will be the margin performance. Margins are likely to go up for the company. The absolute EBITDA is seen up 8% and margins at 18.4%. And this will drive a jump in the company's profitability. Now, what's going to drive the company's margin performance this time around? Well, first, the oil to chemical business, which has been subdued so far, is likely to recover. Secondly, this would be the second consecutive quarter of a strong performance for the telecom business and retail, where there is a continuation of the festive demand. But those gains, all these gains, will be offset by some pressure that we are seeing in the upstream side of the business, where the production is likely to decline. Particularly on oil to chemicals, the refining margins, that's a number we track very closely, and that, according to some estimates, is likely to rebound to $7.6 per barrel versus $5.6 per barrel, not billion, and this is on account of the recovery in the Singapore GRMs. For the telecom companies, there was a tariff hike which they undertook in July. And usually, whenever there is a tariff hike, it takes about 2 to 3 quarters for the full pass-through to take place. So for the telecom business, even Q2 was strong. We had about, a 7 to 8% revenue growth. The ARPUs went up 7 to 8%. And this would be the second consecutive quarter, which will benefit on account of that. So a top line growth of about, 4 to 5%. Margins are likely to inch up even further, expanding 100 basis points. So that's going to be driving the telecom business. The street is increasingly turning optimistic on Reliance Jio after underperforming last year. Last year, in 2024, was the first year in 9 years that Reliance Industries gave you a negative return. But now analysts are pointing out that valuations are attractive. There are triggers like a potential Reliance Jio IPO. So that's one. But even in terms of the pure business, the refining business, the oil to chemical business could recover. Telecom could have a stable year. Retail, they're hopeful things will recover because the base is low. Even if the consumption doesn't pick up, but just purely in terms of the base effect, you could see maybe a double-digit growth. So even fundamentally, analysts are now turning positive. And if the Jio IPO happens, then that's the additional
significant value unlocking trigger is what the street will look forward to. Reliance Retail, Reliance Jio, value unlocking triggers could lay ahead. Well, moving on, Vishal Malkan from malkansview.com joins us for a quick technical check on the market. Thank you so much, Vishal, for joining us. There's been a bit of a strong bounce back as far as markets are concerned. Do you think this particular bounce can sustain? And what are your view on Nifty as well as Bank Nifty?
Yes, I think we are in that time zone when typically market makes an important move in this second, third week of January, which we have seen in the last so many years. And Nifty finding its feet around 23,300, 200, testing those bottoms couple of times in the last couple of months with some bullish patterns, and especially today with some volumes. So I think this bounce can sustain, and we can look at targets of 23,600, 700 in the next few trading sessions. And going forward, it can be higher also. My stock picks for today would be, the first one would be India Cement, which I think has made a very strong consolidation at this 375 levels. So I'll go with a buy on that with a stop of 370 for targets of 385 and 395. And the second one would be Hoodco, which is also making good support and patterns on daily as well as weekly chart with a stop loss of 218 for targets of 235 and 245 in the next few trading sessions.
Thank you very much for that. By the way, Hindalco and Nalco are pushing higher, and there are reports that China has capped the aluminium production, and therefore prices, may go up. And that's the reports which are doing the round for the last 1 hour, and we've seen the stocks of Nalco and Hindalco inch up.
Even Vedanta for that matter, that's up almost 3.5% as well. Well, we'll now take a quick break. Up next, we'll discuss market fundamentals with Sahil Kapoor from DSP Mutual Fund.
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price hikes. And even the retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, Jio and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Jio too, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember...
Welcome back to Trading Hour. Well, Reliance Retail too is expected to report its Q3 results today. Mangalam joins in with what the street is expecting from this particular vertical from Reliance Industries.
For the third quarter for Reliance's retail business, because of muted consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially, growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, quarter 4, quarter 1 and quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins, and we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year-on-year growth in the EBITDA and 8 to 9% growth quarter-on-quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll, which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Yusta and Swadesh, and finally their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
Thank you very much for that. Need to get into a break, but as we do that, here is some good news for all our viewers because India's business news leader is now just a click away. We're introducing the CNBC TV18's all-new app. You can get instant access to breaking news, all our in-depth articles, financial world updates at your fingertips. So don't wait. Download the CNBC TV18 app from the Apple Store or the Google Play Store, or just scan the QR code on your screen.
Story that you would like to tell?
No, right now my laser focus is on my next film and preparing for it. And the new story I want to tell is Irish cricket, Scottish cricket, and cricket from the Netherlands. It's exciting me. It's something new, It's like this new toy I've got my hands on. I'm really looking forward to it. I can't wait to start working on it. I've never been the kind of person who's very good at just going and waving my hand. I'm somebody who likes to get down on all fours and get dirty and really work.
Be in the trenches.
Oh, I love that.
hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter the overall subscriber base declined by more than 10 million on a sequential basis. Perhaps as you know, the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will watch. But remember, the stock has been a bit of an underperformer. So last year, Reliance Industries share price declined for the first time in 9 years, and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptick. Even the telecom business is likely to see telecom, stable. Tariffs, retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
For the third quarter for Reliance's retail business, because of muted consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, quarter 4, quarter 1 and quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins, and we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year-on-year growth in the EBITDA and 8 to 9% growth quarter-on-quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll, which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Yusta and Swadesh, and finally their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
Safe.
Welcome back. Let's get you a CNBC Awaaz exclusive. Now, sources say the cabinet may soon approve an increase in ethanol prices. It's an important story. Lakshman Roy of CNBC Awaaz is now with us with the details. Lakshman.
देखिए, जो मुझे सूत्रों से जानकारी मिली है उसके मुताबिक सरकार एथेनॉल को बढ़ावा देने के लिए जल्द ही एथेनॉल की कीमत बढ़ाने के प्रस्ताव को मंजूरी दे सकती है और ये प्रस्ताव बहुत जल्द कैबिनेट में लाया जाएगा और कैबिनेट से इसे मंजूरी मिलने की संभावना है। जो प्रस्ताव है उसके मुताबिक एथेनॉल की 3 अलग अलग कैटेगरी होती है। इसमें बी हैवी मोलासेस, जो एथेनॉल हैवी मोलासेस होते हैं जिससे एथेनॉल बनता है, उस बी हैवी मोलासेस की कीमत में ₹1.82 प्रति लीटर की बढ़ोतरी की जा सकती है और अभी इसकी कीमत ₹60.73 उसे बढ़ा करके ₹62.55 की जा सकती है। बी हैवी मोलासेस वो होता है जब गन्ने से चीनी निकाल लिया जाता है तब भी कुछ गन्ना में चीनी बची रह जाती है तो उसको बी हैवी मोलासेस कहते हैं। इसके अलावा जो केन जूस है उससे जो एथेनॉल बनेगा उस केन जूस में की कीमत में ₹1.31 की बढ़ोतरी संभव है। अभी फिलहाल ये ₹65.61 प्रति लीटर है, उसे बढ़ा करके ₹66.92 प्रति लीटर किया जा सकता है। उसका सी हैवी मोलासेस होता है जिसकी कीमत अभी ₹56.28 प्रति लीटर है, उसे बढ़ा करके ₹63.15 प्रति लीटर किया जा सकता है, यानी करीब ₹6.87 के आसपास बढ़ोतरी की जा सकती है। ये जो बढ़ोतरी होती है वो चीनी कंपनियां जो एथेनॉल ऑयल मार्केटिंग कंपनियों को बेचती हैं उनके लिए होती है। ऑयल मार्केटिंग कंपनियों को इस कीमत पर ये सारी एथेनॉल खरीदना होगा जिसको पेट्रोल में ब्लेंड कर सके। तो ये कह सकते हैं कि एथेनॉल बनाने वाली कंपनियों के लिए ये एक अच्छी खबर होती है। कई कंपनियां, चीनी कंपनियां नहीं भी होती है लेकिन एथेनॉल बनाती है, वो अगर ऑयल मार्केटिंग कंपनियों को बेचने जाएंगी तो उनको ये कीमत मिलेगा। कीमत बढ़ाने का मकसद ये है कि एथेनॉल के उत्पादन को बढ़ावा दिया जाए।
Well, a very important story coming in from our colleague at CNBC, Awal Lakshman, telling us that there could be a hike as far as B-heavy molasses prices are concerned. But moving on, Sahil Kapoor, market strategist at DSP Mutual Fund, joins now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, Sahil. First up, you've come out with a very interesting report where you've actually said that equity returns have, apart from a few countries, have actually lagged even US bond market returns. So first up, going into 2025, given the kind of outperformance that we've seen in equity markets over the last couple of years, how are you positioning yourself and what is your view as far as equities are concerned?
So if it is about 2025, I think it's very hard to say how the year will go. The only data that we have, or at least we had just a few months ago, was that equities were not priced cheap. When you look at equities as a whole, when you look at Indian equities, if you take, let's say, NSE 500 as a basket, it was trading at about 28 times trailing earnings, price to book of more than 3.7 times. These are not cheap numbers. Earnings growth, which was by the end of March 24, averaging about 22% CAGR over the last 4 years, is now on a YOY basis struggling at about 7-8%. So when you look at the aggregate ROE number, it's about 15%. So anything which has an ROE of 15% but grows at 7-8% is going to be very hard to justify a multiple of 28 times. So I think from a, let's say, next few quarters perspective, it makes sense to be conservative. Maybe 25, 26, unless you see cheaper equity prices, it's very important to look for value, look for margin of safety, and possibly exercise conservatism.
Sahil, I was quite interested to read about the 7 market myths that you've debunked in one of your reports, which goes on to say that if GDP rises, which means if India's economy is growing, we're going to get to Viksit Bharat, then there is no other way but for the markets to move up, and many others. So take us through the 7 myths and what is the reality?
So maybe we'll pinpoint a few which are very important. First is that I think there is a lot of narrative fallacy and a thought that if GDP is going to go from X to Y, market cap should replicate that. And just to put 2 facts into these numbers, first is that when you look around globally, you will find that in most instances, it's not the case. There are countries where GDP has multiplied by a factor of 10, but equity markets have delivered returns which are negative. Case in point is our neighborhood, China. And there are many other. I mean, you could take a look at, let's say, Malaysia, Indonesia. For that matter, look at many European countries, you'll find very similar numbers play out. The only thing is that when you go back in time and look at data, you look at the US market and you look at the Indian market. Both of these markets have performed fabulously well. What it does is it creates what I call the problem of induction. You look at the last 25, 30 years for India, you look at the last 150 years for US, and you end up thinking that equity markets will always give you fabulous returns, which is true for these 2 countries. But unfortunately, it's not the case in many other countries. And therefore, if data falsifies that even if there is one country where GDP growth has not translated to equity returns, I think it is enough to burst this myth that GDP is equal to equity returns or GDP growth. Second thing is that, then what is more important, and which I published the second myth, that what is more important in terms of equity returns, or you could say, why has India outperformed if it is not about GDP or policy making, etc. So one very important factor is what is the return for shareholders? And there comes a very important distinction. When you look at the US market, almost 39 to 40% of companies in US from S&P 500 have delivered ROEs of more than 20%. So this means that there is a large shareholder return being delivered to shareholders in the United States. And the second country, which is India, 1/3 of companies in India have delivered a ROE of more than 20%. Now, this is a great outcome, and we think that this is one of the most important reasons why India has delivered for a very long period of time. And I would choose managerial and entrepreneurial sagacity, their ability to navigate cycles over any other narrative of, let's say, GDP growth or any other numbers. So the crux of the matter is that managers and promoters in India have been able to deliver shareholder returns. And that is the reason why India has outperformed for a very long period of time, not only because there is a growing construct. And for that matter, we've shown in data that a country like Brazil, where the last 30-year GDP CAGR is only 2.5%, has actually delivered one of the highest dollar returns globally. So this is again a very, very important parameter to look at when you think about long-term equity performance. It's not only about how GDP is going to pan out. Another myth that in the overall scheme of things we've highlighted is a lot of people believe that very simple investing structures like a systematic investment plan or a dollar cost averaging is only for the retail investor. And it is not something that a sophisticated investor should exercise. And we've shown that even in countries like Japan, where 30-year returns are more or less negative, inflation-adjusted returns are negative, a simple SIP or a dollar cost averaging strategy also delivers 5 to 6% CAGR dollar returns, which are fabulous. You will not get these kind of returns very easily. So once again, there is a myth in the market that simplicity is too simple. So we believe that simple structures are much better than creating any complex structures over time. So these are some of the myths that we've spoken about in our report, and of course there are a number of other myths that we bust.
Right. Sahil, another very interesting point you've made is actually on gold being a poor investment. So that's another myth that you've written about. So talk to us about number one, gold. Number two, if you have a view on real estate, whether that should be looked as an investment vehicle. And you've also spoken quite in depth about quality businesses being stable. So these 3 points, if you could give your quick view on.
So gold is a very interesting case. I think in India, there is a big affinity for gold and people have done quite well over the longer term. One case in point I wanted to make, we've shown that in our report also. When you look at gold as an investment and look at all emerging markets, you will see that except in India, in every other single emerging market, gold has outperformed equities in the 21st century, which is the last 25 years. Even when you look at developed markets, in number of developed markets, I think almost all of them, gold has outperformed equity. Even in United States, in dollar terms, gold has outperformed equity. You could argue with the starting point and take a different position. If you take data from, let's say, another 30 years ago, you will find different numbers. But the case in point is gold outperforms equity in emerging markets. And the reason is that emerging markets go through a lot of accidents. There are political turmoils, there are wars, there is inflation, and all of these result in currency depreciation. And gold helps in countering that by a very wide margin. Even in India, just about 3 to 4 years ago, gold was ahead of equities over a longer term CAGR. So even in India, it's not a completely equity win. They lead and lag over a certain period of time. So that is one of the most important reasons to have gold in the mix in your portfolio. It provides possibly sort of a disaster hedge, which is very, very important for equity investors, specifically in emerging markets. And I think in the last 2 to 3 months, we saw some amount of this play out when currency depreciated. You saw that precious metal had a good time. Second point that you mentioned is about quality businesses. And I think there is a sort of a myth that if you buy a great business and hold it for a very long period of time, you are sorted. But the data also tells you that even great companies, which are fabulous businesses, can go through massive stock price correction. And we've showcased that in the report. A lot of great companies, which have compounded very well over a longer period of time, have fallen between 50 to 90%, even during their best times. So stock prices are slaves to sentiment, and businesses can continue to do well. Eventually, investors will do well, but you should have the stomach to, digest that volatility.
Right. Thank you so much, Sahil, for joining us and, running short on time, but we have a lot more questions for you. But moving on, one stock in focus is Aeroflex Industries. The stock is surging after reporting its Q3 earnings. Vamakshi is here with the earnings fine print.
Well, Vivek, a good set of numbers coming in from Aeroflex. The company's revenue saw an uptick of almost 36%, coming in at almost 100 odd crores. The revenue growth that we saw this time around was much stronger compared to what we've seen in the recent quarters. So therefore bodes well for the company. The gross profit margin for the company also saw a substantial improvement of nearly 220 basis points to 39.9%. The EBITDA margin resultantly also saw an expansion of nearly 285 basis points, coming in at 21.7%. 7%, which is the highest that we've seen since Q4 of FY23. The net profit for the company came in at 15.2 crores. This is an uptick of almost 68% year on year. And in fact, with that, the net profit is at a multi-quarter high for the company, so bodes well. When we look at some of the key internals for the company, strong growth was seen in their assemblies business, which is their value-added products. They saw an uptick of almost 101%, so good growth coming out here as well. The export sales, which account for nearly 77% of the company's mix, saw an uptick of almost 10.5%, but it is the domestic business that actually drove growth this time around, because the domestic business is seeing a surge of almost 183.6% this time around. The company also announced additional capex plans in addition to what they already commercialized in December 2024. They've announced that SS hose and braiding capacity will be increasing from 16.5 million meters per annum to 20 million meters per annum. For miniature metal bellows, which is expected to be a new product for them, they will be installing a capacity of 2.4 lakh pieces per annum, and combined capex for both of these will stand at 77 crores, which will largely be funded through internal accruals. So good set of numbers coming in. The company has announced expansion plans, and resultantly the stock is surging in trade today.
Thank you very much for that. Now from reviews to preview, let's talk about LTIMindtree. It used to be a part of the Nifty, now it no longer is, but numbers will be important. This is a stock which has underperformed the markets. So last year, LTIMindtree was down 34% as growth for the company slowed down. So the key is, does growth come back? In the current quarter, we're expecting about a 1.5% kind of constant currency revenue growth. In dollar terms, 1.2%. Margins are seen under pressure on account of wage hikes, so margins seen dropping. Profits are down close to about 10%. As I said, the reason for the margin drop is the wage hikes. And the margin decline is a bit of a worry for the analysts. So for one, growth needs to come back. And two, margins for the company need to recover. Look at the way the margins for the company have trended. They've been under pressure. And in this quarter, if it comes at 13.5%, it would be a record low. The company's desired margin range is 17 to 18%. So how do they get to that? That's something the street will watch. But generally, brokerages again are turning bullish on LTIMindtree. One, because of its underperformance. Two, because it has a high component of BFSI and discretionary spends, which is why it got affected by the slowdown. And now as things are recovering, the hope is that LTIMindtree can get back. This was a company which used to grow in the leaders quadrant, right? The top end, those were the words they would use. And then things slowed down for the last 18 months. And now I think there is hope that it gets back to that. But again, the margin performance is going to be tracked very closely because it's come off from what they aspire to.
Thank you so much, Reema. Quite a lot to look forward to as far as LTIMindtree is concerned. We'll take a quick break. We'll get you more on the markets on the other side.
Welcome back. Here's another important story that Sapna is now going to be telling us. She's joining in with the latest on the IDBI Bank divestment. Sapna, take it away. Can you hear us? Okay, we'll get back to Sapna in just moments from now. In the meanwhile, proxy advisory firm IIAS calls on regulators to implement a majority of minority voting mechanism for approving promoter remuneration, citing a steady and significant rise in the compensation paid to promoters. Hetal Dalal, President and COO of IIAS, is now joining in. Hetal, thank you very much for joining in. You have reviewed nearly 900 proposals over the last couple of years. So first, tell us, by how much has the compensation gone up? Why is this such a big issue?
I think the compensation levels, and we've seen this over the years, has outpaced revenue and profitability growth. And therefore, there is a certain delinking of compensation with company performance. And that's a level of concern. In pockets, compensation has been significantly high, upwards of 50 crores, and one or two instances upwards of 100 crores. And therefore, we find that in these in these pockets, there is a significant pushback that we see from investors. But it's the promoters' votes that carry through these resolutions, and therefore because promoters have their voting power, it allows them to get paid at will. I think we also find that nomination and remuneration committees have been diffident in actually setting accountability for the kind of compensation that promoters are getting. And therefore, fundamentally, we believe that there should be some kind of rein-in of promoter compensation. But our ask of saying that the resolution should be put to a majority of minority vote is a fundamental tenet of conflict of interest, right? I own 52% of the equity or 55% of the equity, and I vote on my own compensation. It basically is a fundamental conflict of interest, and therefore we believe that like related party transactions, this resolution too should be put to a majority of a minority vote.
And what you're saying is that that when the promoter compensation comes up in the AGM, only 10 resolutions were rejected in the last 21 months. But had we followed what you're saying, that a majority of the minority shareholders need to approve it, then 216 resolutions would have been rejected out of nearly 900? Is that the analysis?
Right. Yes, that's right. And this data comes from voting patterns, right? We just look at removing how promoters have voted and then see whether the resolution is passed or not. You will find that the pass percentage drops from 99% to 75%. Essentially, 1% gets defeated, which is 10 resolutions. Another 25% would have actually not passed if it had been a majority of minority vote. And this is for the period of resolutions that we evaluated from 1st of January 2023 to 30th of September 2024. So that's a 21-month period. If you look at the same pattern for 2022, we found that 34% of the resolutions would not have made it to the majority of minority vote. And this was for 2022 data. So the pattern continues. You're seeing this year on year that promoters are voting their own compensation. Investors don't like it, but because they have majority vote, they are allowed to pay themselves effectively at will.
Hetal, you've spoken about investor concerns, and two concerns stand out significantly. Number one, you've spoken about a lack of adequacy of disclosures in resolutions as far as promoter pay is concerned. And the second point that you've highlighted is there is actually involvement of promoters themselves as members of the nomination as well as the remuneration committee. So, number one, talk to us about these concerns and how do you expect regulators to go ahead and address these concerns?
Sure. I think when we look at compensation disclosures for, let's say, professionals vis-a-vis promoters, right? In a lot of the compensation disclosures for promoters, there is really no performance metrics which is disclosed. So if the promoter gets paid 1% commission or profits, and it's a flat 1% in several instances, sometimes it can even be up to 5% of profits. The question is for achieving what, right? On the contrary, when you look at compensation for professionals, you will see a reasonably clear articulation of what actually drives variable pay. And therefore, in promoter and compensation for professionals, you see a greater articulation of or alignment of pay versus performance than you would see for promoter compensation. Also, in several instances, we've seen where companies don't perform as well, or they're actually underperforming their peers in the same industry. If commission sort of drops, fixed pay goes up. So the kind of compensation that promoters get still remains the same, independent of company performance. So fundamentally, we believe that the disclosure level should include a full cap on the absolute level of compensation. You can't say 1% of profits. Let's say Reliance Industries says we're going to pay the promoter at least up to 1% of profits. What does that number really mean? Or even Infosys for that matter, right? So size drives a lot of these things. And for companies with a reasonable size, the regulatory thresholds of 1% to 5% really don't add any meaningful constraints. So one is a cap on the absolute level of compensation. Second is what is the accountability for the variable pay? What needs to be achieved? And companies differ from saying that we don't want to put out targets saying revenue growth of 15% and EBITDA growth of 5%, but at least what are the bases on which the variable pay will be paid out is something that companies need to articulate. Whether these actually have any of these ESG metrics as well, or is just going to be a P&L number, which one of the parameters of P&L that will drive the entire compensation. So even for compensation for professionals, one of the things we find lacking in disclosures is the quantum of stock options that will be granted to these professionals over the proposed tenure. So today you are voting on the next 5 years appointment and their compensation, but stock options is a very material element of the compensation structure which doesn't get really disclosed, and it's left to the NRC to decide as and when the company performs and as and when they actually do the grant. And there we find that a significant proportion of the compensation really cannot be estimated. So some of these things need better clarity. From a regulator standpoint, our view is that if you put it to a majority of minority vote, all these issues get ironed out because the quality of disclosure improves dramatically, just as what you're seeing has happened as far as related party transactions are concerned. All the other pieces, and they're likely to face a significant pushback given that corporate India is 2/3 controlled by families. But in the absence of that, at least mandate these kind of disclosures which talk about how does the pay align company performance and what is the kind of final cap that you're looking at. And some of these elements need to be better detailed out or at least provide a framework. If you look at RBI, for example, right, RBI for bank CEOs has a very structured framework where they say that there is fixed pay and variable pay will be up to 300% of fixed pay. And that again gets split between how much will be stock option and how much will be cash pay. So there is a model. Now you can argue that because bank CEOs are custodians of people's money, we are brought this in, and you can't do that for all public sector, but you can serve all sort of private sector. But you can certainly bring in a degree of structure which for disclosure that helps investors understand exactly what is the compensation number they are voting upon. I think that's really broadly where we are. I missed your second question. Can you just repeat that?
Hazel, one final question before we wrap up this particular discussion. Citing a specific case of a company like Religare Enterprises, the company performance maybe has lagged peers, but if you're looking at the promoter compensation there, it's been quite high, along with stock options also being given. Do you have a view on that particular company? And other than that, any examples you can cite where you feel that there should be more stringent regulation coming in as far as promoter action or promoter compensation is concerned?
See, I think whether promoter compensation or professional compensation, I mean, one of the things that NRCs need to do is simply disclose how they benchmark the compensation. Once they're compelled to disclose how do they create a peer, and companies have disclosed this well, government companies do disclose this. Once they disclose how the compensation for either the promoter or the professional has been benchmarked vis-a-vis peers, vis-a-vis size of company, vis-a-vis growth or potential growth, I think that brings in a lot more balance in the remuneration structure than simply looking at it at a point in time.
Heta, thank you very much for joining in. It's been a great conversation and quite the eye-opener. So thank you with the data and even the recommendations coming in from IIAS. We leave the markets fairly stable in the last 1 hour. So the Nifty still holding pat at 23,300. The high today was 23,400, roughly there. But that slip happened in the first 1.5 hour of trade. And after that, things have been steady. The mid-cap index again off its high, but still holding on with a gain of a little more than 1%. Banks continue to outperform. It's a wrap on Trading Hour. On that note, thank you for watching. Stay tuned. Halftime Report is up next.
Advances far outstrip declines as heavyweights inch up and mid-caps continue to rally. Strong gains in the US overnight on easing inflation aid the move. Realty and utilities gain while FMCG and consumer durables are the big drags.
HDFC Life, among the biggest gainers today, jumps after it beats margin estimates and holds on to its growth guidance. Analysts bet on its margins bottoming out, though they remain wary of possible regulatory headwinds.
Hindenburg Research is set to disband and wind up after running through its pipeline of ideas, says its founder Nate Anderson, who is looking forward to focusing on other aspects of his life. The news triggers a relief rally in Adani Group stocks.
5 years after it stopped daily repos, the RBI has restarted it to infuse liquidity into the market. The return of this much-needed liquidity crutch, along with lower than expected US CPI, has pushed down the 10-year yield by 5 basis points and revived hopes of a February rate cut. The rupee, however, remains under pressure despite a fall in the dollar index. Bounce back was imminent and a bounce back has come by. 23,300 is where we are at the Nifty. The Nifty mid-cap index doing a lot better. So last 2 or 3 trading sessions, we've seen more green than red despite all the volatility. I'm Manglam Malu, with me Hormas Fatakia. The proof of this pudding will lie in its eating towards the expiry. We have the second half, which will be extremely crucial, Hormas.
And an action-packed second one is the action-packed second half as well, Manglam. Is not only the weekly expiry, but once you call shutters on today's trading session, we have 3 very important earnings lined up today. The index heavyweights, be it Reliance Industries, Infosys, Axis Bank, all of them coming out with numbers today. And that perhaps is one of the reasons why there is still a bit of a cautious tinge, even though we are in the green, but we have not had a blowout move as we saw on Wall Street last night, still continuing to hover around that 23,300 mark. More importantly, we are above the November lows of 23,263. That was the first level that the index had to cross in order to move further higher. So 23,300 is where the index is. The broader markets, though, are continuing the way they have over the last 2 trading sessions, be it the mid caps or the small cap indices. The mid cap index is up 1%, as is the small cap index. They too cooled off a little yesterday in line with the way the benchmark index moved, but today they are firmly in the green as as compared to the benchmark indices. But we have been focusing on the disinvestment theme over this week. We spoke of PSU banks earlier in the week, and now it's on IDBI Bank, and Sapna is joining in with the latest update on that. Sapna, tell us more.
Yes, Urmo. So what we are clearly given to understand is that the government is still sticking to its target timeline of March FY25 for receiving the bids, the actual financial bids for IDBI Bank disinvestment. Basically, just as a quick background, there have been reports indicating that since the due diligence is currently on, it may not be possible for the government to receive the bids in this year, and hence the transaction gets, kind of moves forward to the next financial year. But some clarity has come in indicating that, the March timeline is still very much on in terms of actually receiving the financial bids. Now, this clearly indicates that sometime soon, maybe next month, the government may be in a position to call for these bids. Definitely, the due diligence for IDBI Bank disinvestment is still on, and it started some time back. And that's the normal process for any privatization, transaction. Having said that, so the timeline for receiving the bids is intact, absolutely intact, clearly indicated. However, in terms of closing the transaction, in terms of formality, that may move to the next financial year. But obviously, Hormuz, what we are all interested to know is who are those potential bidders who will actually get to buy the stake sale on the part of LIC and government. And those bids are to be received in the month of March. There is a clear indication on that. Hormuz?
All right, we take that point, Sapna. Thanks a lot for that. IDBI Bank has been flip-flopping over the last couple of trading sessions, was under a little bit of pressure, but back up again today on the back of what Sapna has just reported. We'll keep an eye out on this itself. But let's also focus on some other stocks on the move. The biggest one today has been HDFC Life, up over 10% in today's trading session at one point in time. Now still holding on to gains with about 9% so 3% off highs, reacting to its third quarter earnings. Yash joins in with a fine print of that. Yash, the margin compression is a lot less than what the street anticipated.
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates in terms of specific numbers. For new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3,569 crore rupees. Retail AP again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Beating muted expectations, brokerages upbeat, a perfect recipe for the move that you're seeing in HDFC Life. Yash, thanks a lot for that. 9% higher on the stock, the top gainer on the index as well. The biggest single day gain that the stock has seen since April of 2020. The other one that is doing well today is Paytm, and that is buzzing today on the back of an MK note. Abhishek is telling us more about that. Abhishek.
Well, MK has upgraded Paytm to buy from at. They have increased the target price to about 1,050 per share from 750 that they had earlier. They say that the recent NPCI approval in October 24 has released a major regulatory overhang on the company. So this should help the MTU base get built up again over the next 12 to 18 months. The cross-sell retail financial products like home loans, insurance and wealth products, that will help in improving the revenue per customer or per user for them. So Paytm may be on early path to profitability by FY26, post which profits will keep on increasing as per their estimate. They also say that Paytm's cash to market cap ratio is at 21% when compared to 5% for Zomato. Now this provides strong margin of safety for investors. So additionally, a further easing of regulatory stance via potential approval for payment aggregator license, that could be another positive catalyst as per MK for Paytm. Back to you.
Abhishek, thanks a lot for that. Paytm up around 4.5%. Meanwhile, keep an eye out on Sun Pharma. They've made an acquisition via their arm Taro. It's a Canadian company that they've bought. We'll just try and get more modalities of that acquisition, what it does to their overall portfolio, the kind of monies that they will be paying for that as well. But the street seems to like that. The pharmaceutical stocks have been in focus, recovering from lows. Currently, Sun Pharma, ahead of this news, had recovered from the lows, currently sitting with a gain of almost 0.25%. So we'll just get some more details on this acquisition. Hamas.
They're calling this a strategic investment in a pharma company, and the turnover of the company that they've acquired is nil. So it seems to be a strategic investment. It's not a related party transaction. They're expecting it to be completed before the 7th of March, and it's an undisclosed sum. So they've given a cash consideration, yes, but how much is going to be the cash consideration is something that the company has not disclosed.
Maybe some capabilities that they are buying off that company since it's pre-revenue, strategic investment out there. So we'll keep an eye out on that. But the other stock that is reacting to its third quarter numbers is L&T Tech. This morning we spoke with Amit Chadha, who's the managing director and CEO of the company, as well as the NASCOM Executive Council member regarding the company's third quarter performance. Listen it.
Our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year, or 16.2 that we've got. And I do see quarter 4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
The management there of LTTS at the stock doing very well for itself as well. By the way, just going back to Sun Pharma for a bit, the acquisition that they have done through Taro, Antibay Therapeutics, now that is currently being managed by a court-appointed receiver, and that receiver is authorized to carry out the sale of Antibay. So it almost comes across as if it's an NCLT sort of an acquisition, a resolution of sorts, and they have been asked to not disclose the consideration until the acquisition is complete. So once that's done, is when the company will make the disclosure. March of 2025 is where Sun Pharma has shared the timeline for that. So keep an eye out on the stock at the highest point of the day now. Taking a short break, but before we do that, it's time to dive into Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. Now, this week, CNBC-TV18's Nigel D'Souza interviewed Praful Kulkarni, who is the founder of Alpha Leo Capital, to understand why traders must learn to avoid the noise in the market.
Any practical tips for the traders? How can they stick to their strategy and avoid overreacting to news?
News, I think it's a very important question, because most of the people overestimate their ability to judge the exact outcome of the markets to the news. Two things here. One, we need to understand that we don't have the capability to exactly judge what would be the possible outcome or how would exactly market react to the news. And the second thing is, you need to understand that we are at the bottommost layer of the information chain. By the time you get the news, understand that the game is already over, you're late to the party. And at the same time, since you don't have the capability to take such big bets and sit through the ups and downs, and you don't have the capability to exactly judge how the market's going to react, I would say retail traders are better off not looking at the news, and they would just have to stick to their strategy by completely eliminating the noise.
investing.
Welcome back. 23,300 is where the Nifty continues to remain, and it's almost a status quo, a flat line if you can see there on the index. And all eyes will be on the index heavyweight, and that is Reliance Industries, that reports its third quarter results later this evening. Rima is joining in with the key expectations. Rima.
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price hikes. And even the retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, geo, and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Geo2, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember, would be the July hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter, the overall subscriber base declined by more than 10 million on a sequential basis, perhaps as, the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will watch. But remember, the stock has been a bit of an underperformer. So last year, Reliance Industries share price declined for the first time in 9 years, and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptick. Even the telecom business is likely to see telecom, stable. Tariffs retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
Take that point. Thanks a lot, Reema, for that. Reliance has been a bit of an underperformer for the first time in a very long time, but ahead of numbers, the stock's well bid, up around 1%. And the reason for that could be perhaps some improvement that is expected in the retail EBITDA. From a revenue standpoint, there is some moderation, consolidation, which is expected on account of a couple of things. One, the prior pace of growth has been extremely strong. Secondly, the company had been making a lot of acquisitions and scaling all of that. And thirdly, the consumer sentiment itself has been weak. So YOY, the growth would be moderate because of the B2B business in the base. Quarter on quarter, there would be some support coming in because of the festive season. So if you look at the last 3 quarters or so, the revenues per quarter have been around that 75, 76,000 crores. Third quarter seasonally strong. So we're expecting around 80 to 83,000 crores on the top line for the Reliance retail business itself. The key to track, however, would be there would be a 7% expected increase in retail revenue per square foot. That's Nuvama's expectations. And the other thing that we'll be watching out for, does that become, operating leverage positive or not? Retail EBITDA growth is something that we're keeping an eye out on. The analysts expect 1 to 2% growth year on year and 8 to 9% quarter on quarter growth on account of the festive season. We are expecting numbers of close to around 6,400 crores for Reliance's retail business EBITDA for the third quarter itself. That's a CNBC-TV18 poll. Apart from these numbers, just keep an eye out on the JioMart orders and the growth in new formats. They have Tira, Ustar, which is being fairly well bid after the value fashion business has seen some traction, and also aggressive footprint expansion by beverage. Campa are a bunch of things that we'll keep an eye out on. So that's as far as Reliance's retail business is concerned. Hormaz.
A lot of these brokerages also have been saying, right, that retail and Jio will be driving growth for Reliance going forward. So all eyes will be on Reliance and the various business verticals. So time for a short break. Just before that, EMS won an order worth 105 crore rupees. The stock is on a 5% circuit now after that order win. Keep an eye out on that as well. Time for a short break then. On the other side, more earnings in store today. Axis Bank and Infosys, and we get you their expectations on the other side. Stay tuned.
You're also making investments in a whole bunch of startups. What guides
the kind of investments that you're making into the kinds of companies that you're looking at.
I think I need to change that attitude of mine. I think I think I've saturated that whole like I did in sports, where it was all about just passion and I want to do everything, to okay, I need to set a system in place, and maybe I need to take a step back because maybe I'm becoming the speed breaker. What's really exciting me and has been for the last 5-6 years is the India story. You know, companies coming out of India doing stuff for India. Make in India is something that really excites me, because I think gone are the days where we look upon ourselves as being inferior. I think if not anything, we are the market leaders in whatever we do. And I love that renewed confidence within ourselves.
So you've been playing international level badminton for almost 15 or more than 15 years now. Do you feel it also defines who you are as a player now? How you've matured as a player, your journey, your experience?
Yeah, definitely yes. The person you are, the confidence levels that you show on court are very important. And I think as a person, when you're right there, you know, when you stand and people, when they look up to you, they also need to understand that yes, you know, she has done a lot for the country. And that itself shows that how confident you are when it comes to the way you are, the way you show up, the way you prepare, and the way you stand yourself in terms of, let's say, when it comes to style, when it comes to your personality, when it comes to your confidence levels. It is very important.
Right.
Yeah.
You know, when you're speaking about your career, one thing when I was hearing you speak, how would you define a winning mindset, both on court and in life?
I think it's very important to believe yourself. I think that itself defines who you are, what you are, and what you stand for, whether if it's on or off court. I know people might say that, you know, you've been very successful, what else you need in life? But I think to get till there itself was a tough task. But I have been very fortunate to have people around me have been very, very positive and very supportive. So I think for me, success definitely means everything, but I think initially nobody is born with a golden spoon. Everybody need to, you know, work hard and be smart enough to work hard. It's not just few months of hard work, but it takes years and years of hard work to come to a level. But I think coming to a level is one thing, but you know, maintaining that level is a different thing altogether, and it takes even more you know, time and hard work, and you know, it takes a lot of your time to maintain that. So I think for me, success, I think badminton.
Axis Bank, that's the stock on our radar ahead of its third quarter earnings today. Abhishek joins in to tell us what the street is anticipating. Abhishek.
Well, it's expected to be a weak quarter for Axis Bank. Our poll suggests the NII growth on a YOY basis may be one of the lowest that you are seeing in last 13 quarters. Now, deposit and advances growth will be seen closely. Now, Citi estimates deposit growth of 11% YOY and 3% quarter-on-quarter, which is higher than the industry average, while they estimate, you know, advances growth of 10% YOY and 2% quarter-on-quarter, which is lower than the industry average that we had as per RBI data at the end of December 24. So, net interest margin may decline both YOY and quarter-on-quarter. Kotak Securities estimates 11 basis point decline in net interest margin YOY and about 4 basis point on a sequential basis. Slippage is expected to rise quarter-on-quarter. Again, Kotak Securities estimates a slippage of 5,000 crore versus 4,400 crore in the previous quarter. So, asset quality expected to deteriorate. Citi estimates gross NPA ratio to increase by 20 basis point quarter-on-quarter and net NPA ratio to increase by 10 basis point on a sequential sequential basis. Provisions can remain elevated, thereby impacting the earnings momentum. Again, Kotak Securities estimates 198% gain with respect to provisions rising on a year-on-year basis and 5% increase on a sequential basis. Near-term, loan growth outlook and deposit growth outlook will be seen closely. Deposit is becoming a challenge for the sector. Our polls suggest NII growth of 9% YOY and about 1.5% sequentially. We are working with a profit growth of 3.5% YOY and a decline of more than 9% quarter-on-quarter. Back to you.
Abhishek, thanks a lot for that. Keep an eye out on Axis Bank. The stock is up over 1% today. Was one of the big drags in yesterday's trading session, ended at the lowest point of the day, and that was one of the key triggers, while the Nifty 2 ended off the highs of the day in yesterday's trading session. Here too, it's off the day's high, but still holding on to gains of 1%. But moving on to Infosys then, and Rima is joining in to tell us what is the street expecting from the second largest IT company in the country. Rima.
Thanks so much for that. So we're expecting growth better than TCS, but not as strong as HCL Tech. So constant currency revenue growth is seen closer to 1%, while dollar revenue growth is seen flat. Margins are seen expanding slightly to 21.3%, and this will drive a modest 3.5–4% jump in the company's profitability on a quarter-on-quarter basis. But what the street will watch closely will be the FY25 guidance. Now, the current guidance stands at 3.75 to 4.5% in constant currency revenues for the full year. Now, given the performance in the first half of the year, it's widely expected that the lower end for sure will be raised. But the question is, do they raise the upper end of the guidance, which is 4.75? Do they get that up to 5–5.5%? 5 may be priced in, 5.5 perhaps will excite the street. Margin guidance is likely to be maintained at 20 to 22%. Now, what will you watch? Well, commentary, because so far the commentary from either a TCS, HCL Tech, or even an L&T Technology all point to the discretionary demand situation improving, being better than what it was 3 months ago. TCS came out and categorically said FY26 is going to be better than FY25. For a company like LTTS, the deal wins were the largest ever, especially the large deal wins. For Infy in particular, watch for the wage hike timing and the implications, and then commentary on BFS, retail, and other important verticals. Back to you.
All right, Rima, thanks a lot for that. Before we take that short break, just keep an eye on Bharat Dynamics. Quite a bazooka move taking place out there, pun intended, because they've gotten an order worth nearly 3,000 crores coming in from the Defense Ministry for surface-to-air missiles, and that's exactly what the stock has done as well. From surface to air is where it is, up almost 7% odd. We need to get the modalities of this contract back as well. Was it an old order that has now been reopened, or is it a contract which is a fresh contract which has been signed? What is the delivery period, etc.? Nevertheless, the amount is something that the street likes, and the stock already had been beaten down. All the defense stocks had come off the highs, but now at lower levels. Maybe there is some buying on account of these order wins that do come intermittently. But another stock which is also seeing bazooka move is Aeroflex Industries. What we'll do is take a short break, come back on the other side. Asad Daud, who's the MD of the company, joins in to discuss their third quarter performance.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
So I would do anything to be successful or to be at the top class level.
Right.
Yeah.
So just the way you handle a victory, how do you come over defeat and failure?
Definitely, I mean, every athlete or every person goes through it. I mean, wins and losses, and I think ups and downs are part and parcel of life. It's important to let go. I know it does take time, And it is easy to say, but I think it's not just end of the world, you know, when you lose a match. You get to learn a lot more and you need to come back stronger. That's what I've believed in, because I've had toughest matches where I was nearly there and then I just missed it out. But I think I've learned a lot from that, and for me it was very important to believe in myself and have that hope that I can do it again.
Right. So what's the Sindhu way of coming out of the defeat, getting your mind back on track? What's the mantra you follow?
Well, I mean,
you could tell us after any match that you remember which was very close to your heart and was difficult to get over.
Yeah, recently I think, not recently, but Tokyo, I would say, where my Olympics, the second Olympics, I lost in the semi-finals. And of course it was very, very hard, but I had mixed feelings, mixed emotions, where, you know, I was feeling bad, where if I have to think, I lost an opportunity, you know, I lost a chance to go to the finals. And on the other side, I was thinking, do I have another opportunity to play the bronze medal match? So I was like confused, I was upset, I didn't know what to do. I just had that, I would say, less than 24 hours to decide and come back stronger. So I think that was the perfect example that I could remember and tell you now, because it was really hard at that point of time, because you lost the semi-finals and you lost the opportunity to go to the finals and get a gold or a silver. Rather, you have another opportunity to prove yourself, right? So, yeah, I mean, my coach and my parents just told me that there's a lot of difference between the fourth and the bronze. So, at that point of time, my mindset was like completely like, I was like, no matter what. I couldn't even sleep that night because I had a match next day in the morning, and obviously I just gave my 200% and I got that bronze back. So
right, just come back harder. Just come back even harder.
Welcome back. As promised, to get in the management of Aeroflex Industries now, and that is having a very, very good day today on the back of its strong performance in the quarter gone by. Now, to discuss the road ahead for the company, we are now being joined by Asad Daud, who is the MD of the company. Asad, good afternoon. Thank you for joining in, and congratulations on a quarter that has been good for your company. Now, if the last time you spoke to us, you had mentioned that there will be a 20 to 25% revenue growth in FY25. And this, you said this despite only the 10% growth that you had seen in the first half. Now, with this performance, do you expect this guidance to be met, and how is the fourth quarter shaping up as well?
So yes, so if you see in terms of our growth in terms of our revenue for the 9 months has been almost close to 20% now. But our focus has been on growth in the bottom line. So if you see our EBITDA margins, they have grown by 25% on a year-on-year basis, and our PAT has grown by about 30%. So for this entire financial year, we expect our EBITDA margins to grow over a period of the 1 year to about 25 to 30%. So we are in line with reaching our objectives and our target in terms of our EBITDA margins.
So what you're saying is that EBITDA margins will be 24 to 25% in the fourth quarter?
In terms of the growth, as compared to last year, we'll be...
Okay, so you're talking about EBITDA growth, not margins.
Growth, yeah.
Got it.
Not margins.
Yeah. Okay, and revenue, where will it be? 20 or 25%? Or you think it'll be between 18 to 20%? For the full year?
I think if you see from a full year perspective, I think it will be in the range of about 18 to 20%. But our focus, like I said, would be on growing our bottom line much faster as compared to our top line.
So could you give us then guidance on your margins? Because the first 9 months of this year, your margins have seen an improvement of nearly 140 basis points, or rather, a little around 140 basis points, from 19.7% to about 21.1%.
Yeah, so we would be hoping to end the year at our EBITDA margins anywhere between 21.5% to 22%.
Okay, 21.5% to 22%. Now, tell us a little about business itself, because this quarter, when we see a lot of growth, most of it is coming from domestic itself. I remember you had earlier told us that, there is some problem with global supply chain and global demand itself, and that impacted your performance in the previous quarter. How are things shaping up out there going forward? What's the kind of growth split that you're looking at in US, Europe, and India?
So yes, in terms of the growth in this particular quarter, the growth from the domestic market has been much more. But also, if you see the growth in the exports, so as compared to the same quarter of last year, our exports have also grown. Obviously, they have not grown in the same percentage as compared to the domestic market, but yet export has grown. The major growth in the export has come from the USA market, which continues to be our major thrust. Europe is a market which is which is still not shown the kind of growth that we are looking at. Hopefully, if the war comes to an end over the next few months, then I think from the next financial year onwards, I think we'll also see some growth in the European market as well.
How much does Europe contribute, Asad? And is war the only deterrent why business in Europe had been slow?
So Europe currently contributes about 20 to 25% of our overall sales. So which is a significant contributor. The war has been one of the reasons where the overall economy of Europe has seen a bit of a slowdown. Although I'll say that we have not seen degrowth in Europe, but the kind of growth that we were expecting from the European region, that has not yet materialized. So hopefully, I think in the next financial year onwards, I'll see, we are hoping that Europe can see that kind of growth that we are seeing both in the India market and in the USA market.
Could you give us a couple of more details? In the third quarter, what was the volume/value breakup? And secondly, in December, you had another plant which was likely to come on stream, the expansion of SS flexible hoses. We wanted to understand whether that has come on stream and what kind of orders are you expecting for this facility? Do you have some in your hand? And if you could give us some early indications of what FY26 looks like on account of revenue and margins.
So yes, in terms of our expansion of capacity from 15 million to 16.5 million meters has been commissioned. We have also started the production of metallic bellows at a new facility which was dedicated to the manufacturing of metallic bellows. That has also started off, from this month onwards. And if we talk about in terms of our growth, so we have seen a significant portion of the business actually come from the assembly section, which has been the thrust for the company over the last few quarters. And we expect that over the next few quarters and for the next few years as well, our focus would be to grow our assembly business, which definitely has much better margins as compared to our flexible hose business.
So what does that mean in terms of your expectations for FY26 and FY27 on both revenue and margins?
So in terms of the expectation for the next financial year, I think it will be in the same lines as compared to this financial year. Although we will have a new product segment, there will be added on, which is specifically metal bellows. We are expecting that the growth in FY26 would be actually much better than as compared to FY25. So that.
What about the fundraising, Asad? You had last month approved a QIP, 400 crore rupees through a QIP. Is there a timeline that you could share for us on that? And how do you plan on utilizing these funds?
Obviously, before we plan to take the QIP forward, I think our aim at the company is to professionalize the management, and hence we have onboarded a new COO who will be joining from the 1st of February. And with regards to the QIP, I think the final amount and the utilization of the funds is still under discussion at the management level and also at the board level. So probably once it is finalized, then I'll be able to share with you the approximate timelines and the utilization of the proceeds. So till that time, I think I will not be able to share much information. Our focus is to grow our team, and hence the reason why we are now planning to become a more multinational company, and hence we have we have got on board Mr. Kagalkar, who will be our CEO of the company, to take our company to a global scale.
No, we understand that point. If you could just quickly tell us, obviously you can't give us the exact time, but typically how long does it take for you to, get this board resolution of the QIP and launching that QIP itself? How long should, investors wait for? 2-3 months, 4 months? You have some clarity then?
So, ideally we would be looking to get the same, by the Q1 of the next financial year or earlier if possible. But obviously, there are some detailings to be finalized and completed, and obviously, the timing of the QIP also has to, consider the market scenario and the market conditions as well. So we will consider all of the things in perspective and then launch our QIP.
We take that point entirely, largely because, it's a big amount. It's not a small amount. You're raising up to 400 crores and your first 9 months revenues have been close to around 284 crores. So if you annualize that, you're raising almost as much as your annual revenue. So to that extent, what you do with those funds will be very important for the street to know. Organic opportunities, if at all you're looking at, if you're looking at inorganic growth also, the amount that you put in from the money that you raise in the QIP will have to have some bearing on your turnover, asset turnover, either via inorganic or organic route. So do you have an ambition here with 400 crore investments? How much are you looking at to scale up your revenue over the next 4, 5, 6 years or something?
So, in terms of our organic expansion or our capacity expansion, I think that for the next 1 year, we plan to do it from our internal accruals. Now, with regards to the QIP, we have plans for inorganic acquisitions as well. And like a significant portion of the QIP would be utilized for that purpose as well. And hence, we are, in discussions with regards, obviously, we are looking at opportunities for inorganic acquisitions. And I think the QIP would also be utilized for that particular aspect. And obviously, the QIP is being raised, with a vision of that the funds would be required for the next 2 to 3 years. So it will help us to reach a target of 1,000 crores over the next 3 to 4 years.
So 3 to 4 years, 1,000 crore is your top line ambition via organic and inorganic. The way you are talking and the clarity that you have in your head, it so appears that you have an asset in mind already. You're talking to someone. If you could give us a sense of, what are we looking at? Is it a similar business as yours? Is it similar category? You're bringing on new capabilities. What could potentially be the size in terms of revenue of the asset that you're looking at? And by when can we hear about the closure of this deal, if at all?
So, right now we are in talks. It is at a very early stage, so it will be difficult for me to comment anything in terms of the opportunity or the company or the size of the business. I think obviously once anything is finalized, then we'll be able to discuss on the same. And the opportunities that we are looking at is not only in India, but we are also exploring the opportunities in the international market, especially in the USA and in the European region, which will help us to scale our business in those particular countries. So we are exploring a lot of opportunities right now, and nothing has been finalized as yet. And once anything is towards the stage of closure, we'll be able to share more details.
All right, Asad, thank you so much for joining in. Wish you good luck for the road ahead and, of course, for that potential acquisition that you have in mind.
You promise to join us as soon as you have some clarity on that acquisition, right?
Yes, I'll do for sure.
This is US or Europe?
No, so there are multiple, talks are going on. So,
Not India for sure.
Maybe India also, I don't know.
There are multiple on the table, but Asad Daud will join us as soon as any acquisition is completed. He's confirmed this to us on air. Asad, thank you so much for sparing time and joining in the management there of Aeroflex Industries, the stock in a 20% circuit. Take a short break, back with the markets. Aditya Agarwala of Invest for Edu joins us on the other side. Stay tuned.
Is very, very important. Just believe in yourself.
Didi, we'd also like to ask you about this debate over 70-hour, 90-hour workday. It's a rage on social media. People have different views about productivity, not being forced into 90 hours. Rajiv Bajaj has said that if you want to work 90 hours, it should really start from the top, and if it's successful, then implement it. And it's not really about the number of hours you work, but about the efficiency and productivity you show. What would be your view?
I would not say this is right and this is wrong. My only thing would be, how many hours whatever it is, I would say it needs to be useful, and there need to be a good change in whatever you do. I think that is the only thing I can say, because talking about hours, I think people ask me how many hours do I play, is it important that you play so many hours, or is it important that you play only for a few hours? So even that debate keeps going on at times. But whatever it is, it needs to be in a very smart way, and it needs to be very useful for everyone, and everyone needs to be happy at the end of the day. That is it.
My final question, what do you think India as a country can do more in terms of encouraging sports and making sure we do better at Olympics year after year? Athletes like you work very hard. It's a tough journey. You go through injuries, defeats, failures, bounce back again. It's a constant journey. But what can we do to have a greater sporting culture all the way from top to the bottom, or from bottom up?
I think it's very important that you have a very good system. That is very important, and I think everything needs to start from the grassroots level. Not that when you come to a certain level, people then say that, okay, we need support, or we need the infrastructure or everything, but it needs to start from the grassroots levels. And I think I'm happy to say that we've been getting a very good support from the government, and there've been good support from the sports authorities. At the same time, I think there needs to be a lot more leagues happening, so that there are a lot of youngsters who are doing really well, but not able to prove themselves. I think leagues now, if you see, there've been Coco, and then there've been tennis and pickleball. A lot of leagues are coming up, and I hope there will be a lot more in every sport, because these kinds of leagues, a lot of people get a recognition in terms of they get to see a lot of athletes who take them as an inspiration and prove themselves and have that confidence that yes, even we can do it, because a lot of people are doing really well, are working hard, but they're not getting that opportunity, or not able to have that platform where they can prove themselves. So leagues like these will definitely help them to come up and think that yes, we also have something to actually look up to.
Testing. Welcome back. You're watching us here on Halftime Report. Perfect time to get you what's taking place in the F&O space. There have been some improvements in the way the indices have performed over the last couple of trading sessions. The Nifty is sitting with a gain of almost 100 points. Essentially, there is mid-cap index is doing well as well. So, over the last few trading sessions, we've been talking about how the indices have been making lower highs, but the last 3 trading sessions, the indices have been making higher highs, and that's a positive. Apart from that, the mid-cap index, what a smart bounce back it has had. From Monday's close, where the mid-cap index saw a 4.5% fall, it's up 4.2%, where the Nifty and Nifty Bank are up 1.3% itself. So the gains being led by the banks and the mid-cap index itself. Hormaz, you remember, we've been talking about the iron condor strategy in options trading, where you sell calls and puts of the same strike, and then you buy the wings on the other side as well to protect yourself. That's taking place at 23,300. The call out here is 13 odd rupees. You pull out the 23,300 put as well. You will see that is about 30 odd rupees. You sell it for about 50 rupees net. You are hoping for a range between 23,250 and 23,300, because that's where the hedges have been bought. 23,250 put and 23,350 call. So short point that I'm trying to say is option writers for this Thursday are positioned for a Nifty expiry between 23,250 at the lower level to 23,350 at the upper level itself. A lot of long positions added on India Mart and some shorts added on Trent after that up move that we saw in yesterday's trading session as well.
Indeed, and an interesting one at that. I'm sitting next to you. I will have learned about irons and butterflies and everything possible. I may not understand the strategies, but I do remember what's happening. Aditya Agarwal of Investment Edu is also joining in. Aditya, good afternoon. Thank you for joining in. If this bounce sustains or not is questionable, but are there any stocks that you are recommending to your clients this afternoon?
Oh, absolutely. Hi, Hormuz. Good afternoon. Hi, Mangalam. Good afternoon. Thanks for having the show. I've got a couple of buy recommendations because the undertone is still strong. So, Bharti Airtel is the first pick from my side. both on the long side, the stocks. So for a target of 1760 with a stop loss at 1560, I have a buy recommendation of Bharti Airtel. It's breaking out of a narrow consolidation zone, so I think the uptrend will continue here. The second is City Union Bank. Again, this is one stock which has withheld massive correction in the banking stocks. I see positive harmonics, bullish harmonics in the stock, and has taken support at key Fibonacci retracement levels. So at current levels, I'm a buyer in City Union Bank for a target of 182 on the upside, with a stop loss at 166 on the downside.
Take that point. Thank you so much, Aditya, for joining in. Short interaction, but we got all that we need to from you when it comes to stocks. Take a short break. On the other side, we talk about CEAT, which is reacting to its third quarter earnings. On the downside, we'll tell you why.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for that.
Back with us here on Halftime Report. There are plenty of losers in the broader markets, even though the mid-cap and the small-cap indices are continuing to be near the highest point of the day. Kalyan Jewellers is one of them. Another 4.5% down today. 9 out of the last 10 trading sessions in the red now for the stock. And mind you, the stock is in the F&O ban today, so no new positions on the stock. So 4.75% lower for Kalyan Jewellers. The other one that's not doing well, though, is CEAT, and that is reacting to its third quarter results. Sudarshan is here with the earnings fine print. Sudarshan.
So earnings for Q3 by CEAT are muted, but largely in line with what brokerages were estimating. Nevertheless, revenue has increased 12% year-on-year, but sharp increase in raw material cost had a drag on EBITDA and margin. Raw material cost has increased to 63% against 57% that company had seen the last quarter, and it's up more than 440 bips year-on-year and almost 70 bips sequentially, and that led to margin falling to 10.4%. That is down nearly 400 bips year-on-year. But talking about the earnings and the outlook, company says it has witnessed double-digit year-on-year growth, and it was driven by replacement segment. On demand front, it says it remains stable, and going forward, it says that order book remains strong, and going in the Q4, as of now, raw material cost remains stable. That might help in the earnings for Q4. And apart from the earnings, company has also increased the capacity addition for Nagpur unit. It's going to increase the capacity by 30%, and that's going to be completed by FY28. And investment for this would be total rupees 400 crore, and that will be funded via internal accruals and debts. But on the earnings front, it's muted but largely in line, and that's the reason you might have seen a minor recovery from lows.
Indeed, Sudarshan, thanks a lot for that. Keep an eye out on CEAT as the day goes by as well. But with that, it's a wrap on this edition of Halftime Report. Mangalam and I leave you with the Nifty at the highest point of the day now. 23,320 is where the index is. 350-point gain on the Sensex as well. From the team that put this show together, thank you so much for watching. Business Lunch for the next 30 minutes.
At these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
I think it's going to be, I believe, not a very high return market, to be honest, the next few quarters. The thing is, rather than forecasting anything, the biggest thing is last 3-5 years have been solid in terms of returns. Obviously, valuations are high. And two is, as you pointed out, we're entering a phase where the world's largest economy is going to see a fairly radical regime change. We don't know what exactly will happen in terms of dollar strength, yuan weakness, trade tariffs, etc. So there is a lot of uncertainty, and the valuations are probably on an aggregate not reflective of that uncertainty. But having said that, I think there is value at polar opposites of the market. I think a lot of tier 2, tier 3 financials are almost at distress valuation. And I believe that in India, secured lending will still be okay because in general, we are a reasonably high inflation economy. So the asset values keep inflating. And a lot of the tier 2 private banks, PSU banks are at book or below. So I think there is a risk reward opportunity there. I think there is a risk reward in metals.
Advances far outstrip declines as heavyweights inch up and mid-cap rally. Strong gains in US overnight on easing inflation aid the move. Realty and utilities gain while FMCG and consumer durables drag. HFC Life jumps after it beats margin estimates and holds on to its growth guidance. Analysts bet on its margins bottoming out, though they remain wary of possible regulatory headwinds. Edinburgh Research is set to disband and wind up after running through its pipeline of ideas, says its founder Nate Anderson, who is looking forward to focusing on other aspects of his life. This news triggers a relief rally in Adani Group stocks. 5 years after it stopped daily repos, the RBI has restarted it to infuse liquidity into the market. The return of this much-needed liquidity crunch, along with lower than expected US CPI, has pushed down the 10-year bond yields by 5 basis points and revived hopes on a February rate cut. The rupee, however, remains under pressure despite a fall in the dollar index. Israel and Hamas reach a ceasefire agreement to pause the war in Gaza after 15 months of fighting. The deal will come into effect from Sunday, with the first batch of 33 hostages set to be released by Hamas in exchange for Palestinians held in the Israel jail. US President Joe Biden, in a farewell address, says both administrations and the incoming Trump administration are responsible for brokering the deal. Hello, good afternoon. You've tuned into Business Lunch on CNBC-TV18 and I'm Vinny Motiwala. A quick look at the markets today. We're seeing a bit of a green that's come in on the screen today, and what we're seeing for the Nifty, 23,320 level. So about the 23,300 mark is what the Nifty's managed to sustain most part of the day today. Where it started, that's what's managing to hold on to. What's supporting it today is HDFC Bank, ICICI Bank, Reliance, Bharti Airtel. Do not forget, yesterday these private banks were a bit subdued and were on the drag side. But today, a different story is coming in for the private banks. What's not doing well? We have the IT names. So TCS and HCL Tech, that's down and out, as well as ITC and HUL from the FMCG side. Nifty Bank is managing to hold on to good gains of 1.3%, more than that. And it's trading at the day's highest point is the Nifty Bank. Mid and small cap, that's also managing to hold on to good gains, more than 1% of gains, again outperforming the benchmark indices, the Nifty Mid Cap, as well as the Nifty Small Cap. Let's talk about sectors which are not doing well. So, you did see those names like HUL, ITC coming in on the top tracks for the Nifty 50. So, Nifty FMCG is one of the sectors which is trading in the red. Other than that, we have Nifty Pharma that is also trading in the red. It's down almost 0.5% in trade, while also we have Nifty IT that's subdued. So Nifty IT also is down 0.3% in trade. Other than that, PSU banks, realty, metals managing to hold on to good gains. But yes, that's how the market setup is looking like this afternoon. Benchmark indices managing to hold on to the gains that I've seen since the start of the day. But the important talking point today is that the Reserve Bank yesterday announced that it will conduct variable rate repos every working day, thus signifying a major change in the availability of liquidity in the market. Now, this announcement, along with the cooler than expected US core CPI, has pushed down the bond yields. Lata is joining in with us to explain us all of this and what it means. Lata, good afternoon.
Well, the Reserve Bank has restarted daily repo. What is repo? Repo is a means by which the central bank of any country gives money to the banking system when it needs. So this had gone away into a 14-day repo. Some time back, 2020 was when it got written into the RBI rules that they won't do daily repos at all. They will do 14-day repos. Now, often what the Reserve Bank actually is trying to tell the banking system is that you make an assessment of what will be the deficit for you over 14 days and take that money from us. We will provide the liquidity. It was trying to tell the market, I will not be your treasury manager. You have to manage your own liquidity. But it often wouldn't work. The Reserve Bank was giving 5-day liquidity, 3-day repos, 4-day repos, especially when liquidity was tight. But with the re-emergence of the daily repo, that is really status quo ante, it clearly indicates a regime shift. We are going back to a position where the Reserve Bank is ready to stand by on a daily basis and give not unlimited liquidity as they used to, but give 50,000 crores. So that really counts as a change of mindset, and probably when it coincides with the governor and the most important deputy governor changing, it looks like a regime shift. It could be interpreted as one. Besides, of course, the easy liquidity is only 50,000 crores. The market deficit is more than 50,000 crores. It's often a lakh crore and even more. But this is definitely some kind of a relief. The Reserve Bank is also doing something called swaps. They did it twice in the last 7 days. They sell dollars in the spot market so that the rupee doesn't depreciate too much. And then they do a buy-sell so that, the liquidity is provided back to the market and the liquidity withdrawal is postponed. Basically, it is the swaps are a liquidity infusing instrument. Given both these, the market is of the view that the Reserve Bank is on the side of providing more liquidity, and therefore possibly a rate cut in February can be expected. You know, if the liquidity is very tight, a bank cannot pass on a rate cut. They will still want to keep deposit rates high so that they can continue to gather liquidity through deposits. Now, if the liquidity eases, then when the rate cut comes, it will get passed on. So all told, the markets are on a cheerful mood. Add to it the US CPI core CPI coming in lower than expected. There is a good 5-6 basis point fall in bond yields, and if you compare it to the high of the week, then it's a 10 basis point fall in the yields. So bond markets in a cheerful spot.
Absolutely, Lata. Thank you so much for giving us the explanation on this front. But let's move on and let's focus on some stocks which are on the move today. We have HDFC Life that's surging in trade after a strong set of third quarter numbers was reported by the company. Yash is joining in with us to give us more details on this one. Yash, good afternoon. HDFC Life holding on to gains of 8% as of now.
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates in terms of specific numbers. For new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3569 crore rupees. Retail AP again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Okay, Ash, thank you so much for that. And let's move on. Another stock, that is L&T Tech, that is also surging in trade on the back of its third quarter results. We spoke to Amit Chadha, who is the Managing Director and CEO at NASSCOM Executive Council member, regarding the company's Q3 performance. Listen in to what he had to say.
Our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year, or 16.2 that we've got. And I do see quarter 4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
Let's move on. And Yoga Bank gets an approval to raise funds via QIP, confirming CNBC-TV18's newsbreak. Now, speaking to CNBC-TV18, the bank's MD and CEO Ashwini Kumar, who says that the process for raising 2,000 crore rupees is underway. Listen in.
Yes, we have got the approval from Government of India to go ahead with the QIP plan of raising 2,000 crore. Our plan is to go in the one tranche after this quarterly audited results. Then we'll go to the market and we'll have a road show and discussion. Preliminarily, we have started discussion with some of the investors, and hopefully after the quarter end, we'll come out with the QIP. With this, we'll have around 3% reduction in the government stake. Currently, government stake is 95% in our bank. And with this, 3% stake will come down 92%.
Okay, on that note, we're going to step into a very short break. When we return, Bollywood actor Saif Ali Khan has been stabbed during an attempted burglary. We get you the latest update on this one on the other side.
What is the story that you would like to tell?
No, right now my laser focus is on my next film and preparing for it. And the new story I want to tell is Irish cricket, Scottish cricket, and cricket from the Netherlands. It's exciting me. It's something new, you know. It's like this new toy I've got my hands on. I'm really looking forward to it. I can't wait to start working on it. I've never been the kind of person who's very good at just going and waving my hand. You know, I'm somebody who likes to get down on all fours and get dirty and really work.
Be in the
for it.
trenches.
Oh, I love that.
And on the other side, when you look at the quality companies, I think the internet platforms and anyone who has the potential to use stuff like AI well, those companies I think still are very interesting.
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price hikes. And even the retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, Jio and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Jio too, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember, would be the July hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter, the overall subscriber base declined by more than 10 million on a sequential basis, perhaps as the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will watch. But remember, the stock has been a bit of an underperformer. So
Thanks for staying tuned into Mr. Sanj on CNBC TV18. Now, in some shocking developments from Mumbai, a Bollywood actor Saif Ali Khan has been stabbed during an attempted burglary at his home. The actor is currently being operated upon at the Leelavati Hospital. We have Santya joining you with us to give us more details on this one. Santya?
So the attack happened
happened at around 2 this morning when Saif Ali Khan, his wife Kareena Kapoor and both the children were present in the house. So according to the prima facie investigation of Mumbai Police, Vinny, this is what happened at around 2 this morning. The house help, who's actually the caretaker of the children, Mrs. Aliama Phillips, who's also known as Lima, she went to the younger son's Jay's bedroom and she found this person, this accused, this intruder, hiding in the bedroom. She cried out for help, and in the meantime, when Saif could come to protect her, the children and the rest of the members, the attacker had attacked the house help, the caretaker, and when Saif entered the bedroom, he and the accused, according to Mumbai Police, got in a scuffle, and the accused was carrying a sharp knife-like object, and he stabbed Saif Ali Khan 6 times. Out of these 6 cuts, 2 were deep and 1 was pretty close to the spine. He was rushed to the Leelavati hospital. Just now, Leelavati hospital staff spoke to the media and they have confirmed that the surgery is complete and Saif is now stable and he is out of danger. In the meantime, right now, we are standing outside Bandra police station and the investigation is going on. Mumbai police is yet to arrest the accused here. At present, they think that there was only one person involved. They are checking the CCTV footage. Crime branch is also unofficially investigating the case. 10 teams have been formed and they have been sent to multiple locations in Mumbai. Mumbai police is confident that they will be able to nab the accused in a few hours. But the question is, how exactly did he manage to enter a high-profile? The building was in a plush area. We are talking about Pali Hill, Pali Road, Bandra. That's the area we are talking about, Vinny. How did he manage to enter the building? What about the security? And what exactly was the motive? Why did he attack the actor and his? Why was he planning to attack the family members? How did he manage to go inside? And who is behind this? All these questions are yet to be answered by Mumbai Police.
Absolutely important questions yet to be answered. Thank you so much for the latest update coming in here, Santhya. And we'll keep you all more updated with this news flow as well. But in some more national news updates that we have, now ISRO has successfully executed the SpaceX experiment which involved docking 2 satellites in the space. India is now only the 4th country after the USA, Russia as well as China to complete this historic feat. The 2 satellites were launched on December 30th and Prime Minister Narendra Modi also tweeted his congratulations to the team, calling it a significant stepping stone for India's ambitious space mission. On that note, we are going to step into a very short break. But up next, we'll get to the latest updates that's coming in from West Asia as Israel and Hamas reach a ceasefire deal.
Reliance Industries share price declined for the first time in 9 years and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptake. Even the telecom business is likely to see telecom, stable. Tariffs retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
For the third quarter for Reliance's retail business, because of muted consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, Quarter 4, Quarter 1 and Quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins. And we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year on year growth in the EBITDA and 8 to 9% growth quarter on quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Yusta and Swadesh, And finally, their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
Welcome back and thanks for staying tuned into Business Lunch on CNBC-TV18. Let's move on. And after 15 months of fighting and tens of thousands of people being killed, Israel and Hamas have finally agreed to ceasefire and hostage deal. The agreement is set to take place on Sunday. Now, NBC's Richard and
little celebration in Tel Aviv Square, where families of hostages usually gather. NBC's Danielle Hamamjan is there.
There are only a few people gathered here at Hostage Square. One family member telling me they want to see all the hostages back before they can celebrate.
And in his farewell address, just hours after the deal was announced, US President Joe Biden made clear that the deal was possible, he says, due to the work of his administration. Listen in.
After 8 months of nonstop negotiation, my administration, a ceasefire and a hostage deal has been reached by Israel and Hamas, the elements of which I laid out in great detail in May of this year. This plan was developed and negotiated by my team and will be largely implemented by the incoming administration. That's why I told my team to keep the incoming administration fully informed, because that's how it should be, working together as Americans.
Also, during his farewell speech, President Joe Biden also warned about of a tech industrial complex that has been bringing an avalanche of misinformation and disinformation and could pose dangers for the country.
We see the same dangers of the concentration of technology, power, and wealth. You know, his farewell address, President Eisenhower spoke of the dangers of the military-industrial complex. He warned us then about, and I quote, the potential for the disastrous rise of misplaced power, end of quote. 6 decades later, I'm equally concerned about the potential rise of a tech industrial complex that could pose real dangers for our country as well.
And moving on, the short seller Hindenburg Research has decided to end its operations. In a note published on its official website, founder Nate Anderson said that he is winding up the company as they have finished the pipeline of ideas they were working on. Now, the short seller began its operations in 2017 and quickly gained prominence for exposing poorly managed firms. From car maker Nikola to ICANN, the company targeted most and some of the biggest corporate names. Its biggest target so far has been the Adani Group, which it claimed indulged in stock manipulation and corporate fraud. And with that, we're absolutely out of time on this edition of Business Lunch on CNBC-TV18, leaving the markets with gains of almost 0.5% on the benchmark indices. Up next, you have Midcap Radar to take you through the market action, so don't go anywhere.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum. Starting from our first story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
It's mid-cap radar time this Thursday afternoon. You're with us on CNBC-TV18. I'm Hormas Patakia. With me as always is Vivek Iyer. And Vivek, we left the studios half an hour ago. It was still at 23,320. It's still at 23,320. And we are awaiting some very important results today. 3 Nifty companies reporting results today. But the broader markets are doing well for themselves today.
Absolutely right. Broader end of the market's doing very well. The mid-cap, small-cap indices both up over 1%. The Nifty Bank is the one that's also aiding the rally. That too is doing quite well. But we have quite a lot lined up on the show. Let's start off with the top headlines. Advances far outstrip declines as heavyweights inch up and mid-caps rally. Strong gains in US overnight on easing inflation and the move. Realty, PSU banks gain while FMCG and consumer durables drag.
L&T Technology Services rallies after an inline third quarter which sees its highest ever quarterly deal bookings. Management maintains its medium-term aspiration of $2 billion in revenue and margins of 17 to 18%. On the other hand, Oracle Financial slips in trade after the company's revenue declines on a year-on-year basis.
Paytm jumps more than 4% after brokerage firm MK upgrades its stock to a buy rating and raises its target to 1,050 rupees a share from 750 rupees earlier, citing reasonable valuations.
CEAT has come under pressure following a weak third quarter. The margins have declined almost 380 basis points due to higher raw material costs. The EBITDA also fell close to 20% from a year ago.
Aeroflex Industries hits upper circuit in trade today after the company's net profit and revenue surged year-on-year in Q3 FY25. Management tells CNBC-TV18 that FY26 growth will be much better than growth seen in FY25. Company also announces expansion plans.
Well, the benchmark indices are where they are, but the broader markets are doing fairly well for themselves. The mid-cap index is up over 1%, and as is the small-cap index. And with this move, both the mid-cap and the small-cap index have recovered almost everything that they lost on Monday, as they ended off the highs of the day in yesterday's trading session, but ended in the green. And today, the small-cap index is up over 1.5%. The mid-cap index too up over 1%, closing in on the day's highest point as well. Of course, as we mentioned, we are awaiting three very important earnings from the index heavyweights, be it Reliance Industries, Infosys, and of course Axis Bank, most of them coming after market closing. Reliance has surged to the highest point of the day. Infosys conversely has slipped to the low of the day, and Axis Bank is holding on to gains of 1%. But there are plenty of other movers in the broader markets, and which are those? Vamakshi is joining us to tell us just that. Vamakshi, good afternoon.
Well, good afternoon, Hormaz. It's a good day for trade for the mid-cap stocks. Let me first pull up the list of top gainers. We have GMDC. That stock is up nearly 12% in trade today. Jupiter Wagons is another one that is surging over 13% in trade. Econ and RVNL. RVNL has a news flow. That stock is surging nearly 8.5%. Apart from that, all of these sugar counters are seeing a surge today. All of them are up in trade because sources are suggesting that the ethanol price hike is on the cards. Keep in mind that this is something that the industry was asking for, and resultantly we're seeing stellar gains, especially on Sri Renuka as well as Bajaj Hindustan Sugar. Apart from that, PSU stocks are rallying in trade. Keep in mind that Punjab and Sindh Bank reported its numbers yesterday. That stock is seeing a surge of almost 7.5%. Indian Bank, Union Bank and Bank of India, all of these counters are up somewhere around 3 to 4%. Apart from that, there are several stocks reacting to their numbers as well. We mentioned Aeroflex Industries just a short while ago. That stock was locked in upper circuit. It moved away from that and then again is back in the upper circuit. Mahindra EPC has been locked in the upper circuit since morning. Transrail Lighting, that stock is up nearly 3%, and L&T Tech Services, that stock is reacting to a good set of numbers. And lastly, on the flip side, let's also look at some of the stocks that have lost momentum in trade today, are under pressure. Newgen Software is down nearly 5%. CEAT as well as Kalyan Jewellers. Kalyan Jewellers has been in pressure over the last couple of days, continues to be under pressure as of now as well.
Thank you so much, Vamakshi, for joining us and giving us a sense of what exactly is transpiring in the broader end of the markets. Well, let's now dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, CNBC-TV18's Nigel D'Souza interviewed Praful Kulkarni, founder Alpha Leo Capital, to understand why traders must learn to avoid the noise in the market.
Any practical tips for the traders? How can they stick to their strategy and avoid overreacting to news?
News, I think it's a very important question, because most of the people overestimate their ability to judge the exact outcome of the markets to the news. Two things here. One, we need to understand that we don't have the capability to exactly judge what would be the possible outcome or how would exactly market react to the news. And the second thing is, we need to understand that we are at the bottommost layer of the information chain. By the time you get the news, understand that the game is already over, you are late to the party. And at the same time, since you don't have the capability to take such big bets and sit through the ups and downs, and you don't have the capability to exactly judge how the market's going to react, I would say retail traders are better off not looking at the news, and they would just have to stick to their strategy by completely eliminating the noise.
Welcome back to Mid Cap Radar. Well, DB Corp just posted its Q3 set of results, a slightly muted set with net profit and margin both declining on a year-on-year basis. To discuss this and the outlook going forward, we are joined by Girish Agarwal, Promoter Director at DB Corp. Good afternoon, Mr. Agarwal. Thank you so much for joining us. First up, give us a sense of how exactly ad revenues panned out. We understand we are coming off a much higher base last year on the back of election spending. But how has Q4 shaped up in terms of ad revenue, and how was Q3 too?
So if I would see the 9 months, I'm happy to bring to your notice that we have done the highest ever top line and bottom line in the 9 months since the inception of the company. Last year, as you know, 3 states were under election in our markets, MP, Rajasthan and Chhattisgarh. So because of that, this quarter, we have a 1% growth only. But if you look at 9 months base, I think from 9 months this year and 9 months last year without the election, I'm at a double-digit growth on that way. So I think that way, business looks comfortable. I think my larger concern is going forward, because if you see this quarter, the India GDP is 6.4. I'm slightly worried on that, because if this quarter continues like that, then I'm sure all the industries would show a slightly muted results, and that will impact on the advertising directly.
Mr. Agarwal, good afternoon. Thank you for joining in. But since you mentioned about the GDP growth, how is the current quarter shaping up? It's still early days, right? But what are you expecting in the fourth quarter? Do you expect this current growth rate to sustain? And what is an overall growth estimate that you have for FY25?
So, on the advertising front, the automobile, real estate, education, FMCG are doing decent. They are doing pretty decent, I would say. But government advertising is fluctuating. And I hope they continue this way. That's one. Second thing, one best thing happening for the industry is the newsprint prices have come down. Like if I compare my last year and this year, 9 months or even 3 months, I'm down on the newsprint price on a 3-month basis around 5%, on 9-month basis around almost 10%. So I think that is providing a major respite to all of us.
Understood that. Mr. Agarwal, so margin improvement aided by lower newsprint prices is something that we understand. So Q4, can we see sequential improvement, and FY26, can that improvement sustain? Any guidance that you could quantify for us?
I think on the Q4, as I say, we're already in January, and I'm not yet seeing major response or rebound coming from various categories. So now let's hope what the budget has to say in the next 10 days' time. Based on that, I think your 26 also will get clarified.
Mr. Agarwal, it may not necessarily be a business question, but in the early days, every time somebody would wake up, the first thing that they'd pick up in their hand is the newspaper. Now, the first time they wake up, they see their phones to check the news. The newsprint business for you continues to remain soft as well, right? Even though you mentioned that newsprint prices have come down, the digital business continues to grow. How much is digital now a part of your business? And do you see this as the new normal going forward as well?
First of all, I would like to correct you. People do get up and check not the news, check up the WhatsApp, that what their friends has to talk about. Okay, family, everything is all right or not. For news, I'm happy to say almost all my readers, those who are reading us every day, are very much intact. There's a reason why time spent of our newspaper and most of the newspaper stays there. Having said that, are people reading news on digital also? Yes. So in the morning, they're reading newspaper, and during the day, they are reading a digital. So I think this combination will continue. But at the same time, I guess all the newspaper organizations need to ensure that they offer more quality, more in-depth research to the readers, so that the habit of spending that 35-40 minutes in newspaper continues.
So what's the newsprint to digital mix right now, Mr. Agarwal, for you?
95% of my revenue comes from newspaper and the radio. Digital is hardly anything.
Mr. Agarwal, one question which we want to ask you is FY25, in terms of circulation, will you see growth? Would you be able to quantify the growth? And going forward, what is it that you're targeting? And what are the key triggers to go ahead and drive circulation growth?
This year, the growth has not come, but you rightly mentioned that now the time has come since the newsprint prices have gone down. So we as an organization are running a huge readers scheme. Like we are running a current readership scheme for motivating our readers, the fringe readers, the casual readers to come back, read more. The prize is worth almost 14 crores is being offered to the readers. Every participant gets a prize. Idea is to create excitement in the category. See, one thing what is happening, if you see as a consumer, every possible category offers me some excitement apart from the product or services what they give me. So we realize that maybe in our category also we need to do that. So I guess all the newspapers, because of the newspaper prices down, we have the ability to offer that saving back to our readers. I'm sure we are going to do that.
One final question from my end, Mr. Agarwal, is on margins. You know, they improved from the previous quarter, but year on year, they're still slightly lower. With newsprint prices coming down, do you see them trending back to normal levels? What's the outlook there?
At a 28-30% margin, what are you talking about here? We're already sitting at 28-30% margin. 1% here and there doesn't make much of a difference.
Okay, thank you so much, sir, for joining us, giving us a sense of how business is shaping up, and we wish you all the best for 2025. Well, now as we slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
When you started Kabaddi, you said you'd have to work 2 years and do a couple of films to be able to fund that.
Yes.
How much more do you need to do on the film side to be able to fund this?
Well, thankfully, I've moved on from that thought process. I realized about 2-3 years into Kabaddi and football that signing innumerable films to finance my love for sport and the business of sport was not something which I was very happy doing.
Or sustainable?
It is sustainable. It might not be a lot of fun. I started up my family office. I streamlined the finances. It's taken me about 7 years. But thankfully now...
You've got a healthy balance sheet to be able to fund this?
We have a balance sheet and allocated funds through my family office that I can run a sporting business. And I will turn heaven and earth upside down to make sure it's profitable.
So what's the path to profitability?
A conservative figure is 5 years. I'd like to try for 3.
So you've been playing international level badminton for almost 15 or more than 15 years now. Do you feel it also defines who you are as a player now? How you've matured as a player, your journey, your experience?
Yeah, definitely yes. The person you are, the confidence levels that you show on court are very important. And I think as a person, when you ride there, when you stand and people, when they look up to you, they also need to understand that yes, she has done a lot for the country. And that itself shows that how confident you are when it comes to the way you are, the way you show up, the way you prepare and the way you stand yourself in terms of, let's say, when it comes to style, when it comes to your personality, when it comes to your confidence levels. It is very important.
Right. Yeah. When you're speaking about your career, one thing when I was hearing you speak, how would you define a winning mindset, both on court and in life?
I think it's very important to believe yourself. I think that itself defines who you are, what you are, and what you stand for, whether if it's on or off court. I know people might say that, you've been very successful, what else you need in life? But I think to get till there itself was a tough task. But I have been very fortunate to have people around me have been very, very positive and very supportive. So I think for me, success definitely means everything, but I think initially nobody is born with a golden spoon. Everybody need to work hard and be smart enough to work hard. It's not just few months of hard work, but it takes years and years of hard work to come to a level. I think coming to a level is one thing, but maintaining that level is a different thing altogether, and it takes even more time and hard work, and it takes a lot of your time to maintain that. So I think for me, success, I think badminton has been my passion. So I would do anything to be successful or to be at the top class level.
Right.
Yeah.
So just the way you handle a victory, how do you come over defeat and failure?
Definitely, I mean, every athlete or every person goes through it.
Welcome back to Midcap Radar. Well, a quick stock check on Yatharth Hospitals is what we are looking at. This particular stock at one point of time during the session was down close to 7 to 8%. It's seen a bit of a sharp recovery there. But one of the reasons for the kind of volatility that you're seeing in the stock price today has been an Ambit note. Ambit, in fact, has written a note where they have dropped coverage on Yatharth Hospitals, and the last rating that the company had, or Ambit had, was buy. What is it that concerns Ambit, and why have they dropped coverage? They are saying that IT raids that were initially conducted in October 2023, there have been sufficient lack of disclosures. Along with that, they say that the recent move by authorities to attach various properties and equity shares in subsidiaries raises concerns. On the back of that, they've gone ahead and dropped coverage on Yatharth Hospitals. It's a lot of volumes on the stock today, and also very, very volatile. But it's seen quite a bit of a sharp recovery from the intraday lows. But we'll now shift focus to the sugar sector. Sources to CNBC Awaaz suggest that Cabinet may soon approve an increase in ethanol price. To discuss this and more, Prashant Biani, Vice President of Institutional Equity Research and Sector Lead for Agri-Input, Sugar and Hotels at Elara Securities, joins us now. Good afternoon, Prashant. Thank you so much for joining us. Well, you've seen the story that was done by our colleague from CNBC Awaaz. What are your first thoughts, and how does this impact the sector?
Good afternoon. So the move, I will say, is mildly negative in my view. If the government increases only the B-heavy ethanol price, we were expecting some increase in cane juice-based ethanol price as well. Because in the last 2 years, we have seen that FRP for sugarcane has increased, but the last revision in juice ethanol price was only 2 years back. So the cost of production for the ethanol manufacturers have shot up, but not the realization. So it is mildly negative in my view if there is no price hike in the juice ethanol segment. So this is what we were expecting in B-heavy ethanol, price increase of 3 to 5%. So B-heavy ethanol price increase is fine, but we were expecting something on juice ethanol as well.
So if this does not take place for the cane juice bit, and it only takes place for the B-heavy and the C-heavy, Prashant, what is the kind of impact that you are expecting on the margins of a lot of these companies?
So C-heavy ethanol price is same as what it was earlier. Earlier it was in the form of additional incentive. Now it has been in the main ethanol declared price as well. So there's no change in C-heavy ethanol profitability. But I think there will be some downward revision in overall distillery EBIT if we have only B-heavy ethanol price and nothing on cane juice. Because cane juice volumes are also likely to be decently higher this year, because this year we are seeing full-scale ethanol blending. So that will be a bit margin dilutive for the distillery business.
Understood that. Now let's talk about the current state of operations. Are operations viable in the current set of prices? What is it that sugar companies would be hoping for?
So operations are very much viable. Only in case of grain ethanol, I think the industry would be expecting some price increase, both in your FCI rice as well as ethanol based out of maize. But otherwise, for any kind of feedstock relating to sugar, which is your B-heavy, C-heavy, or cane juice, operations are viable, but the return on capital employed is less. So no one is making losses in sugar-based ethanol, but returns would not be adequate for juice ethanol.
Now, Prashant, there are also talks of allowing exports of up to 10 lakh tons. Now, ISMA wants 20. If this move does go through, what is the kind of impact that you foresee?
So So if exports are allowed to the extent of 1 million ton, I think there will be some relief on the balance sheet side, while it would be lower than expectation because we can export around 2 million tons. But I am expecting relief on working capital requirements, nothing much on the EBITDA front because internationally prices have come down vis-a-vis what they were earlier. A year back around 26 to 28 cents. Now they are hovering between 18 to 19 cents. So no, not a major impact on EBITDA, but certainly on the interest component part, which companies incur on working capital, there some relief is expected.
Thank you so much, Prashant, for joining us and giving us your take on what is still a developing story. Well, a couple of stocks on the radar. Remember, quite a few important results today, so it'll be interesting to see how the stocks are moving just ahead of the results. We had the numbers of Sterling and Wilson Solar that just came about, and the stock is reacting quite positively to that. It's a back-to-black quarter as far as Sterling and Wilson is concerned, up 6.5%. The other stock on the radar is Reliance Industries. The stock is now near the day's highest point. Also have a look at Infosys today. Infosys is another stock that will be coming out of its results. And Axis Bank, that is the other stock on the radar. Axis Bank too will be in focus and they'll be declaring the results today, Harmas.
Important to keep an eye out on all of these names, but the one stock that continues to move higher regardless of where the market is BSE, and that is now 3.5% higher today, heading towards the mark of 6,000. It's slightly off the highs. It already made a high in excess of 6,000, so now trading near that mark, so 3.5% higher there on BSE. And the other one that's seeing some bit of selling pressure today though is Motilal Oswal, and that stock is now slumped to the lowest point of the day, 5.6% lower on Motilal Oswal Financial Services. And there you can see it's been a one-way drop since the morning. It opened higher, but since then it has continued to decline and now down to the lowest point of the day, 18% down in a month is Motilal Oswal. Kalyan Jewellers has seen a bit of a recovery from the lows of the day. At one point was down 4.5%, now trading with losses of anywhere close to 3%. Kalyan Jewellers, mind you, the stock is in the F&O band today, so no new positions on that as well. And one more before we call time on the show is Trent, and that is trading 3% lower in today's trading session, among the top losers on the index. It just made an announcement today. They'll be declaring results on the 6th of February. But with that, it's a wrap on this edition of Midcap Radar. The Nifty continues to remain above 23,300. From Vivek, me and the team that put this show together, thank you so much for watching. MF Corner up next.
Losses and I think ups and downs are part and parcel of life. It's important to let go. I know it does take time and it is easy to say, but I think it's not just end of the world, you know, when you lose a match. You get to learn a lot more and you need to come back stronger. That's what I've believed in, because I've had toughest matches where I was nearly there and then I just missed it out. But I think I've learned a lot from that, and for me it was very important to believe in myself and have that hope that I can do it again.
Right. So what's the Sindhu way of coming out of the defeat, getting your mind back on track? What's the mantra you follow?
Well, I mean,
you could tell us after any match that you remember which was very close to your heart and was difficult to get over.
Yeah, recently I think, not recently but Tokyo I would say, where my Olympics, the second Olympics, I lost in the semi-finals. And of course it was very, very hard, but I had mixed feelings, mixed emotions where, you know, I was feeling bad, where if I have to think I lost an opportunity, you know, I lost a chance to go to the finals. And on the other side, I was thinking, do I have another opportunity to play the bronze medal match? So I was like confused, I was upset, I didn't know what to do. I just had that, I would say, less than 24 hours to decide and come back stronger. So I think that was the perfect example that I could remember and tell you now, because it was really hard at that point of time, because you lost the semi-finals and you lost the opportunity to go to the finals and get a gold or a silver. Rather, you have another opportunity to prove yourself, right? So, yeah, I mean, my coach and my parents just told me that there's a lot of difference between the fourth and the bronze. So, at that point of time, my mindset was like completely like, I was like, no matter what. I couldn't even sleep that night because I had a match next day in the morning, and obviously I just gave my 200% and I got that bronze back. So
right, just come back harder. Just come back even
yeah,
harder.
I think the belief is very, very important. Just believe in yourself.
Bibi, we'd also like to ask you about this debate over 70-hour, 90-hour workday. It's a rage on social media. People have different views about productivity, not being forced into 90 hours. Rajiv Bajaj has said that if you want to work 90 hours, it should really start from the top, and if it's successful, then implement it. And it's not really about the number of hours you work, but about the efficiency and productivity you show. What would be your view?
I would not say this is right and this is wrong. My only thing would be, how many hours ever it is. I would say it needs to be useful, and there need to be a good change in whatever you do. I think that is the only thing I can say, because talking about hours, I think people ask me how many hours do I play,
Hello, good afternoon. You have tuned into CNBC-TV18 and you're watching Mutual Fund Corner with me, Vinny Motiwala. I'm in the Mumbai studio. At a time when the markets are seeing volatile movements coming in, it is imperative actually to go back and check your mutual fund portfolio. Whether you're starting off also, it's going to be important to see how should you start your portfolio, how should you build your portfolio at such a tough time. Now, that is what we're going to be talking about and addressing in today's show. How viewers can address the volatility, how often should they rebalance their portfolios, how should they start building their portfolios. Now, to talk about this, we have special guests joining in with us on the show today. We have Kalpesh Ashar, CFP and RIA at Full Circle Financial Planners and Advisors, as well as Jimit Modi, founder and CEO at Samco Group, joining in with us. Very good afternoon, gentlemen. Thank you so much for coming to the studios, and it's a pleasure having you both on the show.
Thank you.
Now, let's start by talking about this important topic, because every time I look at the market, sometimes I'm wondering, like, okay, if you have already started, what should the strategy that one should follow, given that you're seeing such volatility that is coming in? How should you balance your risk and reward, selecting the funds? That's going to be important in such a market, right? Kalpesh, starting with you, what is it that a viewer should be looking at right now?
Okay, so thanks, Vinny, for having me on the show. The times in which we are living right now, volatility is the name of the game, and we all have to live with it. And especially when you are in a market which is so full of participation and a lot of, I would say, inquisitiveness of everyone that what's going on. At that point of time, I think coming from the financial planning, school, I would always advocate that one should make a portfolio which is based on his goals. So a goal-based strategy, while creating a portfolio, will always stand you in good stead. And what I mean by building up a goal-based strategy and a portfolio which is in sync with it is nothing but aligning your mutual fund schemes which are in sync with your financial goals. So if you have a goal which you have highlighted to be coming up anything between, say, today to the next 3 years, there should be no second thoughts, but all the investments which you have got for that goal should be in debt funds. Because there's not going to be that type of volatility and you have to live within that range of returns, but there is no risk. Second, if you have a medium-term goal, which is again timeline-wise a 3 to 5 year time frame, then there could be a mix of debt funds and hybrid funds. And your advisor could advise you what could be the proportion. But still, if you see the word equity doesn't figure there. But anything beyond 5 years, if that's your horizon for a particular financial goal, then majority of the chunk of your portfolio should be dedicated to equity-based mutual funds, diversified mutual funds, and more importantly, also have some portion of it in hybrid funds or little bit of debt funds like an hedge. So a goal-based strategy, I think, is the answer to the risk and reward which a person would derive, and probably let him, sleep in peace while the volatility carries on.
Absolutely. That sleep in peace and getting proper sleep at night is the key to any investments or anything that you do in life. But Jimit, strategies that you would suggest also to an investor, what is it that you would tell them?
So I think there are two parts to this. First is, I think the way we look at it is you need to make sure that irrespective of your horizon, you have something that is called as a strategic asset allocation. and then you have a tactical asset allocation. No, the strategic asset allocation is you decide what asset classes you want to be invested in from a medium to long-term perspective, and that part of the asset allocation by and large remains static. It's only the tactical asset allocation piece that you keep moving around basis market volatility. Now, if you look at how performance of various categories, asset classes have done in the past few years, I think a good thing for from a tactical allocation perspective would be for investors to sort of relook at moving some funds from the extremely risky buckets of, let's say, a mid-cap, small-cap to a slightly more diversified pool. Because if you see, there has been a massive proliferation of folios and funds in both the mid and small-cap categories. So I think in times of volatility, after a great rise and rally, it makes sense to move and reallocate, rebalance part of your assets from risky assets, as I said, from mid and small to large caps, or if you're in only equity-oriented assets, move part of your assets to hybrid-oriented assets, like Pesh was suggesting. And that's how you have to look at it. And I think the strategic part of your portfolio, I think that by and large should remain constant. Those are things that you should not end up tinkering with basis market volatility. Otherwise, you will end up doing too much rebalancing, too much tax incidence, which will, at the end of the day, result in a net effect, a negative effect for your portfolio.
Absolutely. So, Kalpesh, do you think now, like you were mentioning also debt fund, equity fund, and you gave the timelines of how one should be keeping a mix. Now, in the current situation, if I am, looking at my portfolio, is it time to actually start prioritizing more debt funds, or how should one look at it? If today is the situation where we saw, the first week of Jan seeing so much volatility, what is it that one should do?
Okay, so assuming that still the horizon is long term for an investor, I'm talking of a hypothetical situation. Because the markets have been, so much on an upswing and so much of positivity and expectations have been generated in the last 3-4 years, and it's given above average returns, I think more than people have expected what they would give. And, running against all the negativity which was prevailing, you had wars and whatnot. In spite of that, last 3-4 years have been completely a upswing.
Yeah.
Now, given that scenario, without sounding pessimistic, pragmatically, it could be that this year could be a little bit of a breather.
Yeah.
Or you could not expect that type of returns. Again, I'm not a analyst, or I'm not making predictions. I'm just going by probably something which could happen. And if that were to happen in the life of a long-term equity investor, I would suggest that a little bit of consolidation and a strategy, I would say, evolving is required, in the sense that whatever investments that person would be putting could be through the STP and surely through the SIP route, rather than making some very wild and obnoxious calls that everything is going to go fine in this year. I think time to be a little cautious. Continue with your equity allocations, but through the STP route, and obviously the SIPs need to be continued, because this is the time, in case if there's I would say a downturn or a negativity, your SIP would buy you more units. So this is the time to collect more units.
True.
The values will come later on.
True.
So that is part of the equity allocation. And debt, if again you are an equity investor, there has been a lot of expectations on debt which have been built up because of the rate cut, which is still not happening. But debt could still form a part of your core portfolio to whatever extent I think would be an appropriate hedge.
Okay. Jimit, how should investors at such a time, if there is turbulence in the market, actually look at asset allocation method also, right? We have gold mutual funds as well. There's so much that has come in terms of an asset allocation format. What is it that, you should be looking at in terms for that strategy?
So see, I mean, if you are a beginner from a mutual fund perspective, and if you are just starting out investing in mutual funds, and if you don't know what is the right asset allocation for you, then I think probably first get in touch with an advisor, get in touch with a CFP, get your asset allocation in place, and then make these investment calls, move to the next step, which is selecting the schemes. If at all you cannot probably afford a CFP, and if you decide to go direct, then a lot of mutual funds also now offer asset allocation products within categories itself. So you have the balanced advantage fund category, or the dynamic asset allocation fund category. You have the multi-asset allocation fund category. These categories typically operate as multi-asset categories, which automatically do the job of asset allocation from an investor's point of view. So, if you're a beginner, you don't know what you want to do, you'll be better off starting with these hybrid categories really, and then moving on. If you're very evolved and, if it's been a few years of your mutual fund investment journey and you've been investing for the past 5, 6, 7 odd years and your objective is wealth creation, then if your objective is wealth creation, it should not matter what happens with a 10% correction or a 12% correction. It's quite meaningless. You stick to your asset allocation. If you've decided that I'm going to have 30% multi-caps, 20% large caps, or 20% small caps, then you stick to that. There's no need to unnecessarily tinker with those allocations just because there is an 8-10% correction in the market. So I think one has to decide what stage of their life they are in. What is their objective with investment? So is it maintenance of wealth, making sure that you are taking a conservative approach? Then you'll sort of move towards more debt-oriented assets, more hybrid-oriented assets. But if your objective is wealth creation, and you've designed an equity-oriented or a hybrid-oriented plan, then stick to it, and then there's no need to unnecessarily tinker with every 10% fall, because markets are going to fall 10% invariably every 12-18 months. You can't keep moving around every 12-18 months because I'm panicking with what's happening with the market. So you've got to take a long-term view, stick to your plan, and if you can't make your plan yourself, go to a financial planner and get that built for yourself.
Sure. Kalpesh, coming to the same question with you, asset allocation, importance of that, for a new investor at such a time, what would you suggest?
Huge. I think asset allocation is the heart of an investor's portfolio. And here, many people I completely agree with what Jimit has mentioned, all the points, and not repeat them. But one thing, here, Vinny, I'd like to point out is many investors, even evolved investors in a bull market, tend to confuse asset allocation with diversification. So a person would say, just for example, that, I'm diversified. So when you ask him, what is your diversification? He'll say that I'm diversified into large cap, mid caps, and small caps. But he still doesn't understand he's in the same asset class, which is equity. And he tries to feel that he's diversified, but not into anything else. So he doesn't have fixed income in his portfolio, neither does he have gold in his portfolio, which actually is a complete non-relative to the equity market. So asset allocation needs to be specified and nailed into a person, that you need to be in different asset classes which are not related to each other. And that is where this multi-asset allocation funds or a balanced advantage funds come into picture a lot. And if you can't do it yourself, like what he said, get professional help.
Yeah. On that point also, I just want to understand how important is also the role of international funds in such a situation also. Is it time that one should actually look at international funds, or, now we have those sector-specific thematic funds as well. Does that also count in and come into those sector allocations, or is it counted as a part of that equity side that we are already doing?
Yeah, so I just mentioned that. So that's a geographical diversification. If you ask me, international funds is a geography, but under the asset class of equity. So the content doesn't change, the risk reward doesn't change there. So international funds is good. If you're in the equity thing, you want to diversify in that, but again, don't get carried away because it's just international name attached to it. Understand in which demographics are you investing, which countries are you investing, and what is the exposure given to each of the sectors there, because equities globally is the same way it works everywhere. So if you don't have sufficient knowledge, then again, mutual fund is good, international fund is good, but again, I would say don't have it more than 15 to 20% in your portfolio just for the name international.
Absolutely, because that sometimes, you are like, okay, maybe I may just invest in that market through the mutual funds.
People tend to get swayed.
Yeah.
And that is where the role of an advisor comes to, hold the horses back.
And your thoughts on international mutual funds as well in the part of your portfolio?
So I think, like Kalpesh mentioned, I think you should not have more than a 15-20% allocation. Also, I think international investments and international funds are more suitable for an evolved investor who's already reached a certain stage and is willing to sort of take additional risk. I don't think for by and large most people you need to sort of go and take that additional diversification. So at best 5-10% allocation. In any case, now allocating into international funds via the fund route is sort of restricted because of the RBI ceiling of 7 billion. So to that extent, yes, but even while, let's say, if it were to open up, one should not go all out and say, oh, I'm going to only invest in NASDAQ ETFs or NASDAQ fund of funds or so on and so forth. You've got to have a balanced approach. Make sure that exposure is restricted to 10-20%, and that's about it.
Okay. On that note, viewers, we're going to slip into a very short break. Don't go anywhere. We'll carry forward the conversation on how you should be making your mutual fund portfolio, keeping it balanced, and adjusting the risk to the factors of market volatility after this break as well.
Play so many hours, or is it important that you play only for a few hours? So even that debate keeps going on at times. But whatever it is, it needs to be in a very smart way, and it needs to be very useful for everyone, and everyone needs to be happy at the end of the day. That is it.
My final question, what do you think India as a country can do more in terms of encouraging sports and making sure we do better at Olympics year after year? Athletes like you work very hard. It's a tough journey. You go through injuries, defeats, failures, bounce back again. It's a constant journey. But what can we do to have a greater sporting culture all the way from top to the bottom, or from bottom up?
I think it's very important that you have a very good system. That is very important, and I think everything needs to start from the grassroots level. Not that when you come to a certain level, people then say that, okay, we need support or we need the infrastructure or everything, but it needs to start from the grassroots levels. And I think I'm happy to say that we've been getting a very good support from the government, and there've been good support from the sports authorities. At the same time, I think there needs to be a lot more leagues happening, so that there are a lot of youngsters who are doing really well, but not able to prove themselves. I think leagues now, if you see, there've been Coco, and then there've been tennis and pickleball. A lot of leagues are coming up, and I hope there will be a lot more in every sport, because these kinds of leagues, a lot of people get a recognition in terms of
Welcome back to Mutual Fund Corner on CNBC-TV18, and keeping it going with the conversation with Kalpesh as well as Jimit. Gentlemen, the next thing I want to talk about is also in terms of active and passive fund. What should we be watching out for at such a time? In a volatile market, what is it that is normally preferred, or what is it that one should look at, Jimit?
So I think, again, the difference between active and selection of whether you have to go for an active fund or a passive fund depends on the category that you're typically investing in. So, passive funds are great, and so are active funds. But I think what you need to make a decision on is that depending on which category, let's say you allocated 10% to large caps. In that particular category, there is empirical evidence to show that passive funds may have done slightly better than active funds. Whereas when it comes to small cap funds or hybrid funds or multi-asset allocation funds, actively managed funds which have a slightly more dynamic approach have done better than passive funds. So there is no right or wrong black and white answer when it comes to the argument of active versus passive. Again, passive funds are great for people who understand, have their own plan, and they understand where they want to put, how they want to allocate their money, and they may just go direct picking passive funds. Whereas, sometimes if you're still, as I said, starting out, still nibbling, trying to figure out what you need to do, a financial planner or an advisor may recommend a mix of active and passive funds. So that, again, as I said, you have a balanced approach, and in categories where passive works really better, you have passive exposure. In some other categories, you have more active exposure. But as I said, there is no right or wrong answer as to you only do active or you only do passive.
Your thoughts, Kalpesh? The financial planner is here for us as well to tell us on that.
So if a financial planner were to answer this question, I'll do best what's for the client. And that's actually in his interest, that a goal-based scheme would be selected for him. But just as a tactical strategy, like what Jimit said, supplementing it, I would simply say that if, we know that the benchmarks have been beaten in the large cap space by the passive funds, I would still give active a chance, because you never know which side the ball swings. So say, for example, in a large cap, I would want to allocate 100 rupees. I would still buy one active fund and one passive and give 50-50 to both. But surely small cap and mid caps, I trust our Indian fund managers and Indian AMCs to do a good job of stock picking, and more importantly, for the retail investor who's trying to get into the small and mid cap arena, mutual funds is the best way, because they are shielded, they're cushioned by a lot of research which goes into an AMC, and they would at least do a better job out
Absolutely.
there.
I think, if I may add one point here, I think what's important is also to understand that nowadays a lot of active funds end up implementing index hugging strategies. So what they end up doing is they end up having 70-80% similar portfolios to indices, and then so I think investors must look at a metric called as active share. And when they are looking at active funds, they should make sure that they're actually investing in an active portfolio which is different from the index, and actually getting their money's worth when they're paying a management fee to an active manager by virtue of having a slightly higher active share.
Sure. Kalpesh, you spoke about SIPs, right, and investing, and how it becomes, when the markets are too volatile, it makes sense sometimes because you're averaging out the price and SIP makes a deal. But what about lump sum? Does it make sense to do lump sum investing at such a time?
Yeah, it does, because when there is a person as a planner, if I see that he has got this money with him right now, and suitable to it, again, if the markets are showing some type of indication that this is really, I'm not trying to time the market, but this is really 10-15% from the lows, and the client or the investor would be better off keeping the money in funds rather than keeping it in a savings bank account. I think a combination of these 2-3 factors would call for a lump sum investment. But again, if you make a lump sum investment as a strategy, I would probably again supplement it in the time to come with an SIP. Because you don't know which side that lump sum would go. So even if you have a lump sum made, and if the markets were to fall, you have an STP or an SIP to again buy further units into that particular fund.
Kalpesh, your thoughts coming in on thematic funds, systematic funds. What are your thoughts on that front, to have that in your portfolio?
So again, when it comes to thematic funds, there are two types of thematic funds. One is what they call diversified thematic funds, and in that case, again, it may make sense to have a 5, 10, 15% allocation to diversified thematic funds, let's say like a low variance fund or a momentum fund. These are all thematic fund categories, a business cycle fund, which offer a slightly different strategy as compared to standard diversified funds. I think what an investor should probably try and avoid are extremely thematic or fancy sectoral funds that are playing specific themes. Let's say if you're trying to play a defense theme or a railway PSU theme or a PSU bank theme, and because these kind of themes and these kind of sectoral funds will require you to sort of make sure that you get in, get out at the right time. They're probably best suited for a manufacturer rather than an investor. So as I said, the investor has to probably make that differentiation of which are the really diversified thematic funds that could make some sense in their portfolio from a 5, 10, 15% allocation perspective, and avoid the ones that are, as I said, really fancy in nature. And what ends up also happening is that a lot of these thematic funds are often launched after some of the best performances behind. So they end up marking top of the cycle typically, and I think we've seen that especially in the last year, where a lot of these specific sector-specific thematic funds have made.
That was the trend last year. 2024, every time I heard it, everyone wanted to only know about that.
Correct.
So that was surely the trend. But given that such cases come in, what is it that there's a warning sign that one should watch out for? If I'm investing on my own, that, okay, in my mutual fund portfolio, maybe there's some risk that I'm exposed to. What is a warning sign that I should be triggered by, Kalpesh?
So two things here, Vinny. One is, when you see a portfolio and some person asks me that, is this a good portfolio? Is it prone to risk or what it is? Two things I would like to, see here first. Does this individual have a penchant for NFOs? Because those are sold like hotcakes by the AMCs, and the investors lap it up. Again, just thinking, ye kuch naya hai, Whereas probably in most of the cases, it's old wine in new bottle, okay? and they just clutter up the entire portfolio, and there is evidence to it that nothing happens in that. And the second one is like what Jimit said, and the last question was cluttered with too many sectoral funds. So if that is the case, you know that this person is acting like a herd mentality and doing what the entire, the environment is doing around him, and not looking at what is right for himself.
Absolutely.
So that is a big warning sign in any portfolio, because ultimately what is mutual funds, Vinny? Mutual funds are nothing but a diversification of all your equity done in a professional manner. Now, if that is going to be concentrated, or if that is going to be the same thing in an overlap, you're not doing justice to the mutual fund definition itself. So that's, I think, the biggest red flag which you could see in a portfolio. And one more thing is too many funds.
Yeah.
So you could have a person doing 25,000 SIPs, 25,000 rupee SIP per month, and he could be doing it in 10 different schemes. It just doesn't make sense, because he's just overlapping the portfolios and adding to his cost, and more importantly, losing his peace of mind.
True. Jimit, quickly, we are absolutely out of time, but quickly, how often should one review their portfolio, and how often should you rebalance your portfolio?
So I think typically you should review it every quarter, once every quarter, and the sweet spot from a rebalancing perspective should be once every 12 to 18 months.
Okay, cool. Thank you so much, gentlemen, for joining in with us on the show. It's a pleasure having you both and understanding how one should be building their portfolio. But with that, we are absolutely out of time on this edition of Mutual Fund Corner. Don't go anywhere. Up next, closing bell.
A lot of athletes who take them as an inspiration and prove themselves and have that confidence that yes, even we can do it, because a lot of people are doing really well, are working hard, but they're not getting that opportunity or not able to have that platform where they can prove themselves. So leaks like these will definitely help them to come up and think that yes, we also have something to actually look up to.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
The markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the
Taiwan index 2% up. Hang Seng holding on to gains of more than 1.5%.
The CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA.
But as I prepare to leave office, our friends are strong, our enemies are weak.
20 is conquered now, and 40 is in sight. So 23,347 is the first resistance.
Post-COVID, rural had slowed down for obvious reasons.
What they have announced is they will start a daily repo.
UK has upgraded Paytm to buy from ad.
At 130 odd points higher on the Nifty.
Aspiration to get to $2 billion and 17 to 18% EBIT levels.
Total AP, that is ahead of poll, up 12% at about 3569 crore rupees.
Yes, we have got the approval from Government of India to go ahead with the QIP plan.
23,300 on the Nifty as the benchmark indices gain close to about 0.3%.
We left the studio half an hour ago. It was still at 23,320. It's still at 23,320 and we are awaiting some very important results today.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
And the Nifty is still at 23,300. It's been that kind of a day. We had a gap up opening. We slipped about 100 points from the top early on. But after that, for the last 4 hours or 5 hours, the Nifty has been hovering around 23,300, give or take a couple of points. Absolutely straight, quiet, consolidation kind of session. The mid-cap index higher for the 4th day in a row, outperforming with a gain of close to about 1.2%. Global markets were upbeat, but again, in the Asian market, barring the Taiwanese market, which ended with a gain of more than 2%, the rest of the Asian markets, the gains are similar to what we're seeing in India. So a Hang Seng, a Nikkei, a Kospi, these markets are up close to about, okay, in mine, Hang Seng showed actually a smaller gain. But in some of the other markets, the gains were actually about 0.3 to about a half-odd%. The dollar index has eased, from 110, it's down to 109. The ceasefire in Gaza, all that is helping on the sidelines.
Well, that's right. The softer dollar index is good. Have we seen peak Trump? That's very, very important because, the optimism on President Trump taking office on 20th of January, that's what's pushed up the dollar index, which has cooled off a little bit. So the good news. One positive today is the Nifty Bank. That's the one that was dragging. That was the underperformer. And that's made a higher high yet again. So a higher high from the Nifty Bank, a higher low as well. It's up close to around 500 points. The bulls will take that. We had a one-way slide. The other positive is if you pull up the number of stocks advancing, you have close to around 2,000 stocks that are advancing for around 500 stocks that are declining. So that ratio is still 4:1. And the breadth of the market is good. So the bulls will like that as well. However, the last 60 minutes, it could be rather exciting. Because just looking at the options data, it appears on the downside that 23,250 mark, that's the goalpost on the downside. While on the upside, it appears it's at around the 23,350 because the direction is right. You have the premium that's come down in the last few days as well. So we'll have to keep an eye out on that. 23,350. That's the crucial mark that you're looking at on the upside. So that 100-point range is what is being played for. We'll have to see how that goes from here on. I think we should get the 23,300 call. Yeah, I think that one should come up for you on the screen. Well, how do you position yourself, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, fill us in with what's the strategy? It's been an okay session. 80-point gain, Nifty Bank up 500 points. Well, pretty much okay. And Reliance Industries seems to be finding its form post the last 1 year's underperformance.
So now Reliance is one of my recommendations, but before that, the index. I think the Nifty, the good thing is that it's not falling much. The bad thing is that it still didn't sustain about 23,350. But as I said, I think, slowly if it can consolidate at these levels, then I think it should make an attempt to get past 23,350, 400 zones. And once that happens, I think the bounce back will extend by another 150, 200 points. So in that sense, I think, trading with mostly positions on the stock side, but with slightly long bias, given the fact that I'm looking at an upside continuation. Similarly, the Bank Nifty, the levels of 49,700, 750 are important. We didn't get near those levels. But as long as the Bank Nifty is sustaining above 49,100, I think there's a good chance that it could pick up steam again. So stay with trade with positive bias. On the stock side, as I mentioned, Reliance is something which I like. So buy here with a stop at 12.47. Look for 12.90, and then in a good case scenario, even 13.10, 13.20 could happen on the upside. That's one stock. And the other stock which I have on my list is Maruti. See, last couple of times, the stock prices failed to get past 200 average. Today is also trading around that same level of 200 average, which is at about 12,105. So buy about 12,150, then take a 100-point stop loss and look for targets of 12,450, 500.
Mitesh, hi, afternoon. We'll get to Yash on HDFC Life, but in the life insurance stocks, is there a standout chart?
Yeah, I think all these stocks, HDFC Life, LIC, and ICICI Pru have given some kind of a reversal, and no doubt that HDFC Life has also, given a very strong breakout of the gap, though it's come off the day's high. The 200 average for HDFC Life is at about 648. So closing about 650 would suggest further continuation, and one can look at 690, 700 as the target area. But I would still want to see the stock close about 200-day average. The other stock is ICICI Prudential Life Insurance. I think that's also showing signs of bottoming out. Now, the stock needs to sustain above levels of 644, 643. And if it can do that, then I think the first target is 675.
Okay, afternoon guys. Looking good, right? I mean, 80, 85 points higher, and market breadth, by the way, is super strong. Some 2,000 stocks are up, and you got about 600 stocks which are lower. So broader market actually outperforming what large caps are doing at this point in time. So, but one of the stocks, Mitesh, thank you very much for that. We'll come back to you for the BDST calls a little later. But one of the names which is not participating in this up move and which has fallen a lot, of course, is Kalyan Jewellers. It's, I think, down another 2% today. Mangalam is here to just recap, I mean, what has happened with the stock and the damage we've seen. And of course, maybe some reasons as well. Mangalam, over to you.
Absolutely, so if you look at Kalyan Jewellers, the ferocity with which the stock had moved higher over the last 12 months, it had nearly doubled over the last 24 months, nearly 5 or 6 times. So it's confounding the kind of decline that we're seeing in the stock price as well. This week, the stock is down about 16%. This month, it's down about 31%. And off its highs, the stock is down around 33, 34 odd percent as well, losing a third of its value in just the last few trading sessions itself. Remember, it was only in December series that the stock was first introduced in futures and options. And today, the stock also, trades in F&O band, which it entered yesterday itself. Fundamentally, the company has been reporting strong growth faster than everyone else in the industry, and all the clarity that the management, the street was seeking from the management has come about in the interview that they had given to CNBC-TV18, and alongside that, the conference call they held as well. So it's important to then look at who the participants in the share would be and who the major stakeholders of the company would be, and what could be any sort of moves that would take place out there. So if you look at the domestic shareholders, one fund that's standing out here is Motilal Oswal Mid Cap Fund, which over the last few quarters it has increased its stake from first at around 4.29% to now 6.3%. Whereas the other funds that we have, Franklin India and Sundaram Mid Cap Fund, they hold some stake in the company, but they've been reducing their stake. Franklin India, for instance, is down from 1.8% to 1.31% holding. Sundaram Mid Cap down from 1.3 to about 1% itself. What are the promoters doing? Promoters increased their stake in the company in August because the FIIs, Warburg Pincus had offloaded its stake. Promoter bought about 2.36% from Warburg Pincus at around 535 rupees. And even if you look at the December shareholding pattern, where promoters hold 62.85% stake, 19% of their pledge or their stake is still pledged. So to that extent, this decline in share price, will that affect that or not is the big question. That brings us to the third larger shareholder chunk, that would be the retail shareholders. Over the last few quarters, retail, which held about 4.5% stake in the company, that too has increased to 5.1%, and the number of shareholders has increased from 3.6 lakh to around 5.6 lakh as well. The final piece in this, assuming all the fundamentals of the company continue to grow and the analyst expectations, we haven't seen any downgrades or any sort of revision or commentary coming in from the analyst community itself. At peak, the stock was trading at 103 times, almost at par, if not more, as compared to Titan. And now it's come down to around 68 times. 1 year forward, at peak it was around 65 times, now come down to around 44 times as well. So a stock that saw a big rally is now giving up some of those gains, perhaps overvaluation, perhaps some of the concerns. We'll look at what the key stakeholders in the company are going to do. And all of this just points to one thing, the reason why Titan trades at a certain premium to the industry, because, we haven't seen such wild moves on stocks like Titan.
Indeed, Mangalam, well put. Titan has been the one that commands those premium valuations in the past. We have seen PC Jewelers, Tara Jewelers, just to name a few, and they just fell by the wayside. But that's the big talking point, this week has been Kalyan Jewelers. Deven Choksi is with us. Deven, what do you make of the stock? I'll tell you what, the largest shareholders, as Mangalam mentioned, one is the promoter entity who had bought stake at similar prices. Their hands are tied because they've entered that silent period, till the end of this month. I think January 30th is when they'll come out with the set of numbers. And also you have Motilal Oswal, I think as a percentage of their AUM, they have already hit the limit out there. So both the largest stakeholders, they can't come in there or buy more even if they wanted to. So, that's one point. What's your view on the stock? 800 rupees, now down to 530. Promoters bought at 530. Would you buy?
So, Nigel, I think few concerning point. One would be that expansion into the newer stores is happening at the franchisee model. So, which means that I think the margin, which is already thin, I think could further get thinner. That is, I think, a concern, and that could possibly affect the future outlook. And suppose with the strengthening of the dollar, if the gold prices has to come down, then at least in near term, I think that impact may be seen into the books, if not for long, but at least for near term, it may be seen in the books. So that could be the reason for which I think today the view is that the stock prices probably have firmed up, and I think it has topped up, I believe, in this environment. We immediately do not have any view, but we believe that I think the larger run that this company has had in this market, probably some amount of price correction is also equally due technically as well.
Okay, all right. Just one more stock that's caught everyone's imagination because of lab-grown play that's out there. Goldium. The stock in the last 1 year, I think it's up 3x. In the last few minutes, it's fallen to the low point of the day. Could be routine profit-taking. But from the highs of the day, that stock as well has lost close to around 8%, 200% up in the last 12 months. I think a 6-month, majority of the move has come in the last 6 months or so. And, in today's trading session, some bit of profit taking is what we are seeing. Well, let's focus on trend though. Mangalam is still standing by. Mangalam, yesterday you had a initiation report that said trend to the high point of the day. Today, Kotak thinks otherwise, and the stock is actually one of the underperformers.
Difference of opinion is what the market is made of, right? Yesterday, Elara believed that maybe the company would continue to compound at higher levels with Zudio holding on to its moat and Westside playing a supporting role, whereas, Kotak believes the exact opposite, saying that maybe there could be some cannibalization for Zudio and Westside isn't growing as fast as they expected it to be. The stock already has corrected about 26% from highs. It's, rallied about 96% in the last 12 months, despite the correction that we're talking about. And it was high yesterday because Elara had a target price of close to 8,500, very close to its previous all-time high of close to 8,200 as well. And today, Kotak has downgraded the stock to sell from add. Why is that? Because they believe going forward, incremental revenue growth per store may actually be slower due to potential cannibalization. This cannibalization is something that we had seen in Jubilant Foodworks as well, when, they were opening Domino's stores across the street from one other as well. And all of that impacted the same store sales growth. Could there be a case for Zudio as well? Because they believe that, if that were to happen, then the growth that the street is expecting could be much lower, and as a result of which they've also trimmed their FY24 to FY27 revenue estimates by about 1 to 2% and EPS estimates by around 9 to 14% itself. And as a result of which the target stands revised downwards from 6,800 rupees to 5,850 rupees. We keep an eye out on trend going forward.
Well, let us see if numbers start to come off a little bit. Remember last quarter number, the rate of growth was strong, but compared to what trend usually does, it had fallen. Rate of change matters for high PE stocks. If the rate of change starts to slow, PE start to come off quite a bit as well. But we'll see as the numbers come in. Devin, any thoughts on trend here?
So Prashant, I believe that I think everything is in price. I agree that I think there is a growth, and growth is likely to continue for the format in which I think they are, particularly I think the affordable format like Studio. I believe that I think every aspect of the growth is in price. Probably if the growth expectations are not met, then the valuation will not sustain at current levels. And that's a worry. In most of the cases, when I think you are picked out at the valuation level, I would think that I think one will have to be a little bit more careful buying this stock in the market. Because I guess I think the growth numbers assumed by I think most of the analysts may not sustain, I think, in the subsequent quarters. And that's a reason for which I believe that I think buying at a lower price would be more reasonable than I think venturing anything at this point of time.
Okay. That's the view coming in on trend. Let's get to the big mover of the day, and that's HDFC Life. The stock is up close to about 10%. Yash is joining in with the earnings fine print.
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates in terms of specific numbers. For new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3569 crore rupees. Retail APE again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Thank you very much for that. Well explained. Devin, do you own HDFC Life or any of the life insurance companies?
Yes, I think we have been liking the underlying strength of the insurance businesses, and probably I think though in last 6 months or so, they have had the challenging time with the repricing of some of their products and repositioning of some of their products in the markets. I believe that they have successfully overcome that challenge. I think when you look at the third quarter number, particularly for HDFC Life, the second quarter versus third quarter numbers, I think definitely suggests that I think the product portfolio and the pricing of the products, I think, has basically worked well for them. It is also getting reflected into part of the margin improvement on a sequential basis. So, considering the fact that the fourth quarter is expected to probably produce faster and better rate of growth because of the last quarter of the year, I believe that I think the numbers would show up smartly in the fourth quarter. So certainly the stock on the embedded value to EBITDA is right now putting at a reasonable price. I don't think it is premium as it used to be earlier. So certainly I think that demands some amount of attention to adding to the portfolio. I agree that the upside will be slightly limited, but at the same time, I think the re-rating of the business, I think on the insurance side is definitely on cards.
Okay, thank you very much for that. We will slip into a very short break on that note. But here is some good news for all our viewers, because India's business news leader is now just a click away, introducing the all-new app. You can get instant access to breaking news, all the in-depth articles, financial world updates at your fingertips. So don't forget to download the CNBC-TV18 app now from the Apple or the Google Play Store and just scan the QR code on your screen.
Entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
I think it's going to be, I believe, not a very high return market, to be honest, the next few quarters. The thing is, rather than forecasting anything, the biggest thing is last 3-5 years have been solid in terms of returns. Obviously, valuations are high. And two is, as you pointed out, we're entering a phase where the world's largest economy is going to see a fairly radical regime change. We don't know what exactly will happen in terms of dollar strength, yuan weakness, trade tariffs, etc. So there is a lot of uncertainty, and the valuations are probably, on an aggregate, not reflective of that uncertainty. But having said that, I think there is value at polar opposites of the market. I think a lot of tier 2, tier 3 financials are almost at distress valuation. And I believe that in India, secured lending will still be okay because in general, we are a reasonably high inflation economy. So the asset values keep inflating. And a lot of the tier 2 private banks, PSU banks are at book or below. So I think there is a risk reward opportunity there. I think there is a risk reward in metals at this point of time. And on the other side, when you look at the quality companies, I think the internet platforms and anyone who has the potential to use stuff like AI well, those companies I think still are very interesting.
Okay, welcome back. 90 points, 23,300 is where we are at. Nikhil Ranka is with us, CIO Equity Alternatives at Nuvama Asset Management. Nikhil, good to have you back on the program. Thanks very much for your time. So first, a market view, Nikhil, because this entire episode of big FII selling started. I remember it was a turning point, and we had a conversation, and you were early on it. Do you have a definitive view on how this will pan out? It's muddy and unclear. What's the view?
So good afternoon, Prashant, and thanks for having me on the show as always. If you remember, in the month of October when we had turned a bit cautious on the markets, from October onwards to now, we have seen close to $25 billion of selling in the Indian markets. And at that point of time, if somebody would have said that, we will see $25 billion of selling and markets would be down just 10-12%, you would be very happy with the outcome. Now, what has happened is, in October, the same thing had happened with Chinese markets, where FIs were significantly underweight that markets. And at the slightest positive news, there was a scurry to add on to positions in that market. The same thing has happened over the last 3-4 months with the Indian markets, where FI positioning is now at a 15-year low. In terms of data points that we typically track, if you look at the FI positioning on index futures, they are now short to the tune of close to $2.5 billion. And another interesting data point is, after a long time, we are starting to see the GIFT Nifty trading at parity to Indian Nifty. So typically it used to trade at a discount of 20 to 30 points, which was indicative that there was shorting pressure from FIs. But now we are starting to see parity between the two, and that's the first sign that probably FIs will now start covering their short positions. If and that happens, I think the up move can also be equally swift in the markets. The second point is, if you look at the earnings outlook, the rupee depreciation has given a natural cushion, I think, to the earnings downgrade cycle. Because if you look at IT and pharma sectors, it's a dollar P&L over there, which gets multiplied by eventually the rupee dollar rate to get at the final EPS outcome. The rupee depreciation of 3% and some bit of margin benefits because currency has depreciated by 2.5–3%. Would mean that there could be some upgrades in IT and pharma, and therefore our view is overall the risk of earnings downgrade from these levels for the markets is extremely low.
Nikhil, hi, Rima here. But we've seen some wild moves in IT this time in the earnings season. TCS went up 5%, HCL Tech tanked 7–8%, perhaps more, and today LTTS. It's not that the numbers were completely out of whack compared to expectations, but we've seen some big moves. How do you position yourself on IT now?
So, Rima, what has started to happen in IT now is more than the numbers, people are starting to watch out the commentary of the management. So, in the specific instances that you have told, TCS earnings were weak, but management said that they are seeing first signs of discretionary spending coming back. In the case of LTTS also, they have very clearly said all the three verticals should start seeing some growth. And therefore, the reactions are more than numbers, a function of what the management outlook is. Wherever we are seeing that management commentary is extremely good for the next 2–3 quarters, in spite of numbers being subdued, we are seeing stocks reacting on the upside. My sense is IT should more be a consolidation band. One, because they have not corrected as much as the broader market has corrected. No doubt there is some cushion from the rupee depreciation that has happened. And therefore, to that extent, from an overall perspective, the view is that the upside could probably be restricted to single digit in most of the IT names. But on the downside also, I don't think that these stocks will, fall 10–20%. I think it's a trading band of +10 to -10 in IT stocks. That's the broad outlook that we have for IT.
Okay, hi Nikhil, good afternoon and good to see you. Ben, what about the ones that are not for the faint-hearted? OMCs, it's all probability Q3 is going to look blockbuster. Though the prices are indicating nervousness still, and you have crude oil prices that are spiked up yet again. So how do you approach OMCs, and what about specialty chemicals? I recall there was this phase that everyone was jumping in, and then those stocks saw very, very sharp drawdowns, 20–30% on a couple of names as well. What's your view on both these two?
So, good afternoon, Nigel. So, on OMC specifically, if you look at it, Nigel, the street has got concerned because crude oil prices have moved from $72 to $82. Now, if you look at the sanctions that have got imposed on Russia and some of the tankers, the total quantum of crude oil that is at risk from these sanctions is close to 2 million barrels per day. If you look at the OPEC spare capacity, that's sitting at close to 6 million barrels. So even in a worst case, if we assume that these 2 million barrels do not find alternative routes, because the last time also this thing had happened through some way or the other, this eventually hit the markets. Our OMCs also enjoy discounts as high as $10 to $12. But I am saying leave that apart, even if this doesn't come into the markets, OPEC has enough spare capacity to pump 2 million barrels and stabilize the markets. And therefore, our base case is eventually the up move in crude will not sustain. Crude should head back down again. And therefore, at these levels, two things are positive for OMCs. One, if in the budget we get some element of subsidy for the LPG losses that they are suffering, the estimate is anywhere from 30 to 35,000 crores that they should get reimbursed for LPG losses. Then obviously numbers will start looking very good. And most of the OMC names are now trading at close to 4 to 5 times EV/EBITDA on an FY26 basis. So as and when we see crude starting to reverse, I think the up move can be equally swift in these counters. Anyways, our view is from these levels, given that GRMs also are showing strength, the downside in these names is extremely limited from the current levels. On specialty chemicals, neither specifically on the refrigerant space,
Yes.
we saw that up move. There were talks that there are price increases that these companies are contemplating, and obviously if that happens, there's a potential 20% EBITDA increase that can happen for some of these names. But a large part of it is actually factored into valuations because most of these stocks are trading at close to 25 to 27 times FY26 EBITDA. On the agrochemical space, we still feel that there is pressure on margins and the outlook there has not changed so significantly. So we are not positive on specialty chemicals, focused more on the agri side in that sense. But yeah, some of these names I would say on dips will start to look very, very interesting.
Right. Nikhil, for those who are not constrained by sort of, running a portfolio, right, and who can and who are kind of more flexible in what they can do, just as an approach this year, do you think it'll be it's one of those years where you're going to see lots of ups and downs and more trading kind of market, or you think the steady move higher and higher that will return at some point? What's your sense?
So, Prashant, historically, if you have seen, Indian markets have delivered compounding in the range of 11 to 12%. And the maths for that is very, very simple. You have 6-7% of real GDP growth, 4-5% of inflation. So on a nominal basis, we've compounded our GDP at close to 11-12%, and that is the historical CAGR of Indian markets. Last 4-5 years were exceptionally good for us. We have seen returns in the range of 18-19%. And so to that extent, we will have to temper our expectations that the market returns will again start looking more in the range of 10 to 12%. Having said that, our view is that 23,000 to 25,000 should be a near-term range for the markets over the next 6-7 months. And I think what everybody is looking for is what happens when Trump assumes office on 20th. If we do not see any ugly tariff wars in the first week of him assuming office, then obviously that will soothe a lot of nerves and markets can start to rally back again. So I think a lot of things will get clearer in the next 7 to 10 days as to which way the geopolitical things are moving. And once that happens, I think the extreme and heightened volatility that we have been seeing in the last 2.5 months, that should subside because anyways, even if you look at the positioning in the markets, the single stock HNI futures open interest, which was at close to 1,65,000 crores, has now come down more closer to 1,30,000 crores. So there has been reduction in speculative positions that were there in the markets. And to that extent, the market is looking much lighter now as it was as compared to 2-3 months back.
Okay, so a broad range, 23 to 25 on the Nifty and more clarity in the next 7 days or so. One thing is clear, it's going to be lots of news flow. How much of it will be consequential for markets over the next 7-10 days? We'll have to see, as Nikhil pointed out. Thank you very much, Nikhil, for joining us. Good speaking with you and good conversation, as always. Now, Reliance is set to report numbers and third quarter earnings. Rima will tell us what to expect at an aggregate level. And then, of course, as we get into it, we will, of course, look at individual segments, etc. a little later. But headline, Rima, what are we expecting?
Well, the key will be the margin improvement at the EBITDA level because revenues will be flat, but EBITDA should improve on a quarter-on-quarter basis. And this will be driven by, one, the oil to chemicals business. Now, O2C has been under pressure in the first half of the year. But in the current quarter, we've seen the Singapore GRMs inch up. So Singapore GRMs went up from $3.6 per barrel in Q2 to about $5 per barrel. So therefore, the refining margins for oil to chemicals should push up, and this will drive about a 10% increase in the oil to chemicals EBITDA. So that's going to be driver number one, that O2C, after 2 tough, challenging quarters, is now looking a lot better in Q3. Secondly, for Telecom, it would be the second consecutive quarter. Now, remember, Reliance Jio and the entire industry hiked prices in July. Now, typically, it takes about 2 to 3 quarters for the full pass-through to take place because some people may have a 3-month, package. So therefore, for the full recharge to take place for all the customers, it takes about 2 to 3 quarters. So this would be the second consecutive quarter. Even the prior quarter was strong because of tariff hikes, and so will the current quarter be. We're looking at about 7% jump in the company's EBITDA for Reliance Jio, and the ARPUs, the average revenues per user, should inch up to above 200 rupees. 205 is the level that we have, and retail too should have a relatively decent quarter, again aided by festive season. Where we could see pressure would be the upstream EBITDA. So upstream EBITDA margins could come under a little bit of a pressure on account of lower production. So that's a nutshell for Reliance Jio. The focus will be on improving operating margins, improving EBITDA, driven by oil to chemicals, telecom, and even retail will have a decent quarter. But brokerages are turning upbeat on Reliance Industries over the last couple of days. And the key driver is that last year, Reliance Industries declined for the first time in 9 years. So it's gone through a period of underperformance, and this year, this earnings performance is likely to be steady. So refining will have a better year, telecom should have a steady year, and even retail, even if there is no pickup in consumption purely on account of a low base, the expectation is that retail will have a double-digit EBITDA in the current year. And plus, if there is monetization in the form of any IPO for retail or Jio, that would be the additional kicker the street is watching out for. But that's about Reliance Industries. Typically comes out closer to 7 p.m. Axis Bank also in focus ahead of its Q3 numbers. Abhishek joins in for more.
Well, it's expected to be a weak quarter for Axis Bank. Our poll suggests the NII growth on a YOY basis may be one of the lowest that you are seeing in last 13 quarters. Now, deposit and advances growth will be seen closely. Now, Citi estimates deposit growth of 11% YOY and 3% quarter-on-quarter, which is higher than the industry average, while they estimate, advances growth of 10% YOY and 2% quarter-on-quarter, which is lower than the industry average that we had as per RBI data at the end of December 24. So, net interest margin may decline both YOY and quarter-on-quarter. Kotak Securities estimates 11 basis point decline in net interest margin YOY and about 4 basis point on a sequential basis. Slippage is expected to rise quarter-on-quarter. Again, Kotak Securities estimates a slippage of 5,000 crore versus 4,400 crore in the previous quarter. So asset quality expected to deteriorate. Citi estimates gross NPA ratio to increase by 20 basis point quarter-on-quarter and net NPA ratio to increase by 10 basis point on a sequential basis. Provisions can remain elevated, thereby impacting the earnings momentum. Again, Kotak Securities estimates 198% gain with respect to provisions rising on a year-on-year basis and 5% increase on a sequential basis. Near-term, loan growth outlook and deposit growth outlook will be seen closely. Deposit is becoming a challenge for the sector. Our poll suggests NII growth of 9% YOY and about 1.5% sequentially. We are working with a profit growth of 3.5% YOY and a decline of more than 9% quarter-on-quarter. Back to you.
Thanks a lot for that, Abhishek. Well, time to slip into a short break, and as always, we'll get you a check into dealing rooms. Nimesh will be joining us in a special segment, D-Street Chatter. A couple of trading ideas as well coming in on our buy today, sell tomorrow. Our technical experts will be back with us.
The key takeaway from Reliance's earnings this time will be the margin expansion or the EBITDA expansion. So despite a flattish revenue growth, the CNBC-TV18 poll throws up a near 8% expansion in the company's EBITDA, driving margins to 18.4% and driving about a near 7.8% increase in the company's profitability. So the key is going to be the EBITDA expansion this time. And what will be the drivers for that? One, the O2C business, led by refining margins, will see a pickup in the company's EBITDA. Secondly, this would be the second consecutive quarter where Reliance Jio, the telecom arm of the business, will do well, aided by the July price hikes. And even the retail is likely to continue to see an uptick in the EBITDA given the festive season sales. That said, the upstream EBITDA could remain under a bit of pressure, and that will offset some of the pickup seen in the O2C, the refining, Jio, and the retail business. So let's talk in a little bit more detail about the O2C business. Well, the first half of the year was extremely challenging for the oil to chemicals business. We saw the overall EBITDA decline. But this quarter, we're anticipating a pickup in the company's refining margins. Look at the Singapore GRMs. Singapore GRMs went up to about $5 per barrel in Q3, which compares to a $3.6 per barrel in Q2. So there was a pickup in the refining margins, and that will reflect in Reliance's O2C business. For Reliance Jio too, this will be the second good quarter for the company. So we're working with a revenue growth of close to about 4.8%, margin expansion to about 54%, driving a 10% increase in the company's profitability on a quarter-on-quarter basis. The key reason for this, if you remember, would be the July hike. So whenever there is a tariff hike, and in the case of Reliance, it was about a 15 to 20% tariff hike, it takes 2 to 3 quarters for the full flow through. So even Q2 was a strong quarter for the company. That's the prior quarter, 7% jump in revenues. Their ARPUs went up by nearly 7.5%, and this would be the second quarter as the full pass-through takes place. So we're working with the ARPU expanding to above 200 rupees this time. But what you need to watch very carefully would be the subscribers, because last quarter, the overall subscriber base declined by more than 10 million on a sequential basis. Perhaps as the telecom tariffs became a lot more pricier, some people dropped off. So does the subscriber base come down again? That's something that the street will.
Welcome back. Well, no big fireworks as yet in the final, 60 minutes or so. We are more or less flattish. But I'll tell you what, pull up the IT index. The street is getting a little bit nervous about tech right now. Infosys has moved to the low point of the day. I'll tell you what, if, we saw what happened with TCS, may not be such a bad thing. A stock goes soft into its numbers, deliver an inline performance, don't disappoint too much, may not be such a bad thing. But for the time being, the tech stocks have moved a little bit lower. As promised, Nimesh is with us. He's here to tell us about what he's picking up in D-Street action. Nimesh, take it away.
Hi, Nigel. A strong day. At least we've held on to the early morning gains, and there is no selling or profit booking, so to speak, after the gap up. And again, the broader markets are outperforming, so that's a good sign. The mid-cap index is up 1%, but a lot of individual names are buzzing and are rallying in today's trade. So at least looks like the near-term upside momentum in the broader markets have resumed, and there is a bit of interest as well from retail and HNI category. So that's overall feedback from a flow perspective. On the institutional side, though, again, it's a mixed day, but flow seems to be slightly on the positive side now, especially in select large cap names. And within sectors is the financials, and within that the PSU banks have done well, and some bit of traction seems to be back in the metal names today. So a bit of buying there as well is what I understand. Technically, we are very close to that crucial support of 2300. The feedback is if that gets taken out, you will see a further short-term, very fast rally on the Nifty and the Bank Nifty. So that's something which the bulls will like to defend. But 3 big results to watch out today. Infosys will react. Reliance will be a big number to watch out for, and of course Axis Bank as well. So a bit of position there, but I guess at least from a flow perspective, looks like some bit of selective buying in large cap has risen by larger institutions.
Okay, Nimesh, and what about stocks? What have you picked up?
So in terms of individual names, the first stock is Alchem Labs. Well, the stock has been consolidating. I understand there could be a corporate development very soon. A potential inorganic move is what I understand the company is looking for, and it's likely to be a domestic acquisition. But again, this is something to track in Alchem Labs. So that's the first name. The second stock is Godrej Properties. Across the real estate name, some bit of buying is back, and Godrej stands out largely because of very strong buy flows. Expect high delivery volumes. And after the recent correction, there is a bit of interest back in the real estate names, including Godrej, DLF, and others as well. The third stock is Nazara Tech. That stock reacted very sharply to the announcement of a board meeting on Monday. There is a board meet for fundraising via pref issue. I understand the existing shareholders are likely to invest, and that could potentially trigger an open offer as well in Nazara Tech. So that's something to track on Monday as to who gets into the preferential allotment. And the last is Sammaan Capital. Again, after a long time, some bit of interest is back. The stock is reacting today, good volumes as well. Again, for Sammaan Capital, the fundraising is lined up. I understand a leading long-only fund is an active buyer already in the market, and they may potentially, come into the fundraising as well. So, looks like there is something on the cards as far as fundraising is concerned in Sammaan Capital.
Nimesh, with Nazara, are the existing promoters looking to sort of play a smaller role? Because are these existing large shareholders which are looking to sort of increase their holding?
Well, it looks like, Prashant, because if you look at the shareholding pattern, the promoter holding is very low at 9%. It's largely owned by institutions, and within that, there are a couple of names who own a large stake, right? So, my sense is that the large part of the pref issue will be done to those large institutional investors, and within that, one of the guys will actually turn out to be more than 25%. So potentially there could be a open offer as well after the preferential allotment is done to those large institutional investors.
Okay, all right. Nazara on your screens, 996. Otherwise, of course, the stock has been in focus for the numerous acquisitions it has made over the last say sort of 2 years or so. So that's when, of course, we've had them on the program. The low this month, by the way, in January was 876. And it's essentially recovered about 100 rupees from the lowest level, about 10%, 12%. And of course, up about 7% as well. So it's been ranged for a long time. It's at levels where it was in 2021 or so. Well, let's get Mitesh in to talk about some of these names and, of course, his view on the market trades. Anything new, Mitesh, out there?
So I have a BTST and Dabur. I think, after a good consolidation, the stock is showing first signs of a break on the upside. And while the pivot is at about 530 for the closing basis, or BTST for a target of 530 can be taken, and keep a stop at about 517 half or thereabouts. And the other one is BTST and Kotak Bank, which has stayed positive. And here I would recommend a BTST with a stop at 1794 for targets of around 1825, 1830.
Okay, Paytm is a big mover today on the back of an MK note. Abhishek tells us why MK likes Paytm.
Well, MK has upgraded Paytm to buy from at. They have increased the target price to about 1,050 per share from 750 that they had earlier. They say that the recent NPCI approval in October 24 has released a major regulatory overhang on the company. So this should help the MTU base get built up again over the next 12 to 18 months. The cross-sell retail financial products like home loans, insurance and wealth products, that will help in improving the revenue per customer or per user for them. So Paytm may be on early path to profitability by FY26, post which profits will keep on increasing as per their estimate. They also say that Paytm's cash to market cap ratio is at 21% when compared to 5% for Zomato. Now this provides strong margin of safety for investors. So additionally, a further easing of regulatory stance via potential approval for payment aggregator license, that could be another positive catalyst as per MK for Paytm. Back to you.
Thank you very much for that. Amrish Balika is now joining us on the show. Amrish, first, your thoughts on the market. Do you think the worst is now over? We've priced in and markets should head up now?
Good afternoon, Rima. I don't think that the markets have begun their upward journey. After close to a 3,000-point fall in the last 2-3 months, and if you see the last few days, it's been a 1,000-point fall. It's quite natural that you will have some amount of bounce back. And let us not mistake this as a fresh run-up. I think we should still see further lower levels, and that could happen possibly once Trump is sworn in, once we have more results coming out for Q3, where I see more of a disappointment than surprises. I'll not be surprised if we see levels of closer to about 22,000 or so on Nifty. And I think that would be more of a buying level than the current levels.
Okay, all right. By the way, I wanted your view on some of these sugar stocks because we are expecting some announcements to come in there. But Balrampur Chini has moved down. So there was that hope that we'll hear something on the ethanol price increase. And the street could have been a little bit nervous about the quantum of it. But at least as of now, pull up the intraday chart of Balrampur Chini. From the highs of the day, actually, it's seen a sharp drop because as of now, at least we haven't heard anything with regard to that increase. The intraday chart comes up for you currently at the low point of the day. So some disappointment playing out there. Amrish, what's your view on this space? There is hope that, there could be something in terms of an ethanol price increase. The quantum will be debatable and also maybe some relief on the export front of sugar. Your view on these stocks that have come off from the recent top?
See, in the last 2 or 3 days, we've been hearing those rumors about the ethanol prices, which I think came just this morning. And we had heard about the export quota being increased. This was about 2 or 3 days back. But as of now, there is no official announcement. But the way I read it is that both these need to come because whatever said and done, we have seen that the rupee has become weaker. Oil prices are going up. So somewhere we need to protect our import bill to a certain extent. So I think these announcements should come sooner than later. So I would be a buyer in the sugar stocks on this correction because we have seen Balrampur Chini at a much lower level in the last 3 or 4 days. So I don't see it going to those levels again, but closer to about 450, I think it's a decent buy.
Okay, you have a pick as well, and we'll come to that in just a bit. So just, in a bit from now, what we're going to do is take a break here, but play out a very small snippet of a special interview with the US envoy to India, Eric Garcetti. Of course, he's the sort of outgoing envoy as Trump comes in. There'll be new appointments. He spoke with my colleague Parikshit on the latest Israel-Hamas ceasefire deal, the growing India-US relationship, and of course the incoming transition and Trump taking office on the 20th. Listen in.
I think the announcement yesterday is welcome. We have too much war in the world today. We are both peaceful countries that want to see conflict. As the Prime Minister said, this is not an era of conflict. It should be an era of peace. And I hope we can see hostages come home, and we can see violence reduced, and that we can finally see armies be able to retreat and communities be able to recover. That is the most important, and for families to be reunited who for so long have not been.
Right. But what do you think? Do you think now this would lead to lasting peace in the region?
Well, lasting peace isn't just achieved one day. It has to be accomplished every single day. And I think one of the places where India and the United States can work on that peace was the announcement during G20 of IMEC, the India-Middle East corridor, a way we could connect literally that old spice route that connected India with the Middle East, or as West Asia as it's called here, and Europe. This could be a way to embed peace across borders where we've seen too much conflict, investment to flow, tourists and visitors to come to these areas, and whether it's communications cables, or whether it's energy infrastructure, or whether it's the trade of goods and services, create jobs that...
Okay, well, more of that interview later during the course of the day, but this is some important information which my colleague Timsy is picking up. Now, government is considering reintroduction of the concessional corporate tax rate. This is source-based information at the bottom of the screen. Timsy is joining in with details. Timsy, a little bit of background to this and what you're picking up.
Well, yes, as you rightly said, what sources are indicating right now is that the government is considering to reintroduce the concessional corporate tax rate. Remember, the concessional corporate tax rate regime was brought in September 2019 for setting up new manufacturing units at 15% plus surcharge. And this scheme actually phased out. There was a sunset to it, and March 2024 was the sunset when it lapsed. India Inc. has been pitching for a reintroduction, and this currently is under active consideration between North Block and PMO as they finalize the budget announcement. But yes, a sort of a change here in the reintroduction. The rate this time that will be offered, if agreed upon, could be a little higher at 18% instead of earlier 15%. So the idea behind this reintroduction that the government is considering is that it feels that bringing back the concessional corporate tax rate scheme will help to promote Make in India, create more employment and enhance manufacturing, which is the need of the hour to kickstart the economy in the given current scenario. The view that we are picking up is that India Inc. pitched really hard this time for a reintroduction of this scheme, and thus the government is currently mulling upon how best they can reintroduce the scheme. As of now, if you want to know what is the exact status of the proposal, well, as I said, the proposal is under active discussions between North Block and PMO, and no decision has been finalized because taxation decisions for the budget are made only 2 or 3 days closer to the budget. So right now, the proposal is under active consultations, and it could be that the government this time might decide to reintroduce this scheme, but yes, at a higher rate. Let's see what happens finally when the budget is finally being logged from the taxation side. Back to you.
All right, Timsy, thank you very much for that. 18% now. Earlier was 15%, but reintroduction is the more important bit with a slightly higher tax rate. We'll get
by
you...
the way,
sorry.
Yeah. Go ahead, finish.
No, I was taking a break, please.
Okay. Infosys has moved to the day's low ahead of its numbers. So that suddenly tanked in the last 10-15 minutes. It's down 1.5%. Remember, Infosys has also been an outperformer. It's up 30% in the last 1 year. And what we've seen so far in the earnings season is stocks which have outperformed, like in HCL Tech, despite reasonably in-line numbers, the stocks are falling, and Infi too is a bit under pressure ahead of its numbers. LTI Mindtree, on the other hand, which has been an underperformer, is inching up 2.5%.
Yeah, you know, the bears are saying that it's been an outperformer. It could come in for a clonk. The bulls are saying not such a bad outcome. TCS went into its numbers weak, and then there was a pleasant surprise. So we'll see which way the wind blows tomorrow.
You know, the stock which at the start of the earnings season, the stock which was expected to do very well is Infi on the back of numbers.
HCL Tech.
TCS came out of nowhere with that 5% pop that day. But generally, it's well advertised that numbers for Infosys should be better, at least amongst the large caps. So we'll see what actually happens. But this is, of course, I mean, pre-results trading, positioning, and all of that going on. So yeah, it's come off. We take a break. We are back. Ambrish is with us. There's 6 minutes to close, and we'll get you that stock which Ambrish has picked out for you as well on the other side in just a bit. Stay with us.
The stock has been a bit of an underperformer. So last year, Reliance Industries share price declined for the first time in 9 years, and it underperformed the Nifty in 2024. Brokerages increasingly over the last couple of days have started turning bullish as valuations are now looking attractive. They expect the oil to chemicals business to show an uptick. Even the telecom business is likely to see telecom, stable. Tariffs retail is showing a pickup. So brokerages are increasingly turning bullish on Reliance Industries. But will the numbers match up or beat? Time will tell.
For the third quarter for Reliance's retail business, because of muted consumer sentiment and the company's own pace of growth, there is some moderation and consolidation likely. What we're looking at is sequentially, growth in revenue would be led by pickup in festive season and the overall third quarter seasonality, which would improve their revenues. But year on year, there would be moderate growth in the business, largely because of the big acquisitions that the company had done. B2B business itself is in the base. So if you look at the last few quarters, quarter 4, quarter 1 and quarter 2, the revenues have been around that 76,000 crore mark itself. In the third quarter, we're expecting it to be pretty flat year on year itself. The key to track, however, would be the margins, and we're also looking at 7% increase in retail revenue per square foot as per Nuvama's estimates. Now, talking about the margins itself, analysts would be pegging in anywhere between 1 to 2% year-on-year growth in the EBITDA and 8 to 9% growth quarter-on-quarter due to the festive season itself. Put all the estimates together and we have the CNBC-TV18 poll, which throws up a Reliance Retail EBITDA for the third quarter at close to around 6,400 odd crore rupees itself. But apart from reported numbers, what we're looking at is some commentary on festive season pickup, growth in their new formats, the likes of Tira, Yusta and Swadesh, and finally their FMCG business as well. Aggressive rollout led by the beverage business Campa are all these factors which would lead the next leg of growth for Reliance Retail.
Welcome back. Last few minutes to go. Infosys going into its numbers at the day's low, but a couple of these OMCs have moved up. BPCL as well has spiked up in the last few minutes, and Reliance Industries is going into its numbers rock solid after the recent underperformance. Very quickly, Amrish, if you could give us, you normally give us one pick. Which one is it this time around?
Right. Today's speaker is Federal Bank. This was originally set up, as a regionally focused bank in Kerala, but now has pan-India presence with about 1,333 branches and over 2,000 ATMs across 26 states and 5 union territories. About 609 branches are situated in Kerala, and they have 2 rep offices in UAE. And if you look at the semi-urban presence, it's about 50%. Retail book is about 56%. Wholesale is the balance 44%. And in retail, the focus is on gold loans, loan against property, auto loans, credit cards, personal loans, and microfinance. And in wholesale, they have clients across MSME to MNCs, but the focus is clearly on the mid-corporates. Look at the numbers. The NIMs are about 3.1, CASA ratio is about 30%, gross NPA at 2.1, and net NPA at 0.6, which is quite decent. And recently, there was a management change. KVS Manian, ex-Kotak, has taken over as MD and CEO. And in Kotak, he was driving retail banking. So here, too, the focus is clearly going to be on retail, where the margins are much better. And if you look at the loan growth, expectation, it's going to be about 18% CAGR over the next 3 years. NII and PAT growth should be about 19%. So my target is about 258 based on 1.5 times adjusted book value for FY27.
Amrish, what about something like an LTTS? It's been a bit of an underperformer. The management is saying that we'll see broad-based growth in Q4, even in FY26. Discretionary demand is a lot better. Given the underperformance ER&D companies have gone through, is it time to bet on them versus IT services?
I think one should, because looking at the management commentary, I think that could be one of the brighter spots in the IT space. And after the underperformance, I think it's a good time to buy. Although it's moved up today, but then on a small correction, I think one should get in.
Okay, Amrish, stay with us. Just want to wrap up things here. We've ended the day with a 100-odd point gain of the Nifty. 23,350 is where we are at. The Bank Nifty 1.3% higher, 49,386. The Sensex up 0.5%. Generally a good session. 2,000 stocks, 2,100 stocks nearly up and about 700 lower. So some 3:1 is the advances to decline ratio. Small cap index doing the best, and the broader markets mid cap index also pretty good and up and about. So that kind of a day and looking good. Actually, lots of movers really coming through. Life insurance actually was a dark horse. HDFC Life and SBI Life, which reports tomorrow, by the way, ICICI Pru, Max Life, they all started higher. Maybe came off a little bit, names like SBI Life from the day's high, but decent gains on that particular pack. Nima.
Well, Reliance Industries goes into its earnings with strength, 2% up on that, and Axis Bank ending with a gain of 1.5%. On the flip side, Infi ending at the day's low, down 1.5%. So all eyes will be on Reliance, Axis, Infosys, post-market hours. Other notable losers include large cap IT names like HCL Tech, TCS, some of the consumption names like HUL, ITC down over 1%, and Trent was the biggest loser on the back of the Kotak downgrade. Mid-caps outperformed, the mid-cap index ending with a gain of over 1% with a strong advance decline ratio. We're going to wrap up on the show. Thank you very much for watching, but don't go anywhere because on the other side is Markets Forward. A range-bound session ends in the green. Advances far outstrip declines as heavyweights inch up and mid-caps rally. Realty, metals, utilities gain, while FMCG and IT drags.
Stocks of insurance companies fly. This after HDFC Life surprises the market with a better-than-expected results and also maintains its growth guidance. It has positive rub-off on other life insurance stocks as well.
L&T Technology Services jumps in trade after reporting an inline set of numbers and guiding for a 10% growth this year. Oracle Financial Services slips on the back of a weak quarter. Seat, Aeroflex were the other stocks buzzing in trade on the back of Q3 numbers. Hello and welcome to a fresh edition of Markets Forward, your go-to show where we aim to get you all the key data points to prep you up for tomorrow's trade. And we'll also recap what happened today. I'm Reema Tendulkar and with me is Nigel. Hi, Nigel.
Well, Reema, hi. Today was a pretty decent okay because the global cues are fairly positive and it has the ingredients to see a positive session. And positive it was. The Nifty went home with gains of close to around 100 points. Remember, today was the weekly expiry as well. That adds that element of volatility. But actually, it was pretty much a flattish day altogether. We started off with a gain of around 100 points. We go home with gains of close to around 100 points or thereabouts. The sector of the day was the insurance companies. Remember, it's become a trend right now. When you don't expect much, and in fact, the company comes out with a pretty decent set of numbers, then you see a big fillip. And today, HDFC Life, that was a stock that in fact had a positive rub-off on all those life insurance stocks. So that was the sector of the day. Otherwise, results reactions, we had plenty out there as well. A lot of stocks were in focus. But the Nifty Bank, well, that was the one that did continue its pullback. And in today's trading session, it made yet another higher high that made the bulls feel quite good. But the real positive and the reason that your portfolios will be feeling good is because the breadth of the market was in favor of the number of stocks that were advancing. Close to around 4 stocks advancing for just 1 stock that was declining. Some bit of a pullback is what we have seen, but the bulls will want more.
Well, just a quick wrap of the movers. Well, life insurance companies right on top of the winners list today. So HDFC Life, SBI Life. Banks had a good session. So the banking index itself, the Nifty Bank up over 1%. Reliance Industries ahead of its numbers was a big contributor. The Reliance Industries share ending pretty much at the day's high with a gain of nearly about 2% on the way down. Large cap IT names, Infosys, TCS, HCL Tech struggle, and so did some of the consumption names like HUL and ITC. But let's tell you what we have for you on our show today. The top movers and shakers, always with Hormis. Insurance stock stole the spotlight after HDFC Life Insurance reported better than expected numbers. Several companies like LTTS, Oracle Financial Services, Seat, Aeroflex reported Q3 numbers. We'll bring you a quick snapshot of that. And finally, we'll tell you the key events to watch tomorrow. But as promised, it's over now to Hormis. He joins in. He's at the big wall with the top stock movers of the day.
A good day for the index, better day for the broader markets, and within the broader markets, it was a day that belonged to the railway companies. It's been an age since we spoke of the fact that railway PSUs were outperformers in today's session, and so they were, be it the likes of Ircon, Jupiter Wagons, RVNL. Jupiter Wagons, of course, not a PSU, but look at the others. RVNL, Railtel gaining anywhere between 9% to 15%. Even IRFC was up 4% for the third straight day. A lot of earnings reactions. You spoke of HDFC Life. One earnings reaction took the entire space. Along with it, LTTS 2 ending almost, well, off the highs of the day, but still holding with gains of around 8.5%. Oracle Financial was the flip. On the flip side, though, after that run-up that it saw last year, saw some profit booking after its results. Sterling and Wilson 2 at one point was up 10%, but ended 6.5% higher after its results. So the newsmakers in today's trading session, Dr. Reddy's after a drug approval, it wasn't such a big important drug, though. The stock ending among the top losers today. Samman Capital came out with a business update ending 8% higher. Kalyan Jewelers in the F&O band today, but the topsy-turvy continues, ending 3% lower, and Bharat Dynamics after the order win ending higher today. A lot of volume-led movers in today's session. GMDC was one of them. Sri Renuka, of course, with the entire sugar space buzzing, and Uno Minda as well, 4% higher on strong volumes. And lastly, some stocks that were high flyers in the recent times but saw profit booking recently in today's session. Motilal Oswal ending at the lows of the day, 7.5% lower. Devyani International was up 6% yesterday, gave up almost 4% of that. And Amber Enterprises too, been in the news all through the last month and a half, so also ending at the lowest point of the day today. Back to you guys.
Okay, all right, Hormuz. Thanks a lot for joining us and giving us that neat wrap of all the stocks that were moving around. Well, let's welcome our guest on the show. We have Jay Thakur, who joins us from ICICI Securities. He'll help us out with the technicals. And Amrish Palika, market expert, will help us out with the fundamentals. Hi, gentlemen. Thanks a lot for joining in. Jay, what do you make of today's trading session? Bulls will argue that it was a good session. We ended with a 100-point gain. The bears will say, hey, you couldn't build onto those gains, and that 23,350 continues to get defended. Which camp are you in?
Well, absolutely. Very good afternoon to you, Nigel and Rima. Well, after Monday's sell-off, Nigel, I would say that markets have, managed to hold on to the levels of 23,000. Interestingly, I mean, there was no technical support, honestly, I mean, below the levels of 23,263, I mean, as the lows were broken, but then market had gone too oversold, and there was a good support from the fall in DXY. I mean, there is a good appreciation, I would say, in the INR, and we've seen the global markets also bouncing back quite sharply post the CPI data back in US, and we've seen markets now bouncing back from 23,000 levels, and it's back to 23,300. In fact, today could have been a better day as relatively, had it not been an expiry day wherein we saw that there was a huge build up at 23,300 call and put straddle. I would say more than 8.5 crore open interest is very rare to see that, and because of which we saw Nifty closing around the levels of 23,300. Otherwise, it would have been at 23,400, 450 levels, Nigel. And we have important, I would say, results as well. I mean, Reliance, Infosys, Axis Bank, and many others. So I would say that since markets have bounced back quite sharply, the PSU banking pack is showing good momentum on the upside. We are seeing good short covering in many of the beaten down names, and markets are very oversold. So there is a good chance that market further bounce back until the levels of 23,500 to 550 on the upside, Nigel, where it had actually broken down in the recent fall. So those levels can be tested at least until 23,000 levels are held.
Okay, thank you very much for that. That's the technical call on the index. Let's get to the insurance companies. They were flying. This is after HDFC Life surprised the market with better than expected results and also maintaining its growth guidance. Yash is here with a snapshot.
Well, certainly a strong quarter for HDFC Life Insurance as far as the third quarter is concerned, and what that is doing is, making investors believe that other listed life insurance companies as well could have a strong Q3 as far as financial performance is concerned. To be specific about the numbers for HDFC Life Insurance, except for new business premium, which saw a slight miss in terms of street estimates, all other parameters, total APE, retail APE, value of new business as well as margins were much ahead of street estimates in terms of specific numbers. For new business premium, despite that slight miss, it grew at about 11% to come in at about 7,900 crore rupees. Total APE grew at 12% at about 3,569 crore rupees. Retail APE again saw a growth of about 12%. Value of new business grew at about 9%. The number there was about 930 crore rupees. In terms of margins, the street was estimating a higher compression to come in as far as margins are concerned, but the company could restrict it to a much lower number. The margin saw a compression of about 74 basis points to come in at about 20.06% versus 26.8% on a year-on-year basis. The management has maintained its guidance for the year in terms of 18 to 20% of APE growth and more than 15% of VNB growth. What also helped the stock price today is valuations. The stock had corrected significantly in the last 3 months as well as in the last 1 month. HDFC Life was down about 19% in the last 3 months and about 8% in the last 1 month. Also, what is helping the stock price today? In terms of brokerage notes, HSBC and Jefferies both have a buy call on the stock with a target price of 750 rupees per share. CLSA has an outperform call on HDFC Life. They've trimmed their target price to about 690 rupees per share.
Thank you, Yash, for that. Amrish, would you buy HDFC Life at these levels?
Absolutely. In fact, we were bullish on HDFC Life for a long time, although it's been underperforming. But these results clearly show that going ahead, things should be much better for HDFC Life. Because you look at the VNB margins, I mean, that's improved 174 basis points Q on Q. Increase in sale of high margin products has happened. And again, these earnings are based on changes in commission in line with the IRDI regulation. So that's extremely positive. And if you look at the average ticket size of the policies, I mean, that's increased by about 8%. And again, the company has also announced that there's no intimation from the regulator with respect to limiting the bank insurance channel as far as the premium sales are concerned. So, in fact, I mean, I have a price target of about 795 for HDFC Life, valuing it about 2.1x FY27 embedded value. And the other two triggers which can happen over the next few months possibly could be the GST adjustment reduction and a possible FDI increase to 100%. I think these are the two triggers waiting to happen.
Okay, all right. Gentlemen, hold on to that thought. Rima, I want to focus on a couple of IT names. One was the big outperformer in the last 1 year, which is Oracle. That came out with a set of numbers and the stock sold off. While LTTS, there's been an underperformer, virtually unmoved in the last 1 year. And that one came out with a decent set of numbers. The street liked it. Both different ends. Tell us about both.
Well, a lot to do with positioning also. So even LTTS, it's not that it was a blowout quarter. The numbers were largely in line with expectation at the operating level. There was no upgrade in EPS. In fact, there were some downgrades too. But it's just that the stock was an underperformer going into the numbers, and the street said, well, the numbers are fine and the outlook is better, and therefore they went and bought LTTS. So few quick reasons. First, on the guidance for the current year. The current guidance is 8 to 10%. Now, the company is saying organic guidance is 8%. So, yes, lower than the 8 to 10% that the company was talking about earlier. But including the acquisition, they will make it to 10%. But the way to look at it is that given the H1 performance, it was very difficult for the company to achieve 9 to 10%, the upper end. So, in a way, the street was expecting that the company at best will do the lower end of the guidance, which is what they did. The correction perhaps is in the, it's been an underperformer, as we said. The stock is still down 13% from its recent highs. Motilal says the valuations are now attractive. The stock is trading at 27, 28 times forward multiple, and the outlook going ahead is a lot more bullish. The company reported the highest ever large deal wins. It has a lesser exposure to the automotive vertical, which is slowing down. Lesser exposure compared to a KPIT Tech and a Tata Elxsi, and therefore it's relatively more immune. And the management commentary said, was that all the three verticals will grow in Q4 and going ahead. So high-tech, sustainability and automotive. And they also went on to say that the discretionary demand is a lot better than it was 3 months ago. Their pipeline has improved. Now, Oracle Financial Services has had a bit of a slow quarter. Revenue growth was just up 2.5%, down 6% on a year-on-year basis. But if you remember, it was exactly Q3 of last year when the company reported blowout numbers. Revenues went up 25%. And that's what had gotten the street excited. And since then, the stock had a one-way rally. Margins too have contracted in the current quarter, and the stock is up more than 100% in the last 1 year. So basically for Oracle Financial Services, there was a stock price rally, and plus the base was very high because Q3 of last year was a very strong quarter for Oracle. And compared to that, the numbers have shown a bit of a slowdown. Jay, come in. At least in the large cap IT names, we've seen some big moves. HCL Tech on the way down, TCS on the way up. In mid cap IT today, LTTS. Any chart which is attractive for a trade for tomorrow?
Well, see, definitely, as far as IT is concerned, Rima, I would say that is going to be Infosys. We really need to see where it's going to take the Nifty IT from here on, because it has just gone sideways after having, outperformed the index quite a lot. And now, after results having come out, I would say that TCS is looking good, but is still stuck in a range as that of LTTS. Most interestingly, Rima, I would say that why LTTS would be a better bet from here on post its results is that we have not seen much of the open interest or the derivatives position right now on LTTS. Rather, we had seen a good amount of long unwinding in this stock, and the stock has somehow managed to trade within a range. Technically, it has formed a nice ascending triangular pattern. It's been trading within a band of say 4,500 to 5,800 now, and having reversed from the lower end of the range, I'm expecting this stock to slowly, gradually inch towards the upper end of the range. And looking at the derivatives position, there aren't much position. So if at all we see a good long build-up from here on, there is a very high probability that this time around, the stock might provide a breakout on the upside after a long time. So based on the results right now, as well as the technicals and derivative positions, I would say that LTTS, that is L&T Tech, looks well positioned, and we really need to see whether Infosys finally provides a breakout beyond 22,000 or not, else it would be trading with a negative bias.
Okay, all right. Got that, Jay. Well, let's talk about a few more results. CEAT it didn't react very positively to its numbers. In fact, at the lows of the day, the stock was down more than 5%. It ended off lows though, while Aeroflex, rocket on that one, was at upper circuit. Vamakshi joins us to dissect both these two numbers. Vamakshi, take it away.
Well, Nigel, Aeroflex reported a good set of numbers. Revenue for the company saw an uptick of nearly 36% year-on-year, coming in at almost 100 crores. The gross profit margin improved by nearly 220 basis points, coming in at 39.9%. And resultantly, we saw an uptick in the EBITDA margin as well, because that saw an improvement of almost 285 basis points, coming in at 21.7%. The net profit saw a very sharp surge of almost 70%. The net profit came in at 15.2 crores. Now, we were also joined by the management, and the management actually highlighted that by the next financial year, they're expecting the European market to growth to catch up with that seen in India as well as the US. FY26 growth is expected to be much better. In fact, they also highlighted that the organic expansion that they announced will be funded entirely from internal accruals over the next 1 to 2 years, and a fundraise is what they're looking at by Q1 of FY26 or earlier. They're still finalizing some details, but a significant portion of this QIP will be used to fund inorganic acquisition opportunities is what they've highlighted. They also say that they're expecting a top line of almost 1,000 crores in the next 3 to 4 years through organic as well as inorganic opportunities. So good set of numbers, good commentary coming in from the management. The stock surged and trade on the back of that. CEAT, on the other hand, when we look at the numbers, revenue was up nearly 12%, but the raw material cost to sales rose almost 445 basis points on a year-on-year basis, which impacted the margins. They saw a downtick of almost 370 basis points year-on-year. The profit, on the other hand, was also down nearly 46%. So optically, while these numbers look bad, the numbers were largely more or less in line with the street's expectations, and the company also said that demand was stable. They're witnessing healthy year-on-year volume growth in replacement and international business segments, and the OEM part of it was on the recovery trajectory. The order pipeline was robust, and they're expecting the growth momentum to continue. So therefore, while the stock tanked initially, there was some bit of recovery seen in CEAT.
Indeed, pretty decent recovery and the stock ending flat. But let's quickly get to a CNBC-TV18 exclusive. The government is mulling over reintroduction of concessional corporate tax rate. This scheme is likely to be for new manufacturing units and would be at 18%. Sources tell us that this is to promote Make in India and create jobs in India. Remember, concessional corporate tax rates were notified in September of 2019 and was given for new units at 15%. Well, after this important update, let's get back to our guests for more. Amrish, in the automotive pack, CEAT, what have you made of the numbers, what we heard, and what does it tell you about the other tyre companies?
See, I mean, the numbers weren't really great. In fact, it was a bit disappointing. And I think even going ahead, the next 1 or 2 quarters is going to be like this, because the raw material prices clearly have moved up, and they would find it difficult to pass on, at least immediately. So the next 2 quarters also would be weak. So at these levels, I'll not be a buyer. I'll wait for a correction further.
Okay, all right. Amrish, also wanted to ask you about Paytm. You know, the stock out of nowhere has seen a big jump up in the last couple of days. At around 900 rupees, what do you say?
I think at 900, it is a decent buy, because in fact we are looking at levels of about 1200, 1220, because at least in the last 1 year, I think most of the issues which they have, I think, has been sorted out to a very large extent, and they're clearly on a growth trajectory. So any sort of a correction in Paytm, like what we saw in the last few days, clearly, has been a buying opportunity, but even at the current levels can be bought for a target of 1200 plus.
Okay, all right. Well, let's focus on a couple of numbers then. Abhishek joins us to help us out with a couple of banking numbers. Abhishek?
Well, to begin with Axis Bank, the business momentum is the weakest that you are seeing in last 15 quarters. Deposit growth is the lowest in last 15 quarters, coming in at 9% YOY, and advances growth is much weaker than deposit growth at about 8.8% YOY. The other income is down about 11% on a sequential basis. Operating efficiency is one of the best in last 7 quarters, with cost to income ratio being at 46.2 versus 47% sequentially. Now, this is because the overall OPEX is down about 4.7%. 0.7% quarter-on-quarter and grown by just 1% YOY. Operating profits are down by 1.7% sequentially. It's the lower provisions which has aided the PAT this time around. Gross NPA is up only 2.5% in absolute value on sequential basis. Net NPA is up 4.5% quarter-on-quarter. So gross NPA ratio has inched up by just 2 basis points sequentially and net NPA by just 1 basis point sequentially. The NII is weaker than our poll. The PAT is ahead of our poll due to lower OPEX. Back to you.
Thank you very much for that. With that, it's time for a short break. We'll thank our experts as well for joining in. On the other side, top corporate voices along with the key market events to watch for. Stay tuned.
Welcome back. You're tuned into Markets Forward. As promised, let's take you through all the top corporate voices that we got during the course of the day. L&T Tech Services Management says their pipeline is showing improvement both sequentially as well as on an annual basis, with demand environment also better than it was the same time last year. The company expects Q4 margins to remain similar to Q3, and it's confident that all three segments will experience growth in Q4 and FY26. Additionally, the company is maintaining its medium-term aspiration of reaching $2 billion in revenues and margins of around 17 to 18%.
Now, 5 PSU banks, including UCO Bank, were in focus after the government approved a 2,000 crore QIP for each of them. Now, UCO Bank told us and confirmed the fundraise plans and said this move will result in a reduction of 3% of the government stake. Additionally, the bank is targeting a credit deposit ratio of 75% in line with its guidance.
An auto components maker, Minda Corporation, has acquired 49% stake in Flash Electronics with a strategic aim of building a significant electric vehicle platform. The company anticipates a profit of around 50 to around 55 crores from this acquisition and is targeting around 5,500 crores in revenues. Additionally, the contribution of EVs to Flash Electronics revenue is projected to jump up to around 25% by FY26.
And before we wrap, let's get you the big events, the market events to watch tomorrow. Abhishek is back with us.
Well, Rima, to begin with, China will come out with the GDP growth rate number tomorrow. It's estimated to be at 5% versus 4.6% that it had grown last time around. Watch out for India. The RBI data will come out. Bank deposit growth had fallen to multi-quarter low last time when it had come out at 9.9%. Even the bank loan growth data was on the lower side last time around. It was at 11.2% YOY. That data will be keenly watched. Now, Forex reserve has been falling. So last time it was at $635 billion. How much that will come out will be seen closely. Ex-dividend SCL Tech, interim dividend of 12 rupees and special dividend of 6 rupees. So it will trade ex of dividends. TCS also special dividend of rupees 66 and interim dividend of rupees 10. Now, one stock that will go ex bonus is Kitex Garments. It will go in the ratio of 2:1. We have earnings season. So results that will come out tomorrow include Geo Financial, ICICI Lombard, SBI Life, Tech Mahindra as well as Wipro. On the weekend, we have results coming in from Kotak Mahindra Bank, RBL Bank and Canfin Homes. Back to you.
Thanks a lot for that, Abhishek. Well, on that note, we'll wrap up on this edition of Markets Forward. More news and updates on the other side.
So you've been playing international level badminton for almost 15 or more than 15 years now. Do you feel it also defines who you are as a player now? How you've matured as a player, your journey, your experience?
Yeah, definitely, yes. The person you are, the confidence levels that you show on court are very important. And I think as a person, when you're right there, you know, when you stand and people, when they look up to you, they also need to understand that, yes, you know, she has done a lot for the country. And that itself shows that how confident you are when it comes.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Lal Street ends in the green for the third straight session. The Nifty holds 23,300. Broader markets outperformed. The blue chips, the Nifty Bank and the mid-cap index soar over 1% each. The rupee weakens against the dollar even as RBI announces daily liquidity infusion through bond auctions after a 5-year gap. This move, along with the slowing inflation in the US, bolsters hopes for a rate cut in February. The Reserve Bank of India says Tata Sons' application to deregister itself as a non-banking finance company is still under examination, indicates the company still has a chance to avoid complying with the RBI's mandate for large NBFCs to list by September of 2025. Axis Bank reports a weak Q3 business momentum at a 15-quarter low. Asset quality worsens. Net interest income is below street estimates. A little over 2 weeks left for the union budget. Sources tell CNBC-TV18 the government is considering the reintroduction of the concessional corporate tax scheme for new manufacturing units. It may set the concessional rate at 18% instead of 15%, which was the rate in the previous edition of the scheme. Israel's cabinet delays voting on a Gaza ceasefire deal. Even as celebrations erupt across the region and the world, Netanyahu accuses Hamas of trying to obtain last-minute concessions. Gaza authorities say at least 40 people have been killed in Israeli strikes since the ceasefire announcement.
Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy.
Outgoing U.S. President Joe Biden strikes an ominous tone in his farewell address, warns that an oligarchy is taking shape in America, raises the red flag on a tech industrial complex that could pose dangers.
I don't think there's anything that could stand in the way of U.S.-India progress. A relationship is defined not by whether you love each other. It's clear U.S. and India love each other.
Outgoing U.S. Ambassador to India, Eric Garcetti, says nothing can stop the progress in bilateral ties, wants more American companies to move out to China and invest in India, welcomes the government panel report recommending legal action in the alleged plot to kill Sikh separatist Panun in New York. Hindenburg, the U.S. short seller behind the $140 billion rout in Adani Group stocks, is shutting shop. Founder Nate Anderson says, "We shook some empires that needed shaking. Nearly 100 individuals, including billionaires and oligarchs, were charged based on Hindenburg's reports." Actor Saif Ali Khan undergoes surgery after reportedly being stabbed by an intruder at his Mumbai residence earlier today. Doctors say he's out of danger. Saif Khan's team attributes the incident to an attempted burglary. The police say the accused has been identified and teams have been formed to nab him. Well, let's go straight to the Infosys numbers. Its third quarter results are out. Rima standing by now to decode the fine print for us. How did Infosys do, Rima?
Well, Infosys reported a revenue beat while margins have come in line with street expectations. The company has reported a revenue growth of 1.7% ahead of the CNBC-TV18 poll of 1%. This is also ahead of what TCS had reported, which was absolutely a flat growth. So Infy beats, Infy beats on the top line. Margins on expected lines have expanded marginally to 21.3% versus 21.1%. So it's a 20 basis point margin expansion on expected line. So Q3 revenue beat, margins in line. Now on to the most important thing. The company has upped the revenue guidance. The earlier guidance for FY25 was 3.75 to 4.5%. The new guidance is 4.5 to 5%, which means the lower end of the guidance is raised from 3.75 to 4.5%, while the upper end is raised from 4.5 to 5%. The fact that the upper end is raised will give the street a lot more confidence. That said, many on the street believe that the upper end of the guidance would be raised, and the consensus expectation was that the company would revise the full year revenue guidance to 4.5 to 5%. So it's not that it comes as a positive surprise, but the fact they did it reaffirms that perhaps things are improving. Now, a few other data points. The deal wins for the company continue to remain steady. No acceleration, but steady. $2.5 billion is what the company has clocked in by way of large deal wins. hiring is picked up for the second consecutive quarter. Remember, hiring is seen as a lead indicator of demand improvement. Over the last 18 months, when demand for IT companies slowed, we knew that the employees were cutting back on their overall base. Attrition had cooled off and the companies were not backfilling the people who were leaving. So the overall headcount was steadily declining. No one was hiring. But now it appears that hiring is back. So for Infosys, it's the second consecutive quarter of a pickup in hiring. And attrition too has, inched up marginally for the company. And it's coming at 13.7%, higher for the third consecutive quarter. So a pickup in attrition is also seen in some way as an indicator of demand because people are moving on to different pastures. There is demand and therefore they may get poached. So all in all, it appears to be a good quarter. The Q3 revenue beat will come in as a positive surprise and it will provide a lot of confidence to the street. And even the other indicators like the deal wins, hiring, attrition, all bode well. The stock, remember, going into the earnings fell. Especially, pull up that, the intraday chart, especially in the last 1 hour or 30 minutes, we saw the stock fall. It collapsed from 3 to 330 and it ended with a cut of more than about 1%. Will we see a reversal of that? Shaji Nair, research analyst at Mirae Asset Sher Khan, is now with us on the show. Thank you very much for joining in. First, if you could just share your initial thoughts on Infosys and what is it that we should watch out for in the press conference?
Thanks, Rima. Basically, the revenue growth that has come in at 1.7% on a constant currency basis is really good because I think we as well as the street are anticipating close to 0.7 to 1% growth. So for a seasonally weak quarter, this seems to be a good number. Also, with respect to the margins, there was nothing as such as a headwind or a tailwind. And, the street, as well as we were anticipating flat margins, and we are seeing that there is a slight improvement actually with respect to 20 basis points from our numbers. So both on those both fronts, it's good. On the deal win part, 2.5 billion is a little softer because we, as well as this most thing on the street, are anticipating closer to $3 billion on the large deal TCV. So all in all, good set of numbers. Hiring for the second consecutive quarter after many quarters of headcount declines. That's again a positive. Raising of guidance is again a positive. So many positives to the numbers that have come in. And the main thing or the key monitorable, as we have seen with TCS, HCL Tech and LTS, is a commentary. The upbeat commentary will surely bring out good participation in the stock in terms of investment going forward. The main is improvement in discretionary spend. The commentary on the improvement in discretionary spend, whether it's going to spread from to other verticals other than the financial services vertical. The company had reported that the financial services sector is seeing improvement in discretionary spend, and this would be spending across other verticals would be one of the key monitorables that we feel the street will be watching out for.
Quick word, do we expect EPS upgrades tomorrow, Shaji, and a positive reaction?
There could be EPS upgrades, possibly because they have raised the guidance. Like I said, importantly would be the commentary on how they see FY26 versus FY25 or calendar year 2025. How do they see that would determine whether EPS upgrades would be, or there would be no change on the EPS part.
Indeed, but so far, at least the commentary from the IT companies does point to the discretionary demand being better than it was, say, 3 months ago. The pipeline for most companies is higher on a quarter-on-quarter basis. In TCS, which is otherwise very shy of coming out and making either a qualitative or a quantitative statement, did say that FY26 should be better than FY25. So far at least, the noises that we've heard, the sound bites from IT companies has been positive. Prakash Diwan is also joining in. Prakash, share your initial thoughts on Infosys' numbers.
I think the numbers are quite positive, especially, as anticipated, there has been the upping of the higher end of the guidance, which also is something which can propel a little bit of a virtuous cycle for the next full year, which can translate into EPS upgrades as we go along. And then, as you rightly said, you combine this with the environment, the commentary on the environment from the likes of TCS, even, players like L&T Mindtree, which have, L&T also, which have been struggling for a while. They've also started kind of showing some sort of a turnaround. So I think it's moving beyond the BFSI vertical. The confidence comes from the fact that that's the vertical which is the lion's share of the revenue, which has started chugging along, and the others will also catch up. So, for instance, the retail, and we'll often wait to hear from the management in terms of how high tech does, how retail does. But if those things look up, these numbers definitely pave the way for a very strong re-rating of sorts for all these big companies, including Infosys.
But Infosys has been re-rated relative to, say, a TCS. So in the last 1 year, Infosys is up 18%, while TCS is up 9%, despite TCS moving up after coming out with their numbers. So Infosys has rallied, it has gotten re-rated, it's outperformed its peers, and even valuations historically at a discount to TCS is now at par with TCS. So from here on, which one would you bet? TCS, which is also guiding for a pickup and things to improve from here on, or would it be Infosys?
I would still go with the chances of NC continuing with this. They have had a head start in terms of improving some of their basic metrics, and that improvement will give them much more, stronger traction, especially when the post the Trump administration coming in, there could be a slew of contracts getting awarded. So the TCV could probably dramatically improve for Infosys. They're right there to leverage on that growth. Infosys is right there to leverage growth. TCS will probably take some time to digest the improvements that they've seen in the last quarter and consolidate. But I would definitely believe NC is the one that will continue holding. And this thing about NC having done well, it's not entirely a re-rating of Infosys on an absolute terms, but it's probably a de-rating of TCS that happened, which increased the delta. But going forward, I think Infosys will continue to march ahead at a faster clip in terms of earnings growth as well.
Just two things to point. One, the guidance this time has been boosted also by the InTech acquisition. We presume the upgrade also takes into account the InTech acquisition that the company did, which analysts expected to add about 20 basis points. Now, from the management, we will find out if the upgrade in guidance is X of the acquisition, organic as we call it, or does it take into account the acquisition? So that's point number one. And secondly, remember in Q4, in all probability, the wage hikes kick in. Last year, the wage hikes were in Q3. The company's wage hikes were effective 1st of November. This time they didn't give it in Q3, and now reports are suggesting that the wage hikes come in January, February, March, depending on the level, which means in Q4, there will be a wage hike impact on the company's margins, and the company in a way has deferred its annual wage hike cycle. It's not come in after a period of 12 months, but a little longer, maybe 14, 15 months. So Q4 margins perhaps will have the impact of wage hikes. So Shaji, when you speak to your investors about IT, what is it that they tell you? What is the feedback so far that you've got from the Q3 numbers?
So with respect to the Q3 numbers, the investors are a bit skeptical because currently there are a lot of events that are taking place. Firstly, with respect to the rate, the data that is coming out from the US, which is bringing about volatility. Today we had, yesterday night we had inflation data on inflation, which is seems to be easing, and it's giving out good prospects that there would be rate cuts going ahead. So, but investors on the street are a bit skeptical with Trump slated to take assume office on 20th, and the restrictive policies with which he could be coming could have a bearing on the markets as well as on the IT stocks as well. So right now, investors are a bit skeptical on entering the stock.
Thank you very much for sharing that viewpoint. For more clarity, we will have the management speaking to the media at 4:30 p.m. So all eyes will be on the top management of Infosys. But a quick wrap out, Q3 numbers are strong for Infosys. The company beats street expectations with a revenue growth of 1.7%, raises the full year revenue forecast for FY25 to 4.5% to 5%. Q3 margins in line, and the company holds on to its FY25 margin guidance of 20 to 22%. Hiring is picked up, deal wins is steady, attrition too seems to be on the rise, but within the comfort band. Thank you, Shaji and Prakash, for joining in. With that, Shireen, it's back to you.
Rima, many thanks for joining us. That was Infosys for you. But let's move on to all the trading action of the day. The Wall Street ended in the green for the third straight session. The Nifty and the Sensex gained nearly 0.5% each. The Nifty, in fact, managing to hold on to 23,300. The broader market outperforming the mid-cap index up by about 584 points, 527 points higher on the Nifty Bank, and a 300-point gain coming in there for the Sensex. So a positive close for our markets. In the money market, the rupee weakened against the dollar again. The move comes despite the RBI announcing daily liquidity infusion through bond auctions after a 5-year gap. Now, this move, along with the slowing inflation in the US, bolsters hope for a rate cut by the Reserve Bank in February. Big corporate story, Tata Sons continues to remain classified as an upper layer NBFC as per the RBI, which essentially means it is regarded as a large NBFC. As per its latest list, the company is among 14 other NBFCs who've been classified as an upper layer NBFC. As per an RBI directive dating back to October 2021, large non-bank finance companies are to list their shares on a stock exchange within 3 years, and that period is 2025. The Reserve Bank of India said the Tata Sons application to deregister itself as a non-banking finance company is still under examination. Ritu joins us now to put things in perspective. Ritu, many thanks for joining us. So, under examination, the application by Tata Sons to deregister and thereby avert a listing. So, safe to say that we cannot conclude that a listing is certain for Tata Sons in 2025. The window seems fairly open at this point in time to get an approval or an exemption from the Reserve Bank.
That's exactly the takeaway, Shireen, that, an IPO or no IPO for Tata Sons, there's no final word on that just yet, because as per Reserve Bank of India's periodical updates on the list of NBFCs that are categorized as large upper layer NBFCs, Tata Sons continues to feature on the list, and according to RBI's scale-based regulations, which were released in 2021, after which it followed up with a list of upper layer NBFCs sometime in September 2022, mandating all of these companies to go public within 3 years, that is by the later half of this year. That stands. But importantly, in the footnote to the list that has just been updated for the year 2024, the Reserve Bank of India does say that Tata Sons' application for deregistration as an upper layer NBFC is under examination. This is not the first time that Reserve Bank of India has said so. Remember, earlier in an RTI reply also it had said that it had received Tata Sons' application to deregister, and that was under examination. It continues to be examination even as of now. Keep in mind, we've been reporting earlier as well that Tata Sons repaid more than 20,300 crores of debt, to comply with the regulation to avoid, going public by September 2025, which it will have to do if RBI rejects its application. But for now, there is a bit of a reprieve where RBI is yet to take a call on the matter. Sometime last year, the Tata Sons had submitted its application to deregister as a core investment company, CIC NBFC. But for those of you who are quite disappointed that there is the possibility of no IPO from Tata Sons, keep in mind there's another Tata Group company that still features on the list of these upper layer NBFCs, and that is Tata Capital, which will still be required to go public sometime later this year to comply with RBI regulations.
Yes, Ritu, thanks very much for pointing that out. So Tata Sons' application to deregister, thereby averting an IPO, that matter still under examination. But as Ritu was pointing out, Tata Capital will need to comply with the RBI's rules. Time now for us to take a short break. But up next, Israel's cabinet delays voting on a Gaza ceasefire deal, even as celebrations erupt across the region. Netanyahu accuses Hamas of trying to obtain last-minute concessions. That and more when we return.
The way you show up, the way you prepare, and the way you stand yourself in terms of, let's say, when it comes to style, when it comes to your personality, when it comes to your confidence levels. It is very important.
Right.
Yeah.
You know, when you're speaking about your career, one thing when I was hearing you speak, how would you define a winning mindset, both on court and in life?
I think it's very important to believe yourself. I think that itself defines who you are, what you are, and what you stand for, whether if it's on or off court. I know people might say that, you know, you've been very successful, what else you need in life? But I think to get till there itself was a tough task, but I have been very fortunate to have people around me have been very, very positive and very supportive. So I think for me, success definitely means everything, but I think initially nobody is born with a golden spoon. Everybody need to, you know, work hard and be smart enough to work hard. It's not just few months of hard work, but it takes years and years of hard work to come to a level. But I think coming to a level is one thing, but you know, maintaining that level is a different thing altogether, and it takes even more you know, time and hard work, and you know, it takes a lot of your time to maintain that. So I think for me, success, I think badminton has been my passion. So I would do anything to be successful or to be at the top class level.
Right.
Yeah.
So just the way you handle a victory, how do you come over defeat and failure?
Definitely, I mean, every athlete or every person goes through it. I mean, wins and losses, and I think ups and downs are part and parcel of life. It's important to let go. I know it does take time, and it is easy to say, but I think it's not just end of the world. You know, when you lose a match, you get to learn a lot more, and you need to come back stronger. That's what I've believed in, because I've had toughest matches where I was nearly there and then I just missed it out. But I think I've learned a lot from that, and for me it was very important to believe in myself and have that hope that I can do it again.
Right. So what's the Sindhu way of coming out of the defeat?
Israel's cabinet has delayed the vote to ratify the ceasefire and hostage release deal with Hamas. Prime Minister Benjamin Netanyahu's office accused Hamas of attempting to obtain last-minute concessions on some aspects of the deal. Hamas said it was committed to the ceasefire agreement, which was announced by mediators. Celebrations erupted in Khan Yunis and other parts of Gaza after mediators Qatar and the US said that Israel and Hamas agreed to a ceasefire and hostage release deal following 15 months of a war. Israel has reportedly killed at least 80 in Gaza after the announcement of the deal. Dan Murphy has more on the ceasefire, which is yet to be ratified by the Israeli cabinet.
Prime Minister's office in Israel essentially saying here and claiming that Hamas has backed out of some of the agreements that were put in place and creating what it is now calling a last-minute crisis to finalize this hostage release deal. That statement from the Prime Minister's office released in both English and in Hebrew in the last few hours, saying Hamas is reneging on the understandings and creating a last-minute crisis that is preventing an agreement. It goes on to say the Israeli cabinet will not convene until the mediators notify Israel that Hamas has accepted all elements of the agreement. Now, this shouldn't necessarily come as a surprise. Of course, we have seen previous ceasefire deals really coming down to the wire and failing to be agreed as a result of Israeli and both Hamas walkbacks. How concrete this is, whether or not it can be overcome, of course, all remain to be seen at this point. But what we do know is that there was an agreement that was reached. That agreement is going to take shape over 3 phases, the first of which is originally scheduled to start on Sunday. Phase 1 is going to last about 6 weeks. It's going to see the release of dozens of hostages being held in Gaza, as well as Palestinians in Israeli jails. And it's understood that Hamas has agreed to release 33 hostages in exchange for 100 Palestinian prisoners, at least to begin with. Under this deal, we're also going to see Israeli forces withdraw to the Gaza border, and large amounts of humanitarian aid, also really critically, are going to be sent in to support those civilians who remain behind. What's also interesting off the back of this is to see the political wrangling in the United States over who takes credit. We've seen both President Biden and President-elect Trump claiming credit for finally getting this deal done.
After 8 months of nonstop negotiation, my administration, a ceasefire and a hostage deal has been reached by Israel and Hamas, the elements of which I laid out in great detail in May of this year. This plan was developed and negotiated by my team and will be largely implemented by the incoming administration. That's why I told my team to keep the incoming administration fully informed, because that's how it should be, working together as Americans.
And outgoing US President Joe Biden struck an ominous tone in his farewell address, warning that an oligarchy is taking shape in America without mentioning his successor. Biden highlighted a dangerous concentration of power in the hands of a few ultra-wealthy people. He also raised the red flag on a tech industrial complex, adding that it could pose real dangers to the country.
We see the same dangers of the concentration of technology, power, and wealth. You know, his farewell address, President Eisenhower spoke of the dangers of the military-industrial complex. He warned us then about, and I quote, the potential for the disastrous rise of misplaced power, end of quote. 6 decades later, I'm equally concerned about the potential rise of a tech-industrial complex that could pose real dangers for our country as well. Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms, and a fair shot for everyone to get ahead. We see the consequences all across America, and we've seen it before, more than a century ago. But the American people stood up to the robber barons back then and busted the trusts.
That's President Biden there in his farewell address to the nation. Coming up at 5 p.m, an exclusive interview with the outgoing U.S. ambassador to India, Eric Garcetti, on the Indo-U.S. relationship and what shape it's likely to take under the new Trump administration. On to a CNBC-TV18 exclusive. Less than 2 weeks to go for the union budget. The government is considering reintroducing the concessional corporate tax scheme for new manufacturing units. Sources tell CNBC-TV18 the government may set the concessional rate at 18% instead of 15%. Timsy is standing by now with more details. Timsy, the earlier scheme with the concessional rate of 15% for new manufacturing units, the sunset in March of 2024. So a possible reintroduction on the cards?
Well, yes, as you rightly said, sources are indicating to us that the government is reconsidering the demand that has been coming back and again from the India Inc. And now the proposal is rightly there on the table for a consideration for reintroduction of concessional corporate tax rate. Government currently is mulling this reintroduction of the concessional scheme for new manufacturing units, but at 18% as compared to earlier 15% plus charges. Government, remember, right now is considering to bringing back these concessional corporate tax rate scheme to promote Make in India, create employment, enhance manufacturing, knowing that this is the need of the hour to kickstart the economy and to get it back into the shape. The view that we hear from North Block, from our sources, is that the India Inc. has been asking for a reintroduction of the scheme to promote Make in India, and thus this proposal is under active discussions right now. The exact status, to be precise, the proposal is between North Block and PMO under active discussions. However, just to remind our viewers, no decision has been taken as yet, because any taxation-based decision for the union budget announcements are done only closer to the union budget. So let's see whether this proposal actually comes back or not, because the concessional corporate tax rates were notified in September 2019, which had a sunset in March 2024. And when we approached Finance Ministry with our query on this particular story, it remained unanswered. So that's what sources are telling us right now. New units coming up could be getting a concessional rate, but yes, at an 18% and not at 15%.
All right, Timsy, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. We are, of course, standing by for the Infosys management to address the media. That's coming up right after this on the Q3 numbers, which are in line with estimates and along expected lines. So that and more coming up for you. Stay tuned to CNBC-TV18. We're back in a moment.
Mind back on track. What's the mantra you follow?
Well, I mean,
you could tell us after any match that you remember, which was very close to your heart and was difficult to get over.
Yeah, recently, I think, not recently, but Tokyo, I would say, where my Olympics, the second Olympics, I lost in the semi-finals. And of course, it was very, very hard, but I had mixed feelings, mixed emotions where, you know, I was feeling bad, where if I have to think I lost an opportunity, you know, I lost a chance to go to the finals. And on the other side, I was thinking, do I have another opportunity to play the bronze medal match? So I was like confused, I was upset, I didn't know what to do. I just had that, I would say, less than 24 hours to decide and come back stronger. So I think that was the perfect example that I could remember and tell you now, because it was really hard at that point of time, because you lost the semi-finals and you lost the opportunity to go to the finals and get a gold or a silver. Rather, you have another opportunity to prove yourself, right? So, yeah, I mean, my coach and my parents just told me that there's a lot of difference between the fourth and the bronze. So, at that point of time, my mindset was like completely like, I was like, no matter what. I couldn't even sleep that night because I had a match next day in the morning. And obviously, I just gave my 200% and I got that bronze back. So,
right, just come back harder. Just come back even harder.
I think the belief is very, very important. Just believe in yourself.
Bibi, we'd also like to ask you about this debate over 70-hour, 90-hour workday. It's a rage on social media. People have different views about productivity, not being forced into 90 hours. Rajiv Bajaj has said that if you want to work 90 hours, it should really start from the top, and if it's successful, then implement it. And it's not really about the number of hours you work, but about the efficiency and productivity you show. What would be your view?
I would not say this is right and this is wrong. My only thing would be, you know, how many hours ever it is. I would say it needs to be useful, and there need to be a good change in whatever you do. I think that is the only thing I can say, because talking about hours, I think people ask me how many hours do I play, you know, is it important that you play so many hours, or is it important that you play only for a few hours? So even that debate keeps going on at times, but whatever it is, it needs to be in a very smart way, and it needs to be very useful for everyone, and everyone needs to be happy at the end of the day. That is it.
My final question, what do you think India as a country can do more in terms of encouraging sports and making sure...
Done. With that, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Sangarajka, Chief Financial Officer, Infosys. The first question is from Ritu Singh, CNBC-TV18.
Hi, Salil. Hi, Jayesh. Happy New Year. Let me just start with that revenue growth that you've posted, because Q3 is typically a seasonally weak quarter. The market estimates were about 1% growth, but you've been able to deliver 1.7%. So is the environment significantly better than what you saw 3 months ago? One, if you could give us a commentary on that. And on raising your revenue guidance to about 4.5% to 5% wasn't expected lines, but, what is the implied growth rate for the fourth quarter then? Are you expecting a degrowth of about 2.5%, given this margins that you've given? Also, your wage hikes, I think last time we asked you and you said it may happen in the fourth quarter. If that is on track, and what will be the impact on margins once you do undertake that? And hiring again, has been going up for the last 2 quarters. How should we read into that? Again, coming back to your revenue question, if you're expecting a degrowth in the second quarter, will you continue this pace of hiring? What is the demand outlook? And if I may add, deal wins, while they've been steady, they've not really accelerated. If you could give us a sense of what the pipeline looks like from here on. Thank you.
So thanks. I'll try and go through the question, and some Jayesh will also answer. On the first, I think the sort of view in Q3, and it was the growth at 1.7%. What we saw was, the last quarter we had seen discretionary becoming good in financial services in the US. Now this quarter we have seen financial services in Europe, also the discretionary showing signs of improving, and on retail and consumer products in the US is showing that signs of improving. So that coupled with how we delivered in the quarter was the reason where we changed the guidance to increase. Now the second I think was about, if that is the guidance, what is the Q4 and so on. So there, first, as we've always shared, our Q1, Q2 in a typical financial year are strong, our Q3, Q4 are typically weak. So that's the sort of seasonality that we see in Q4, nothing more or less. Jayesh will give a little bit more color on some of these points. On the hiring that you mentioned, there I'll say a few words and I'll pass it on to Jayesh. We've had a strong hiring in Q3 with this expansion of over 5,000 employees. And we see that based on some of the discretionary, this will continue, but it will have seasonality as we see in our revenue. For the next financial year, we are obviously not giving the growth guidance, but what we do see is that many of the things we've put in place across the whole company, focused on large deals, focused on small deals, focused on artificial intelligence, making sure we're doing cost takeout for clients. All of these things combined are helping the company to execute as well as it's doing. So let me pause here if there's anything else.
How much of it was organic, how much inorganic because of the Intech acquisition, that as well?
So Intech, let me just answer that and I'll go back to other questions. Intech was, last quarter, we had pretty much 2.5 months of Intech. So this quarter, the Intech was roughly around 20 pips in revenue. Coming back to the other points, if you look at large deals, our large deals, while the overall large deal number you will see is remaining same, within that, the net new has increased significantly. So last quarter, our net new was 40%, this quarter, our net new is 60%, which means that the large deals per se, or the net new TCV of the large deals have gone up 1.5 times, between Q2 and Q3. Our large deal pipeline has become stronger, as we see. So all of that has led to our increase in guidance, just to add to the points that Salil was making. Coming to the other question on comp, we had announced earlier that comp will happen in 2 phases. One phase from 1st January, the other one will happen from 1st of April. We are on track with that. The first part of the comp is getting rolled out in this quarter, and we are working with HR on that. So our HR team is working on that.
The question rather was, what will be the impact on margins?
We don't define the impact on comp, exact impact on the comp in terms of margins. So we will have some headwinds coming from the comp in Q4 and Q1 based on it. But, broadly, the comp that we are expecting is 6 to 8% in India, and, the overseas comps will be in line with the earlier comp reviews.
I think, Salil, the question on discretionary spends on high-tech, telecom, some of these areas that you'd continue to flag in the last quarter, if the outlook on that is improving, and if the BFSI momentum you expect to continue into the new year.
So, on high-tech and on telecom, we've not seen a change. What we've seen the change is really on financial services, more in Europe, and on retail consumer products in US. Will it continue at this stage? That's what we're seeing in terms of what we saw in Q3, but we'll wait and see how it looks beyond that.
Thank you. The next question is from NDTV Profit, Haripriya.
Hi, Salil. On the discretionary spending part that you mentioned, is this kind of change that you're seeing is only sentimental, or you see this translating in the budgets, in the upcoming budgets for the companies across the sectors that you mentioned? And also with the new administration coming in the US, what's the kind of impact that you're expecting from that? The market expects the stability to bring in a lot more, budgets to open up a lot more. And also on the employee headcount, the attrition is also rising a little bit more, if not gradually as well. So how do we read into that? And on the margins, what's the kind of impact the cross-currency headwinds have had? There's a lot of movement that has happened in the currency. And also, would there be any furloughs or spillover? And in the long term, like you have had a guidance band for margin, and it is there, but also it's quite narrow. And so, in the long term, what is it? How is it that you choose to improve on the margin part, given that there's also a margin project improvement that you have?
So let me start off with some of them. The first one was on the discretionary. The budgets for our clients will be on a calendar year basis, which will start now. So we'll get a sense in this quarter itself. Our commentary is mainly on what we've seen in Q3 and how the discussions have been going. And that seems to indicate the changes that I mentioned. In terms of the new changes in the US, we'll wait and see how it goes. Generally speaking, most people who are the economists and so on have a view that the economy there will do better. That's what our clients are saying. But we'll wait and see how it goes. We have a business that works in those growth situations, in the cost situations. So we're feeling quite confident in terms of the outlook there.
So what's the dependency on the H-1B visas? Do you see any impact there?
So there, maybe you want to go?
Yeah, I can answer that. So if you look at, over the years, our dependence on H-1 visas have reduced significantly, right? First and foremost, our on-site mix has reduced significantly. We used to be in the 30% range. We are now at 24% range. Within that, our nearshore has increased significantly. And within the on-site, the US on-site population that we have, our H1 independent folks are now 60+%. So we have now built a pretty resilient model from that perspective, and we are therefore much more confident from where we are versus where we used to be earlier.
How do you lead to the attrition? The other question there on attrition.
Yeah, so coming back to your other questions, attrition at this point in time has remained at 13.7, which is one of the lower attrition that we have seen in the last multiple years. It's range bound, and we don't see a challenge there at this point in time. We have already added last two quarters. We have added net new employees, and our campus hiring program is also as per our plan. So we don't really see a challenge there as well. You had another question on margins. So if you look at our margins this quarter, we have expanded our margins by 20 basis points during the quarter. And if I just take the puts and takes of that, 40 basis points came from currency benefit, both rupee depreciation as well as the cross currencies. 30 basis points came from a Maximus, mainly from the pricing benefit that we got. 20 basis points came from the expected credit loss provisions and lower provisions on post-sale customer supports, offset partly by higher third-party costs that we had. And the headwind of 70 basis points was furloughs and lower working days and other costs. So that's our margin walk for the quarter. As we get into the next quarter, we will have headwinds coming from the compensation increase that we have rolled out already. So that would be a headwind. Currency, we'll have to see how it pans out. At this point in time, looks like currency will give us some benefit in terms of margin, but we'll have to see how the currency progresses through the quarter.
Thank you. The next question is from the Economic Times, Beena.
Hi. I want a question on the hiring commitment. I think you'd committed to 15,000 to 20,000 freshers. Is that on track? And how much have you hired so far under that? And what's the outlook for the next fiscal? And if you can just give us maybe this calendar year as well, what's the sort of hiring that you're looking at, both freshers and overall hiring? On the deal momentum, if you could just give us a sense, which sectors are likely to grow in the next 2 quarters, while financial services is seeing a lot of pickup. Could you delve into the other segments as well? And, with the deal cycle closing, a lot of other peers have said that that is sort of shortening. If you could also give us some sense on how the cycle has been. And how is the large and mega deal pipeline going forward for the next near term, maybe next 2 quarters? And the last thing, what sort of impact do you see because of the recent lawsuit that has been made public, in one of your court filings? What is the business impact? because of that lawsuit? And could you give us some color on, the charges? Because I think some of it is very serious. So that's it.
Okay, so if you look at the headcount, we are on track in terms of headcount or the fresher hiring this year. We will be hiring 15,000 plus. We are expecting for FY26 at this point in time 20,000 plus fresher hiring. We do not really give an outlook in terms of the lateral hiring that is dependent on multiple factors, how the demand grows, how the attrition pans out, etc., etc. And it's also a factor that over the years we have now moved to a very agile hiring model. So we can pretty much fill this in India in 2 to 3 months on site in less than a month in terms of the demand. So we don't really therefore give out an overview or outlook in terms of the lateral hiring. But in terms of freshers, 15,000 plus for this year and 20,000 next year is what we are looking at this point.
At Olympics, year after year, athletes like you work very hard. It's a tough journey. You go through injuries, defeats, failures, bounce back again. It's a constant journey. But what can we do to have a greater sporting culture all the way from top to the bottom or from bottom up?
I think it's very important that you have a very good system. That is very important. And I think everything needs to start from the grassroots level. Not that when you come to a certain level, people then say that, okay, we need support or we need the infrastructure or everything, but it needs to start from the grassroots levels. And I think I'm happy to say that we've been getting a very good support from the government, and there've been good support from the sports authorities. At the same time, I think there needs to be a lot more leagues happening, so that there are a lot of youngsters who are doing really well, but not able to prove themselves. I think leagues now, if you see there've been Coco, and then there've been tennis and pickleball. A lot of leagues are coming up, and I hope there will be a lot more in every sport, because these kinds of leagues, a lot of people get a recognition in terms of they get to see a lot of athletes who take them as an inspiration and prove themselves and have that confidence that yes, even we can do it, because a lot of people are doing really well, are working hard, but they're not getting that opportunity or not able to have that platform where they can prove themselves. So leagues like these will definitely help them to come up and think that yes, we also have something to actually look up to.
From sharp insights in the political arena to all the excitement from the world of sports. We are here at the CNBC-TV18 budget headquarters, as we've done for the last 25 years.
Celebrating 25 years of CNBC-TV18.
Markets are betting big on affordable housing. You look at the kind of stocks that have risen.
We are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us.
Celebrating 25 years of CNBC-TV18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the stories we are tracking this evening. Well, Dalal Street ended in the green for the third straight session. Nifty and Sensex gained nearly 0.5% each. Nifty managed to hold 23,300. Broader market outperformance continued, with Nifty Bank and Mid-Cap Index soaring over 1% each. In the money market, the Indian rupee weakened against the US dollar once again. The move comes despite the RBI announcing daily liquidity infusion through bond auctions after a 5-year gap. This move, along with the slowing inflation in the US, bolsters hopes for a rate cut in February. Lata Venkatesh is here with more on the shift in RBI's liquidity stance.
Well, the Reserve Bank has restarted daily repo. What is repo? Repo is a means by which the central bank of any country gives money to the banking system when it needs. So this had gone away into a 14-day repo. Some time back, 2020 was when it got written into the RBI rules that they won't do daily repos at all. They will do 14-day repos. Now, often what the Reserve Bank actually is trying to tell the banking system is that you make an assessment of what will be the deficit for you over 14 days and take that money from us. We will provide the liquidity. It was trying to tell the market, I will not be your treasury manager. You have to manage your own liquidity. But it often wouldn't work. The Reserve Bank was giving 5-day liquidity, 3-day repos, 4-day repos, especially when liquidity was tight. But with the re-emergence of the daily repo, that is really status quo ante, it clearly indicates a regime shift. We are going back to a position where the Reserve Bank is ready to stand by on a daily basis and give not unlimited liquidity as they used to, but give 50,000 crores. So that really counts as a change of mindset, and probably when it coincides with the governor and the most important deputy governor changing, it looks like a regime shift. It could be interpreted as one. Besides, of course, the easy liquidity is only 50,000 crores. The market deficit is more than 50,000 crores. It's often a lakh crore and even more. But this is definitely some kind of a relief. The Reserve Bank is also doing something called swaps. They did it twice in the last 7 days. They sell dollars in the spot market so that the rupee doesn't depreciate too much. And then they do a buy-sell so that, the liquidity is provided back to the market and the liquidity withdrawal is postponed. Basically, the swaps are a liquidity infusing instrument. Given both these, the market is of the view that the Reserve Bank is on the side of providing more liquidity, and therefore possibly a rate cut in February can be expected. If the liquidity is very tight, a bank cannot pass on a rate cut. They will still want to keep deposit rates high so that they can continue to gather liquidity through deposits. Now, if the liquidity eases, then when the rate cut comes, it will get passed on. So all told, the markets are in a cheerful mood. Add to it the US CPI core CPI coming in lower than expected. There is a good 5-6 basis point fall in bond yields. And if you compare it to the high of the week, then it's a 10 basis point fall in the yields. So bond markets in a cheerful spot.
Thank you, Lata, for that. Hindenburg, the US short seller behind the $140 billion rout in Adani Group stocks, has announced that it's shutting up shop. Remember, Hindenburg had accused the Adani Group of violating corporate governance norms and manipulating its stock prices. Following the allegations, the market capitalization of the Adani Group stocks tumbled from an all-time high of 23 lakh crore rupees on September 20th, 2022 to a low of 7 lakh crore rupees on February 27, 2023. Now, nearly 2 years since the first Hindenburg report, the group has not fully recovered its losses and its current market cap stands at 13 lakh crore rupees. Today, the shares of the companies, including Adani Enterprises, Adani Green Energy and Adani Total Gas, surged in trade. Hindenburg Research's founder, Nate Anderson, said that his firm shook some empires that needed shaking. He added that nearly 100 individuals, including billionaires and oligarchs, were charged either civilly or criminally by regulators based on Hindenburg's reports. Last year, the US short seller also accused SEBI chief Madhvi Puri Buch of having a conflict of interest in the Adani matter due to her previous investments in the group. Now, both Adani Group and Buch had refuted the Hindenburg's claims. Israel's cabinet has delayed the vote to ratify the ceasefire and hostage release deal with Hamas. Prime Minister Benjamin Netanyahu's office has accused Hamas of attempting to obtain last-minute concessions on some aspects of the deal. Hamas has said it was committed to the ceasefire agreement, which was announced by the mediators. Celebrations, erupted in Khan Yunis and other parts of Gaza after mediators, Qatar and the United States said that Israel and Hamas agreed to a ceasefire and hostage release deal following 15 months of a bloody war. Israel has reportedly killed at least 80 people in Gaza after the deal was announced.
CNBC's Dan Murphy has more on the deal, which is yet to be ratified by the Israeli cabinet.
Prime Minister's office in Israel essentially saying here and claiming that Hamas has backed out of some of the agreements that were put in place and creating what it is now calling a last-minute crisis to finalize this hostage release deal. That statement from the Prime Minister's office released in both English and in Hebrew in the last few hours, saying Hamas is reneging on the understandings and creating a last-minute crisis that is preventing an agreement. It goes on to say the Israeli cabinet will not convene until the mediators notify Israel that Hamas has accepted all elements of the agreement. Now, this shouldn't necessarily come as a surprise. Of course, we have seen previous ceasefire deals really coming down to the wire and failing to be agreed as a result of Israeli and both Hamas walkbacks. How concrete this is, whether or not it can be overcome, of course, all remain to be seen at this point. But what we do know is that there was an agreement that was reached. That agreement is going to take shape over 3 phases, the first of which is originally scheduled to start on Sunday. Phase 1 is going to last about 6 weeks. It's going to see the release of dozens of hostages being held in Gaza, as well as Palestinians in Israeli jails. And it's understood that Hamas has agreed to release 33 hostages in exchange for 100 Palestinian prisoners, at least to begin with. Under this deal, we're also going to see Israeli forces withdraw to the Gaza border, and large amounts of humanitarian aid, also really critically, are going to be sent in to support those civilians who remain behind. What's also interesting off the back of this is to see the political wrangling in the United States over who takes credit. We've seen both President Biden and President-elect Trump claiming credit for finally getting this deal done.
After 8 months of nonstop negotiation, my administration, a ceasefire and a hostage deal has been reached by Israel and Hamas, the elements of which I laid out in great detail in May of this year. This plan was developed and negotiated by my team, and will be largely implemented by the incoming administration. That's why I told my team to keep the incoming administration fully informed, because that's how it should be, working together as Americans.
And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
It's been over 2 decades of tracking the global power shifts at the World Economic Forum.
Hello and welcome. You're watching News Center. I'm Archana Solanki. The ceasefire and hostage release deal between Israel and Hamas still awaits the final approval. Israel has now said that its cabinet will not meet to approve the deal. Prime Minister Benjamin Netanyahu's office has accused Hamas of attempting to obtain last-minute concessions on some aspects of the deal. Hamas has said it was committed to the ceasefire agreement, which was announced by the mediators. Celebrations erupted in Khan Yunis and other parts of Gaza after mediators Qatar and the United States said that Israel and Hamas agreed to a Gaza ceasefire and hostage release deal following 15 months of war. Israel has reportedly killed 80 people in Gaza after the deal was announced. Meanwhile, both outgoing US President Joe Biden and his successor Donald Trump have claimed credit for hammering out the deal that had been in the making for months. Biden also struck an ominous tone in his farewell address, warning that an oligarchy is taking shape in America. Listen in.
After 8 months of nonstop negotiation, by my administration, a ceasefire and a hostage deal has been reached by Israel and Hamas, the elements of which I laid out in great detail in May of this year. This plan was developed and negotiated by my team and will be largely implemented by the incoming administration. That's why I told my team to keep the incoming administration fully informed, because that's how it should be, working together as Americans. We see the same dangers of the concentration of technology, power, and wealth. You know, his farewell address, President Eisenhower spoke of the dangers of the military-industrial complex. He warned us then about, and I quote, the potential for the disastrous rise of misplaced power, end of quote. 6 decades later, I'm equally concerned about the potential rise of a tech-industrial complex that could pose real dangers for our country as well. Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms, and a fair shot for everyone to get ahead. We see the consequences all across America, and we've seen it before, more than a century ago. But the American people stood up to the robber barons back then and busted the trusts.
Eric Garcetti, the outgoing US ambassador to India, has welcomed the ceasefire agreement between Israel and Hamas. In his last interview as the US envoy, he also spoke to my colleague Parikshit Luthra about India-US ties under the Biden administration. Take a look.
The overnight announcement on the Israel-Hamas ceasefire. The Biden administration, the State Department, has thanked Trump for helping them reach this point. How do you see these developments?
You know, first of all, let me just say at the end of my time here, just what a wonderful 2 years this has been. The Indian people have been so deeply inviting, warming. You know, they have taken me in a way that I never expected, even though I've been coming here since I was 14. And I've also seen India be an incredible voice for peace and for progress in the world. I think the announcement yesterday is welcome. We have too much war in the world today. We're both peaceful countries that want to see conflict. As the Prime Minister said, this is not an era of conflict. It should be an era of peace. And I hope we can see hostages come home, and we can see violence reduced, and that we can finally see armies be able to retreat and communities be able to recover. That is the most important, and for families to be reunited who for so long have not been.
Right. But what do you think? Do you think now this would lead to lasting peace in the region?
Well, lasting peace isn't just achieved one day. It has to be accomplished every single day. And I think one of the places where India and the United States can work on that peace was the announcement during G20 of IMEC, the India-Middle East corridor, a way we could connect literally that old spice route that connected India with the Middle East, or as West Asia as it's called here, and Europe. This could be a way to embed peace across borders where we've seen too much conflict, investment to flow, tourists and visitors to come to these areas, and whether it's communications cables, or whether it's energy infrastructure, or whether it's the trade of goods and services, create jobs that are the lasting product that creates peace.
Right. What is your worry at this stage? Because when we were hearing Joe Biden's speech, he was talking about how oligarchy is taking shape in America, how a tech industrial complex is being formed, how power is now getting concentrated in the hands of very few politicians and tech billionaires. What do you think is the big worry, and what could we see shaping up in America in the days to come?
But I personally think we live in some of the most exciting times in human history, but there are also some of the greatest dangers we've ever faced. Obviously more conflict at the same time than ever in our lifetimes. But what US and India show is when we share values and remind that we're constitutional democracies when other countries are not, when we respect the diversity and the rights of all people while other countries don't, that's when we're at our strongest individually and collectively. So when we see the ability, for instance, to work in Africa together, Southeast Asia, the Pacific Island countries, to be bigger than ourselves, of course to help Indians, of course to help Americans, but to think more broadly than that, that's really where the US-India relationship has a certain magic. I think in our values we want to share prosperity, not concentrate it. I think in our values we believe in democracy, not in the concentration of power. So, for instance, the ISET initiative of critical emerging technologies is how do we use technology to connect and protect us, not to divide us or harm us. So it's a good clarion call that the president put out there. Any country, I think, probably feels the same, and it's up to citizens every single day to make sure that that prosperity is shared, never over-concentrated, and in a democracy, you got a much better shot of doing that every time you vote.
As a diplomat and as a politician, what do you think Donald Trump and the people around him are trying to do? If you had to explain our viewers the importance of Joe Biden's address, the essence of what he's talking about when he warns people in America about disinformation, about oligarchy, about concentration of tech power in the hands of few billionaires, what exactly is happening, and what would you like to warn people about?
Well, look, I don't think it's about an incoming administration. I think it's a general warning that we suddenly open up our phones and we think a politician's talking to us only to learn that it's AI using their face and words that they never said before. We have to guard ourselves, train our children how to find real facts, how to do their own research. And I always remind people the best weapon against changing technology is go outside and talk to real people. As a politician, I had to knock door by door in a constituency. And 99.99% of people never actually have this sort of a face-to-face conversation. That's how we save democracies. That's how we engage in our responsibilities in a democracy. And in the time in between elections, do the work that we've done here in the US and India. Find companies that will co-invest, figure out how we can lift up the empowerment of women, take on the climate crisis that we see in my own city in Los Angeles with fires right now, or as we've seen with floods and other things here in India. That work is too precious for us to just sit back, be passive on our couches, watching the news saying, oh, the world's turning bad. Go make the world instead of passively receive it.
So Elon Musk and Donald Trump, how do you think this relationship is going to be?
Well, it's certainly a dynamic one. Two very strong, very successful individuals. I've worked with Elon in Los Angeles quite a bit. I mean, I think what you have in Elon Musk is somebody who has always pushed the boundaries. I think that it's important for us to remember any one person from the richest to the poorest. In a democracy, we all should all be equal. But let's also harness the courage to not see the world the way it is. I think one thing loud and clear, no matter what political party you're a part of, the status quo isn't working for everyone. It might not be the solutions proposed of it just exploding everything is a solution. But there are certain things we all have to be able to stop defending and walk away from. For instance, the US-India relationship, for too long, and it's very true, we've said, we really like each other. We're working at a historic high. Think about record visas, record students, record trade, record defense work, record space work. But it's still not good enough. If we're going to outpace our adversaries, if we're going to redefine the supply chains of the future, if we're going to find AI that works for human beings instead of oppresses us, Let's continue raising that ambition, and I think that's the dynamic we're seeing in a new administration that Elon Musk has always brought as well. And it isn't about the defense or the criticism of any one person. It's about the engagement of all of us.
All right. I'd like to ask you about Biden administration's legacy vis-a-vis India.
I think this is the most pro-Indian president and administration we've ever had, and vice versa, by the way, the most pro-American prime minister and administration here in India we've ever had. And I'm sure that President Trump will want to take it the next level up from that. But President Biden told me when he asked me to become the emissary here, he said, this is the most important country in the world to me. I believe no American president ever said that in history. And that was 30 years in the making, where he saw our values are aligned, our diversity is similar, we both have constitutions, we see the same threats out there, whether it's countries that want to define the world by their might, or whether it's climate and artificial intelligence and things like that. So when the Prime Minister visited with President Biden, the first time for the state visit, or as a second visit actually, there was 178 different deliverables, from returning Indian cultural artifacts to launching satellites that have never been seen in the history of humanity into space, and everything in between. We're sharing our best technologies with India, we're sharing our hearts with India, and vice versa. India is teaching us so much as well. So I think the legacy of the Biden administration will be that a generation ago, this relationship would have been unimaginable. A generation from now, people will look back and say, this is indispensable for the world and for our people.
Right. If there were any recommendations on ease of doing business, something which you feel has been an irritant in India-US ties, which can be erased, what would that be?
Well, I'm very humbled that I'm sure there's a list for Indian companies in the US. So we're not perfect, we're bureaucratic as well. But it's still a complex place to do business. I'm a big cheerleader for India, and I want to see more American companies investing more, especially as they take supply chain and manufacturing out of places like China. We need to land that here. And this has never been a better place to do business. Great incentives, amazing workforce, infrastructure that's being built out, but it still can go further, faster. So when I see a company saying, well, we're going to go to Southeast Asia because it's a little bit more easy to do business there, the regulations, the real estate, the technologies, the whatever it is, I say, no, come here. But I look forward to an India that continues to accelerate lowering of tariffs, training of the workforce, building out the transportation infrastructure, safeguarding the trademarks. The more India does, I guarantee you, it will pay off in an exponential way.
The Panun case and also the Adani case in the US, how is this likely to play out? And is this going to be a problem with India-US relations as well?
I don't think there's anything that could stand in the way of US-India progress. A relationship is defined not by whether you love each other. It's clear US and India love each other. But like in a marriage, can you get past your first fight? Or do you know how to disagree and get through it? And I think we're showing that. In the Panun case, it was welcome first step yesterday to see the report come out of the Ministry of Home Affairs, which talked about systemic reform and accountability, which we've been clear. Those two things, which never should happen again, are the three conditions for moving forward. There's still a while to go, but it is a very welcome first step. I can't speak to the other case because that's something that I haven't been read into. But look, we are going to need Indian partners, companies that can work with America, that we can help finance in places, whether it's in South Asia, whether it's in Africa or Southeast Asia. We need things that are not debt traps. We need companies that aren't state-owned, non-democratic players. And so I look forward to continuing to deepen that work with all Indian companies in the future.
Right.
All right, time now for a short break. News and updates continue right here.
First story reported 20 years ago to last year's groundbreaking coverage of the world's most important economic event. From discovering era-defining ideas to connecting you with the world's visionary thinkers and doers. From decoding blueprints for growth to driving collaboration to make a better future. We've been bringing you a wealth of information through 20 seasons. Tune in to Davos Diaries at Davos 2025, live and exclusive on India's most trusted business news platform, CNBC-TV18.
Or 16.2 that we've got, and I do see Q4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels. Our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year.
You look at the quality companies, I think the internet platforms and anyone who has the potential to use stuff like AI well, those companies I think still are very interesting. Healthcare is a good space. It's not obviously high beta, but basically I think globally there is a need to reduce healthcare costs because governments are very leveraged. There is aging population, and India has obviously got great strength in terms of generic drugs or medical tourism or whatever. I mean, bulls are very tired on insurance because last 3-4 years we've kept getting hit by some regulation or the other. I do feel that mutual funds are more efficient as a savings vehicle than insurance. But having said that, there is obviously need for long-term savings, which insurance is an avenue for. Yeah, so we have a bit both the general insurers, life insurers, and the tech platforms around it. But yes, it's been it has needed a lot of patience. I think it's going to be.
Welcome back. Infosys has beaten estimates in Q3 with a revenue growth of just under 2%. Quarterly profit rose 11.4% compared to last year. The IT major also raised its revenue growth guidance for the full year to 4.5 to 5%. Reema Tendulkar is here with more on the company's performance. Reema.
Thanks so much for that. So Infosys has clocked in a good quarter. In the current quarter, the company's revenue growth in constant currency has gone up by 1.7%. This is ahead of the CNBC-TV18 poll of a 1% growth and also better than what its closest peer TCS has done, which was a flat performance. Margins for the company have gone up by 20 basis points to 21.3%. But remember, the wage hike impact only kicks in Q4 and in Q1, which means in the subsequent 2 quarters, there will be some impact of the wage hike. What helped the margin performance this time was one, the Project Maximus, which is basically their cost-cutting initiative to try and improve their margin, plus the rupee tailwind, offset to some extent by the furloughs, which is lower working days, and even the higher pass-through of the third-party costs. The company has raised the full-year revenue forecast. So the current guidance stands at 3.75 to 4.5%, and the new guidance stands at 4.5 to 5%. So the top-line revenue forecast has been upped, though the company holds on to its margin guidance of 20 to 22%. Deal wins for the company are fairly steady. The large deal wins now stand at $2.5 billion versus $2.4 billion. Hiring for the company has picked up in the current quarter. They've added more than 5,500 employees to their overall headcount, and the attrition too continues to inch up. But in the management commentary, there's one key positive takeaway. They said that in the prior quarter, it was basically discretionary demand in US financial services, which was showing green shoots. But in the current quarter, they've seen a pickup in demand in discretionary spending in Europe, BFSI, and US retail and consumer sector. So these are the 2 areas where we've seen a positive improvement in demand. One is Europe BFSI, and the other one is US retail and consumption, which is what gave them the guidance to go ahead, confidence to go ahead and raise the guidance. So all in all, it's a good quarter for Infosys. Back to you.
Right, thank you, Reema, for that. Staying with action from the earnings space, Axis Bank reported a weak third quarter with business momentum at a 15-quarter low. Abhishek Kothari is here with us. Abhishek, decode the Axis Bank earnings for us.
Well, to begin with Axis Bank, the business momentum is the weakest that you are seeing in last 15 quarters. Deposit growth is the lowest in last 15 quarters, coming in at 9% YOY, and advances growth is much weaker than deposit growth at about 8.8% YOY. The other income is down about 11% on a sequential basis. Operating efficiency is one of the best in last 7 quarters, with cost to income ratio being at 46.2 versus 47% sequentially. Now, this is because the overall OPEX is down about 4.7% quarter on quarter and grown by just 1% YOY. Operating profits are down by 1.7% sequentially. It's the lower provisions which has aided the PAT this time around. Gross NPA is up only 2.5% in absolute value on sequential basis. Net NPA is up 4.5% quarter on quarter. So gross NPA ratio has inched up by just 2 basis points sequentially, and net NPA by just 1 basis point sequentially. The NI is weaker than our poll. The PAT is ahead of our poll due to lower OPEX. Back to you.
Right, thank you, Abhishek, for that. Tata Sons continues to remain classified as an upper layer NBFC as per the RBI. As per its latest list, the company is among 14 other companies who have been classified as an upper layer NBFC. As per an RBI directive dating back to October 2021, large non-banking finance companies were asked to list their shares on a stock exchange within 3 years. Reserve Bank of India has said that Tata Sons' application to deregister itself as a non-banking finance company is still under examination. Ritu Singh joins us now to put things in perspective. So Ritu, is it safe to say we cannot conclude that a listing is certain for Tata Sons in 2025?
IPO or no IPO for Tata Sons, there's no final word on that just yet, because as per Reserve Bank of India's periodical updates on the list of NBFCs that are categorized as large upper layer NBFCs, Tata Sons continues to feature on the list, and according to RBI's scale-based regulations which were released in 2021, after which it followed up with a list of upper layer NBFCs sometime in September 2022, mandating all of these companies to go public within 3 years, that is by the later half of this year. That stands. But importantly, in the footnote to the list that has just been updated for the year 2024, the Reserve Bank of India does say that Tata Sons' application for deregistration as an upper layer NBFC is under examination. This is not the first time that Reserve Bank of India has said so. Remember, earlier in an RTI reply also it had said that it had received Tata Sons' application to deregister, and that was under examination. It continues to be examination even as of now. Keep in mind, we've been reporting earlier as well that Tata Sons repaid more than 20,300 crores of debt, to comply with the regulation to avoid, going public by September 2025, which it will have to do if RBI rejects its application. But for now, there is a bit of a reprieve where RBI is yet to take a call on the matter. Sometime last year, the Tata Sons had submitted its application to deregister as a core investment company, CIC NBFC. But for those of you who are quite disappointed that there is a possibility of no IPO from Tata Sons, keep in mind there's another Tata Group company that still features on the list of these upper layer NBFCs, and that is Tata Capital, which will still be required to go public sometime later this year to comply with RBI regulations.
All right, thank you, Ritu, for that. That's a wrap on this edition of News Center. News and updates continue right here.
When you started Kabaddi, you said you'd have to work 2 years and do a couple of films to be able to fund that.
Yes.
How much more do you need to do on the film side to be able to fund this?
Well, thankfully, I've moved on from that thought process. I realized about 2-3 years into Kabaddi and football that signing innumerable films to finance my love for sport and the business of sport was not something which I was very happy doing.
Or sustainable?
It is sustainable. It might not be a lot of fun. I started up my family office. I streamlined the finances. It's taken me about 7 years. But thankfully now...
You've got a healthy balance sheet to be able to fund this?
We have a balance sheet and allocated funds through my family office that I can run a sporting business. And I will turn heaven and earth upside down to make sure it's profitable.
So what's the path to profitability?
A conservative figure is 5 years. I'd like to try for 3.
I believe, not a very high return market, to be honest, the next few quarters. The thing is, rather than forecasting anything, the biggest thing is last 3-5 years have been solid in terms of returns. Obviously, valuations are high. And two is, as you pointed out, we're entering a phase where the world's largest economy is going to see a fairly radical regime change. We don't know what exactly will happen in terms of dollar strength, yuan weakness, trade tariffs, etc. So there is a lot of uncertainty, and the valuations are probably, on an aggregate, not reflective of that uncertainty. But having said that, I think there is value at polar opposites of the market. I think a lot of tier 2, tier 3 financials are almost at distress valuation. And I believe that in India, secured lending will still be okay because in general, we are a reasonably high inflation economy. So the asset values keep inflating. And a lot of the tier 2 private banks, PSU banks are at book or below. So I think there is a risk reward opportunity there. I think there is a risk reward in metals at this point of time. And on the other side, when you look at the quality companies, I think the internet platforms and anyone who has the potential to use stuff like AI well, those companies I think still are very interesting.
bet on this experience economy before it became the experience economy?
It's like the analogy from Formula One. So the car that's in front of you is cutting through and creating the slipstream and using more power and energy.
Yeah.
And the guy who's behind you is using 25% less. And he can press the DRS and get ahead of you.
Yes. You know, there are a lot of other players in the market who seem to be wanting to bet on this opportunity.
Yeah, but I don't think just putting big bucks is going to cut it.
You know, there's a lot that requires work at this point in time, and plenty of it is.
It's almost like starting
work
an
in
airline
progress.
but not having an airport, right?
Is it that bad?
It is.
Still.
When you tell me today, what are the venues and where is the infrastructure? When we do one Lollapalooza, we're creating a city overnight and then tearing it down.
How large this opportunity is in the near to medium term.
You and I have spoken about this 20 years ago. We spoke about this 10 years ago. We're still around, right? Doing the same thing.
Yeah.
Which is to say that we have reasons to exist.
What about M&A yourself? I mean, I brought up Paytm.
More companies suffer or die out of indigestion than starvation.
Not a bad thing. Let's address the issue that you've been dealing with in the last few months on account of what's happened with Coldplay.
I've got a clean conscience. My karma is good. I sleep well. People abused us, called us black marketers, called Book My Show, said cancel Book My Show. It's this cancel economy, right? You have nothing to say.
What are the 2 or 3 things that have helped you find that resilience?
Having that balance which Vedanta teaches you, burning your ego every day when you come in.
Hello and welcome to this edition of Young Turks Reloaded. I'm Shireen Bhan. The guest that I have with me on the show today has been around the block quite literally. He's been there, done that, worn the t-shirt, and is one of the people within the Indian startup ecosystem who has survived many boom and bust cycles. And he's lived to tell the tale for the last 25 years. He bet on India's experience economy before it became a thing, and today is looking at the future for Book My Show, which is, of course, India's largest ticketing platform online. Ashish Hemrajani, what an absolute pleasure it is to have you back here on Young Turks. You know, your Instagram bio says, I hope to arrive at my death late, in love, and a little drunk. It's quite appropriate for the way that the business started 25 years ago, isn't it?
I live life every day with that motto. And that Instagram account actually is I don't know who activated it.
It's not actually you.
It's me. But what had happened is that I had disconnected my account, discontinued it, and then somebody posted a Gillette, meme or something, and I don't know who took control of my account. So I changed the password. I've forgotten it. So it still exists, but I don't do anything on it.
So that is that your mantra or not?
It is my mantra. It is my mantra. That is my account, but I don't see it. I don't post, and I haven't seen it in the last 7 or 8 years.
Well, isn't that odd in the world that we live in today, and especially in the business that you're in, that you're off all social media?
Off social media, I have a LinkedIn account, which I haven't seen. I don't have a Facebook account, and I have over 450,000 emails. So I'm like your grandmother. If you send me an email, if you send me a WhatsApp to tell me, go check your email. That's what happened with one of my board members this morning.
Okay, so you know, what is that about? You're a tech company, and you're so far removed from tech yourself?
Not in that sense. Personally, yes, because I just think we are so consumed all the time on looking at our devices that we forget to see the situation or the human or observe things around. And that's always been my motto, that I hate it when we're sitting in a meeting and everybody's on their phones and someone's typing and checking their phones. I just want, if we're doing a meeting, let's keep it short, but let's keep it about the humans in front and ideate and creatively brainstorm and all of that, and we can always get back to our devices. So it's just one of those things that it's become second nature now, and I don't miss it. I don't see it. I've never felt the need to want it.
And no FOMO about it either.
No, I don't. I get all my updates from other people. on what's happening in the world.
Of what's happening in the world. But let's talk about what's happening in the world. And, you know, it's been a 25-year journey for you. And in many ways, as I pointed out at the start of the program, you were ahead of the curve. You bet on this experience economy before it became the experience economy. As you look at where things are today, are we on the cusp of a breakout moment for the experience economy in India?
It seems like that. And I'm not so sure whether it's a good thing to be before your time or not. It's like the analogy from Formula One. So the car that's in front of you is cutting through and creating the slipstream and using more power and energy.
Yeah.
And the guy who's behind you is using 25% less. And he can press the DRS and get ahead of you.
Yes.
And so sometimes you want other players and other people to come and do the heavy lifting as well, to be able to create the market, to be able to spend money, to be able to get new users and consumers and get people used to this experience economy. So we've done all the heavy lifting for many years alone. And I think it's important to have this come together as an industry. So I think you're right that I think this is the starting of what we think is going to be the next 10 years of a change in how people consume and view entertainment. It's a change. I'm not saying it's a good or a bad thing. But there's a lot.
Why are you being so circumspect? Because clearly, you know, there are a lot of other players in the market who seem to be wanting to bet on this opportunity. The likes of Zomato, Swiggy, and others. I mean, they're putting big bucks into this business.
Yeah, but I don't think just putting big bucks is going to cut it. I think you've got to be really careful. And when I look at the entertainment chunk, it's about people going out to, you know, with their spare time. What do they do? To go out for a drink or a meal. You've got TV and OTT platforms at home. You want to spend time there. There's movies, going to a movie theater. How regional is playing a very important role in shaping up India's entertainment economy. Look at the films from the southern part of the country. Look at Marathi films. Look at what's happening with Punjabi music, right? There's a big change. And there's a lot of pride. And there's a lot of connection. So I think why I'm being circumspect is that there's a lot of other catching up to do. I think between single window clearances and licenses on venue, city infrastructure. Look, when you build a venue or there is a venue in any other part of the world, which is 20 miles away, that's 20 minutes from home. 20 miles in India is 4 hours away. And that's not sustainable. You can't do an event every weekend. We have 3 months of the year, which is really hot. And you can't do anything outdoors. A city like Bombay has about 4 months of monsoon. So that takes away 7 months. So you've got 5 months, right? It has to match the global calendar on when artists are touring, because otherwise it's not feasible. It's not economically viable for them or us. So the reason I'm being circumspect is that consumers have woken up to this because the Facebook of India is Facebook, the Instagram of India is Instagram, the YouTube of India is YouTube. Unlike China, where everything is closed.
Correct.
We have a large English-speaking population, and also there's this pride of our own culture and heritage in the music that you see. And when you have these social media platforms, kids are now listening and waking up to this, and you're getting data and analytics. So the consumers have woken up. They're far ahead of the time. We're happy to match up to their needs and expectations. But I think there's a lot of catching up to do on policy, on infrastructure, city infrastructure, just not entertainment infrastructure. So the reason I'm being circumspect is, while this is the start of something big, how big can it get? How will you approach it? How will we succeed and do it well? Because you're one bad news cycle away from something going wrong at an event.
I'll get to the bad news cycle in just a bit, because you've gone through plenty of that, and more recently so. But I still want to delve a little deeper into this economy that's opening up. And as you pointed out, there's a lot that requires work at this point in time, and plenty of it is.
It's almost like starting an airline but not having an airport, right? I mean, where will you land?
Is it that bad?
It is. You tell me today, what are the venues and where is the infrastructure? And when I'm telling you, when you do a venue build-up, when you do stage infrastructure, you do lights, sound, you don't have enough. When we do one Lollapalooza, we're creating a city overnight and then tearing it down. And overnight means it takes us a 1 month build. It shouldn't be like that. It shouldn't be like that. You need public parks like Hyde Park. You need Central Park. You need public parks. You need arenas. You need venues. You need stadiums. I mean, I'm very thankful to, the stadium in Ahmedabad, and it's Mr. Jay Shah and the BCCI and the Gujarat Cricket Association that really took a bet on this and said, look, for the first time in the history of India, we're using an active cricket stadium and the world's largest cricket stadium to put up a show there. Hasn't happened before. Why should it take 75 years? Is my question. Anywhere in the world, it happens every day.
So let me address this. How many permissions and approvals does it take for you to put on a show today in India?
I can't even count. It's just ridiculous because there's excise, there's police, there's traffic, there is fire, there is health and safety, and then there is venue permissions, and then there's a lot, right? It's all ambiguous. Like, for example, the public infrastructure in Bombay is just phenomenal now. Like, just the center ground at Mahalakshmi, because of the coastal road and the development that has happened in the city, the metro lines that are terminating there, the new connector, which is north-south connector, just allows you to do a weekday show. It allows you to get cars in there. It allows people to go home safely.
So the economics, have they gotten better?
It's getting better. Like, I'm being circumspect because it's evolving on a day-to-day. Like, after the 26th of January, you can put 40,000 people in that venue on a weekday because the connector will start after the 26th of Jan. Until the 26th of Jan, you can only put 15,000 people there. So it's evolving on a day-to-day.
So what is your forecast and what is your estimate of how large this opportunity is in the near to medium term? Because there's all kinds of numbers that are doing the rounds on the back of what we've seen happen in 2024, which in many ways has been a sort of breakout moment as far as the live gig economy is concerned. What's your own estimate? What are you forecasting?
Look, the good thing is that we're private and we've always stayed private. All these
you don't intend to change that?
For a while. All these estimates and this big talk and numbers have to be given by the public guys. And the reason they need to do that is because they're playing the stock game. Let's be real over here. We don't need to do that. We're real. This is not some up in the air, come up with a big number, create some plan, say something big, go to the analyst, and then don't deliver. We're delivering every day. And the point is that there's a lot that is dependent on others and not so much on us. And so you've got to work with the local administration, law enforcement, venues, venue infrastructure, infrastructure for sound, light. There is no quality lifts for which go into the stage for a global artist to come. And if you want 10 lifts, they don't exist. You need 20, you need 2-ton pulleys with cable, which you need. And for a stage of our size, which is 230 tons of steel, you need about 40 of those pulleys. Doesn't exist in India. You don't have ground cover, which covers the ground so that the turf doesn't get spoiled. So when you have a pitch, let me finish this. You should be interesting. The work that we've done for both these cricket pitches for the Coldplay concert is the pitch in the middle is haloed ground, right? The 6 pitches or 7 pitches. It's not one pitch because you have practice pitches and you have spare pitches. So in some stadiums, it's 7, some are 11. It's a large piece of real estate in the middle that you have to be very careful about. We've got work that we've done with risers. So you cut a space in the ground and you create base plates.
So leave the pitch intact.
And it has this base plate where you're growing grass on that base plate in the same flora and fauna in the vicinity of the stadium using the same grass, which is a spare piece of patch which goes on top. On top of that, when you create this riser, we have grow lights which mimic the sunlight for those 4 days. So it mimics so that the grass can grow, and it has pinholes where you keep watering the pitch so that it doesn't destroy the pitch. This R&D was done by us for the last year and a half, 2 years, to be able to use a cricket ground. And then you cover the ground and you have to replenish it and get it back in a working condition.
So this is your moat. This is, in a way, the moat that you're hoping will keep the new players in this space at bay.
No, I'm not hoping. I'm just saying that I've got to do a job to put on a show in a stadium, and this is the job at hand. I mean, I'm
trying to understand that you've got now guys with deep pockets who are entering this space, who are doing big deals. I mean, I don't know whether you looked at Paytm and thought that there was any value in that, for instance, or not. But what will be the big differentiator as far as Book My Show is concerned as this space starts to get more competitive?
Look, I think we have a lot of consumer love. we've got a large base of consumers that come to us specifically for a reason, which is to get entertained. We're not confused about the fact that we're going to do 20 things. You and I have spoken about this 20 years ago. We spoke about this 10 years ago. We're still around, right? Doing the same thing, which is to say that we have reasons to exist and we want to give our consumers something which we can offer. And we go deep into understanding things like ground, music preferences. What are the trends? We have 40 artists that come for Lola and only the people talk about the headline. But then they discover bands like Cass, which we did in Lola 1, and now we're doing a 3-city tour with this year, which is in 2025 now.
Yeah.
So I think for us, it's about waking up every day, seeing, what are we excited about? What are the trends for our consumers? What are the new things that we can do? What are the trends in entertainment and the economy, which is the experience economy? We always looked at it as movies and plays and concerts. Now it's called the experience economy. And we wake up every day saying, how can we make it better? What is it that we can do better? What is it that we can do which is different? Can we make it safer? Can we make it, more pleasurable? How do we look at ingress and egress? How do we get people in safely? How do we get them safely out?
Yeah.
I'll tell you what bothers us or keeps us awake or excites us all in one go. When we do an event in Bangalore, what excited us is that at Bandland, we had 14,500 people, which exited our venue in under 6 minutes. Now, that is high for all of us at Book My Show. And that's because we worked with Nama Bangalore, the metro authority. They put 70 volunteers. They put 6 extra rigs. The metro shuts down at 10 o'clock at that place. They kept it open till 11. And we got everybody out in 6 minutes. Now, that excites us. Right now, I don't know, you may say it's a moat. It's a differentiator. We're trying to do it differently. We're just doing it because the consumer is at the center of our world.
Well, speaking of the consumer being at the center of the world, and you also spoke about the fact that you've never chased valuations. But, at this point in time, are you looking at the possibility of going public? Is that something that you aspire to 25 years on?
There's always a possibility, right? There's always a possibility. Never say never.
Yeah.
But at this point...
But it's a much more real possibility today than it ever has been for you.
That's because the markets are going bonkers. And now, is that a good thing or a bad thing? Again, I don't know, right? Because you can get a great listing and then
So do you want to join the party or not?
I don't know if I call it a party. I have my own parties. I don't think if that's a party, because if you break trust, and the one thing that we've done with our investors, with our relationships, including this one, with our customers, is not break trust. And I think when you list high and then the stock doesn't perform over a period of time, or is on a hold, or sell over long cycles, you're breaking that trust. Because I feel in the public markets, the first people that will subscribe to Book My Show stock, if we were ever to go public, will be our customers. And we're just going to break that trust, which we built over 25 years so carefully and curated. And we've curated that trust over a period of time. So I think when we are confident of consistent delivery and performance, where there is consistency in how we're sure on how this business can be business as usual. Yeah. Right now, it's very clunky. There's 5 months of the year. There are cities that we can work in. There are cities we can't work in. Cities that sometimes things get cancelled. There are infrastructure issues. Artists need to believe that this is a market which is sustainable. It's not an exotic market. It is a real market with 220 million English-speaking people who are on social media platforms with a lot of money to spend, with a GDP that's growing at 8%. All of that. And then that single window clearance, and you have the government sort of supporting it and looking at it as an industry. I think at that time, you can think about saying, at that time, we'll take a call whether, how do you raise more money? Do you need to raise more money? Do you need to give an exit to certain investors? So I don't think
it's not a priority for you.
It's not a priority. Bankers come and approach us every day. I'll show you a whole list of these. They love these books. I don't know. I've got these books lying here. They're like weapons of mass destruction. But it's not something that we think about. It's something that we've considered many times. But I think right now, our focus is on building this business, which we started pre-pandemic. Yes. And then we had to press the brakes. It was a hard time during the pandemic. And then again, we saw all the value that we had put in and all the time that we had put in and the effort pre-pandemic. it paid us back in good measure. Call it karma, call it relationships, call it friendships that we built over the years across the border. In the US, in the UK, in India. And there are some really good people who came back and paid us back in good measure because they knew that we were losing money.
So you've been playing international level badminton for almost 15 or more than 15 years now. Do you feel it also defines who you are as a player now? How you've matured as a player, your journey, your experience?
Yeah, definitely yes. The person you are, the confidence levels that you show on court are very important. And
You know, you talked about books that bankers have left with you to consider the possibilities of going public. But what about M&A yourself? I mean, I brought up Paytm, and that's a transaction that Zomato finally closed at over 2,000 crores. Was that something that you considered? Did you look at it at all?
We always
consider. Are you looking at things at this point in time?
I think it's very difficult in India to, it's like I tell people, and I've said this before, more companies suffer or die out of indigestion than starvation. How do you digest some of this? You know, doing an M&A is easy. And I'm not saying this is a good or a bad one.
Yeah.
I'm not casting aspersions on this one. But I'm just saying...
That's your go-to line this interview, right? I'm not saying it's a good or a bad thing.
No, because see, look, if you read Andy Grove's book, Only the Paranoid Survive, and he talks about M&A, right? And there's a lot of work. Intel grew because of M&A.
Yes.
It's hard.
Yeah.
We've done a bit of M&A. We've had like Sunburn is something that we had a structured deal over a period of time. Karan, who's a great founder, works with us now building Sunburn. We just don't talk about it, but Sunburn is something that we did. Chauvin Shah, who ran Tribe Vibe, is a part of the Book My Show family. We have a company called Peppo, which is Naman Pogalia, part of the family. All grade 3 entrepreneurs, as we call them. They're all building their businesses as a part of Book My Show. But it's under the radar. We've never gone and made a big, tall claim that we bought something. Also, it's important to see culturally whether this fits. Right? It's easy to say that let's do an inorganic sale, right? There's organic growth and inorganic. Suddenly you add revenue to your bottom line, and then you can again go to the stock market and say something. For us, it's important to the first handshake. And in each one of these transactions, and many more that we've done probably about 20, which you guys don't know of.
Right.
But in each one of them, we worked with the partner over a long period of time. We got comfortable. They fit in culturally. Somebody you can break bread with, somebody you can have a drink, have a meal with. We know the families, they know us. They become a part of the ecosystem. And then we organically move into a transaction. Another example is if you go to any of our events, you'll see a company called Atomex, this RFID company where we do payment systems and all of that. We own a majority in that company. Again, we worked with that entrepreneur over the years. He's a Pune-based entrepreneur. We got comfortable, and he's a part of the Book My Show family. So we've got about 20 such. None of them are headline-grabbing ones, but they exist.
They certainly do exist, and you've tied up a whole bunch of them. So, finally, before I move on from the competitive landscape and the economics of this business, what would your message be to Dipi Goyal or to Harsha Majety at this point in time as they build out District and what Swiggy is doing with the live space as well?
Look, both phenomenal entrepreneurs and good friends. But let me say friends. We're in touch. We talk. We share conversations. We worked with the Feeding India in the past. We worked with a lot of work that Swiggy's done in the past. Look, like I said, this needs to become an industry. When there are more players, there's more money that comes in. You have the ability to go out into the market to use some leverage with government, or whether it's infrastructure, or whether it is partnerships. And then I think with mature entrepreneurs, you then tend to share some of that, right? You have your own lane, you have your own business. You can be competitors, but you can be fair players. You can be fair competitors. And I think both the founders...
Is it a fair market today? Because I know that, you've always been someone who said that whatever you get free is not something that people value, and so you've stayed away from the discount.
I'm not asking for anything. Oh, you're saying if there's discounting that happens.
Exactly. I'm saying, is it a fairer market today with competition?
Look, if you're talking, and I'm talking about purely the entrepreneurs and the companies, I think they are fair competitors and building a business which they think is right for them. I don't think any of these entrepreneurs have lasted 10, 15, 20 years by looking over their shoulder to annihilate somebody else. They're trying to build their own businesses. And if it crosses paths with somebody else, you find your own way to working with shared values. Sometimes you'll agree, sometimes you'll disagree. Now, in terms of discounting, I have a very different view on discounting. I think if you continue to discount, you'll build a bottom feeder scraping economy, right? And there's no loyalty in that. Consumers will take that 10 bucks or 50 rupees if they're getting it, and why not? And they'll bounce to the next guy. So I don't think there is any value in discounting, but there's value in giving services back.
Right.
And I think consumers, like we're saying, that it's become a experience economy where consumers are discerning, and we use it in the same sentence, right? That consumers are discerning. So when they're discerning and you're going to discount, how are you going to be discerning to your consumers, give anything to them?
Yeah.
And you can do it for a period of time.
Yeah.
You can't do it lifelong.
Yeah.
Right? So then even consumers are getting smarter about the fact that this party won't last. Everybody used to get 500 rupee discounts. Then it became 200 rupees. Then it becomes up to 100.
Yeah.
Then it's become up to 50. And within up to 50, only if you do this. It's stupid. Right?
Yeah.
Consumers also get it.
Yeah.
So I feel that the more we focus on, all of us focus on, and why do we like buying things in the US?
Yeah.
Right? Why is it in the US? You pay a price, but you get great service.
Yeah.
You can return something, you get great stuff, something breaks, you can reach out to a customer agent. You will get a response and you'll get feedback, or you'll get your product back, or somebody will fix it. But if you're constantly discounting, you're always going to scrounge on trying to say, how do I screw the guy? And that's not what we do. We've had so many instances where events have got cancelled or something's gone wrong. Book My Shows stands guarantee in between, where we refund all the money. And we haven't got paid for sometimes a year, sometimes 2 years, sometimes never. But we've always given the money back. And that's for us to carry. And the reason we do that is because, we think that we owe it to the consumer. And that's why we don't discount. We charge a fee, but then we give you the kind of service that you deserve.
Since we're talking about trust as well as the customer, let's address the issue that you've been dealing with in the last few months on account of what's happened with Coldplay. You've got investigative agencies, you've got the EOW, you've got the GST authorities, and so on and so forth. In your office, you've been summoned. And the allegation is that, look, there has been a scam that's happened. The tickets were sold out ostensibly, and then they were put up on resale for 3, 4, 5, 6 times higher the amounts. Now, how do you address that? Where are things as far as the investigation is concerned? You've of course been dealing with the investigative agencies, and how do you cope with this? How do you come out of something like this?
Look, it wasn't easy, but it's also something where I put my head on the bed and I sleep easy. I've got a clean conscience. My karma is good. I sleep well. Not one night of sleep did I lose on this. However, it was hard. It had to be dealt with. I must say that within the government and the authorities, there are some really good people that stood up. Friends like Nikhil Kamath, came out of the blue, sent me a text, called me and said, Ash, I've been through stuff like that. You need any help, reach out. Keep your head above the water. Don't react. And we didn't react, right? As a company, it was sub judice. People abused us, called us black marketeers, called Book My Show, said, cancel Book My Show. It's this cancel economy, right? You have nothing to say. If you see people on social media, they have only negative things to say. You have nothing nice to say. So it's not something worth looking at. Having said that, what we could have done better, I think the first show, we did a linear queue rather than a randomized queue. And then we came up with a randomized queue. What did happen is that for about 7 to 8 minutes, our site crashed. And it crashed because we had 10 million bots that hit our site. Now, we could have mitigated and managed that better, which we did from the second show and the third show, and then the 2 Ahmedabad shows. We did that better. But to say that we
were
deliberately crashed our site, that was the allegation. We deliberately crashed our site. In those 10, 12 minutes, we bought all the tickets, and then we've sold it in black. Now, here's the bizarre situation. If we had to sell it on any other platform, why would we pay 30% fees to that other platform? Book My Show is just not the producer and promoter of the show. We're also the platform. If we needed to charge more money, why wouldn't we just increase the price on Book My Show? Why do we need to buy it off Book My Show and then sell it on another platform and then pay fees for that platform? We'd rather just keep the fees for ourselves and increase the price. So there's no logic to that. That's number one. Number two, we have the email ID, mobile number, home address of every single transactor in this country, which once the authorities looked at, they were satisfied to see that every single transactor has been accounted for in the country. So we decided that instead of 8 tickets per transaction, we'll reduce it to 4 so that more people get a chance to buy the tickets, right? And we have the email ID and we have the home address of every single transactor. So you can go and check any single transactor, and we've complied with the authorities and given all the data to say, you want to call anybody, you want to check who's got the tickets, please do so. So this allegation that we crashed the site, we bought the tickets, we sold them in black, and we did something nefarious is just stupid. I mean, I don't even know how to react. So therefore, we didn't react. And all we did was go to the authorities. But the immaturity in the system was that everybody woke up and just started blaming, and we were vilified by everybody, right? Without even getting to the truth or even asking us questions. Rather than saying, hey, Book My Show, thanks for, working so hard to get this sort of a concert, which was an aspiration for so many Indians for so many years. And then to keep adding shows and to do that was hard for us. In spite and despite of the infrastructure and the challenges and stuff that we face. But there were really good people that stood up within the government, within the administration, who stood by us and said, no, you guys have done right. We believe you, we trust you, and we're going to stand by you. But it took time. Until such time, this was a news cycle. It was a media cycle for 1 month. It went on and on and on about summons and FIRs, and we had lots. We had 5 or 6 agencies after us. And I think everybody felt the need to check if there was something really that was wrong. And we were transparent.
So have they gone over all the data? Have they gone over the books?
They have. They've gone and look, it's all, it's been pulled back. They've all, looked at the data. They've looked at the work that we put in, the tech that we put in, and they're all satisfied in how we handle this. There's nothing to hide from ourselves.
So what has been the big learning that you hope you will take away from this as far as the future is concerned in the way that you do things, especially when it involves big names like Coldplay?
Look, we did not anticipate the kind of traffic and hysteria or the number of people that would come. We thought it would be largely centric because India has never traveled. When we had Formula One, also for 3 years, outside of Delhi was, I think, less than 2.5% of the transactors. Indians don't generally travel within India to go to another location. I think a lot of Indians who were discerning, and this is a learning over the last many years,